What's up, what's up, what's up, guys? All right, it's Friday, so the end of this wild week, probably the third or fourth wild week in a row. Who knows? Of course, here we are, we chime in, or we log in here to CNBC, and they're talking about Chewy and GameStop. Always talking about GameStop. It is their ratings queen. So we had the same issue yesterday with when we got on to CNBC. They just start talking about dramatic stuff, which is no. I mean, it's fun. These guys are awesome, but man, sometimes I really wonder um, if they're talking about just random stuff for no reason at all. So hold on one second. I'm trying to pull something up here. So, where are we? Where are we? I do not know where the heck we are. As much as I think Chewy's a good company, cool company, they have done a good job um, creating a business model that's specific and isolated to a certain thing. They're talking about the pet industry, but at the same time, I wonder what are they doing that special that someone like I don't know Amazon couldn't just do. I don't know. I like Chewy, but to me, it's just a really good narrow, um, just a really good but narrow e-commerce store. That's it. So unless I'm missing something of what makes Chewy so darn special, and if I am, let me know what in the world I am missing. But that's what it sounds like to me. Um, but either way, I like the company, I like the division. I'm not sure if it's quite as spectacular as everyone wants to make it sound because it seems like it's just an e-commerce store that focuses on pet food and all that jazz. So, anywho, that's my quick rant just because they were talking about that. But let's look. They were also talking about something I found interesting. I think was a lot of time. They were talking about SPACs and how A, there's too many, and B, there's a lot that are below 10. There's a good opportunity there. But if you get in one that hasn't announced anything and it's below 10, might be a good opportunity. Having said that, they did obviously talk about the risk because there were some that have already announced their intentions and mergers and yet have now dropped below 10. So, and I think we haven't seen it drop below 10, but we've seen something similar happen with Churchill Capital, where there was this rumor of Lucid Motors merger, and then next thing you know, they the price just drops dramatically from $60 down to about $20 because the valuation wasn't expected. So those things can happen after you got into 10. Either way, you're still down your investment. So, and I think over time, once the merger completely happens and the ticker changes and all that jazz, I think it'll go up as long as they start delivering cars. If they somehow don't deliver the cars here in 2021, then I think we all might be screwed in the EV market because it's really just going to be a one-horse race with Tesla. I mean, maybe there, yeah, a little bit with NIO, but NIO's in Asia. I don't know if NIO plans on delivering cars to the United States. So anyway, um, let's see where we are at here on the stocks we are watching today. Again, just like yesterday and other days in the past, I felt AMC is primed to ready to take off. Looks like all of these guys stumbled out of the gate, with the exception of maybe Express. Express is already up 8%. Pretty good pre-market. Let's zoom in a little bit. Let's go to the one day, 1 minute chart on Express and see where we're at. So let's go to um, just the overnight morning and so far this morning Express. So It started tanking right below the market open, and it opened at 4.9. So here's kind of like 535 to 49, and then right when the market opened, it took right back off to 5.5, 5.7, something like that. So pretty good opening for Express. AMC did a little bit of the same, but just shifted. They were doing okay until the market opened. Then they went down. Now they're trying to turn around. So not a great start at the gate for AMC. But hopefully this little turnaround right here means something. It's down 3.75. Let's look at costs. Looks like cost is doing almost exactly what AMC did. Uh, also stumbled out of the gates and it's starting to make a little bit of a turn on the corner. GameStop kind of doing the same thing. So they're all kind of trending the same way right now. What that really means is overall market conditions are driving that, but at the same time, we're seeing uh, what I've been saying for a while is that a lot of people have these three and various other stocks all in the same portfolio. So when they see something trending or one's going one way, then they're all going to go the other way. If they all buy one, they're all going to buy the other. If they all sell one, they're all going to sell the other. Because a lot of people have all of these in the portfolio at the same time. Express as well, but Express is of course still riding the wave of their earnings report from last week. AMC, I think, is somewhat riding away from an earnings report of a couple of weeks ago, I believe, is when they posted. Plus, having some good optimism. If we do more about vaccines and theater openings and stuff like that, as long as AMC can stay up here and doesn't crash back down to $7 a share, and more good news comes out for AMC that'll shoot it back up again, we could see it back up into the $16, $17 a share. Will it get back up to 20? I think it will at some point. Will it do that in this iteration of it spiking? I don't know. We got Express coming back north. Express is doing good, up 8%, still doing good. Cost trying to make a comeback. GameStop trying to make a comeback. And AMC, the slowest of the comebacks, but also trying to make a comeback. It also has probably pretty good volume compared to some of these others. So let me see. Okay. Yeah, look, I mean, the volume on Express is so small, so small, but it's moving. So, I mean, I'm happy for that. Cost volume is actually pretty good, believe it or not. It's interesting, considering the price of that stock and the volumes are in the tens and 20 thousands. It's pretty surprising, actually. Even GameStop is not near there at 200, unless it's 200,000. Yeah, no, that's 200,000. I'm great, and that's 400,000. I was thinking, man, those numbers look so small for GameStop and Express, and these are 20,000 and 10,000, which that actually makes more sense. I would expect cost to have less trading action than GameStop and Express, um, and of course AMC, which I don't have. I have a different scale here, and it's on a different axis, so I don't even know what the volume is for Express. Oh, there it is up in the corner, 1.3 600,000, so in the hundreds of thousands. Uh, First minute out was 1.7 million compared to GameStop doing only maybe about 300 million or 300,000. So lots more shares getting traded on GameStop, but then again, GameStop is less than 1/10 of the price. So that's also part of the reason why GameStop shares are so much lower than AMC shares as far as volume, not necessarily dollar amount transacted. So let's see what else we have here on the market. It's been an interesting stumble out of the gate market for the rest of the indexes as well. Everybody is currently down. The Dow is opened down and is trending down. It's right now at 32.50 for 513, down 1 full percent, 350 points. NASDAQ opened up, but then went down quickly and is maybe turning a little bit of a turnaround here. It's trying to. Kind of the same with the S&P, but the S&P also opened down. So we might hopefully turn some things around and see the NASDAQ have a great day today. I think that would be good for everybody. But we also saw the Treasury yield open down at 1.687, and now it's shooting back up to 1.741. So that's probably why we're seeing the NASDAQ open green and then turn back red. So kind of a bummer there. Let's see what else we have. That is open. I mean, QQQJ, surprisingly, is one of the QQQ family of ETFs. QQQJ, which is um, more of a forward-thinking innovation fund compared to the others that are more of a legacy level technology fund. Anyway, QQQJ is actually positive right now. Not much, but positive, which is interesting compared to some of the others. Netflix was green, just turned red. Amazon is green and is about to turn red. Same with Apple. Facebook's actually doing pretty good. Facebook out of the gate at 2.29% positive and actually climbing. So good for Facebook. Peloton opened low and is spiking up. So really, really good news for Peloton. Zoom out of the gate is a little positive, but nothing crazy. Ford's doing good. Ford's continuing to invest. I really wish I didn't share. I sold a bunch of Ford shares maybe 3 or 4 months ago. I really wish I hadn't because they've been doing really, really well. 7% up in the last month, 42% in the last 3 months. And I think I missed out about 42%. I think I sold it when it was around $8 a share. Now it's at nearly 15. So man, I did miss out on Ford, and I mean I made a profit on the Ford shares I had, but missed out. EXPI opened up and is trending down. Wayfair opened about even and is trending way up, so that's good. Uh, let's see what else we have on my list here. Asana down again. So I don't have a ton in Asana. I did, and I made some money flipping Asana early on after the IPO, but down again today 4%. So that's a huge one. Neo slightly up, trending up. Churchill Capital trending. That's trending back up, but it's down for the day. But I mean, compared to where it was at 32 earlier this week, Tuesday, and now it's down to 26. So there's an opportunity to get some, maybe some Churchill shares pretty cheap. And then the lowest it was since the announcement was 26.8. I think there's an opportunity there with Churchill Capital, which is Lucid Motors. Its market cap right now is below 7 million or 7 billion, I should say. Express shooting up. We're seeing it there on the screen. It's up to 5.67, up 11% today. It's fantastic numbers. AMC finally making a little turnaround there, nearly back to positive numbers. Looks like it's stalling there at 13.87. Riot and MicroStrategy, two of the emerging tickers that are very, very reliant on Bitcoin and cryptocurrency prices. Both are positive today. Ark Invest positive today. Roblox out the gate 4% up, so good for Roblox. Still not sure about its valuation, but good for Roblox. Bitcoin, let's go back to the cryptos. Bitcoin did peak back out at 59,200 not that long ago. Earlier this morning, it's back down to 452, which again, just yesterday, it was in the 56s, or even 54 at some point. It's 55. I don't know. It might have gotten barely into the 54s for a moment yesterday morning. Yesterday morning was really weird for the cryptocurrencies. They had a weird glitch that like for about 15 minutes, it dropped about 10-15%. So if you got in then, good for you. But all the major cryptos are up right now. So hopefully things are looking up. A lot of the ones that opened down are turning back up. QQQ and TQQQ are both turning green now, which is fantastic, which means the NASDAQ is turning around. And sure enough, it is. So hopefully, I'm really hoping that we have a great ending to the week. But it's like we're walking on eggshells today. We're absolutely walking on eggshells today, which I hate because Wednesday was interesting with Powell talking. Had an interesting reaction afterwards, and then yesterday everyone's like, "Yeah, we need to raise the interest rates, which is gonna demolish the equity market." And sure enough, that's exactly what happened. And everyone was down. My portfolio was down like 4 or 5%, which sucks. Now on a good day it goes up 6 or 7% because it's got some a handful of very um, volatile stocks in it and volatile ETFs, which I like. I believe in them, so that's why I own that stock, but man, it can be roller coaster. You got to have some thick skin and a level stomach to make some of these things work. Tesla is one of the golden childs of that. They're down again today, down to 638. When was the last time Tesla was under six? It was right back here. What date was that? Why isn't it telling me what day that is? That's annoying. I don't know. Early March, I think. It was down below 600, is hovering down there. If I go out to let's go to the 180 day and we can see Tesla's chart. Tesla now, if we go back 180 days, which is half a year, back to when would that be? September? It doesn't look as amazing as it once did, as it did, January, between January and August. It looked very different than what it did from September to now, where it really went, 400 to 600, which is not bad. Not bad. Week to date, I thought they were saying Zoom is down 7% just today. Crap. But yeah, I mean, I own Tesla, I own Zoom, I own Okta. I mean, these guys are turning around. These guys are all having bad days, bad weeks, which sucks. I need those guys to turn it around. But look at Tesla's chart. I mean, they've gone from 407 to 642. Their peak went from 407 to right at 900, right there. They barely got to 900 right there, which is amazing. I mean, it's more than doubling their stock. And then they went down to 550 ish, 560, 570. So now they're at 641 or 640. It's still taking down. Yeah, I think we're seeing a little bit of a realistic turn, I guess, in what we're seeing from Tesla. Because if you look, this is back a year. Pre-split was the equivalent of $81 a share, up to 900. That's more than 10x. But just in the past 6 months, here's if you look at just the first of the year is at 660. So 3 months, nearly 3 months into the year, and it's actually down year to date. So Tesla's just not what it was as far as the stock. I'm not saying the company. The stock is not what it was, which is very very unfortunate. I think it'll still turn around. I mean, it had a period right here from I don't know what was it 9/2 through 11/4 through around a little after the election. So 2.5 months where it trended down as well. So not this far down, not from 9 to 6, but from what 493 to 403, it trended down for a whole 2.5 months, and then it finally kicked back into gear. So we might see the same thing. It'll trend down for 2 or 3 months, and kick back into gear, and it may end up at I don't know 11, 12, $1,200 a share. So you could have a great opportunity to buy in now if you're optimistic about it. Come on, Express. Come on. Man, I would love to see Express get back above six and then keep on going. Look at this. This is awesome over here. Love it, love it, love it. AMC, not as great, but doing okay. Trying to make this little comeback. Same with GameStop, trying to make a comeback. Costs, looks like its comeback is fizzling, so that sucks. So I don't know. Express might be my golden child today. I was hoping, again, I'm really hoping it's AMC. And I mean, again, I'm in a profit level with AMC. I could sell all my AMC shares right now and walk away with a profit, but I'm not. I'm trying to see where it goes. I want to see it go to a much higher price. Whatever that may be. I don't think it's going to go to 1,000 like some crazy people do, but I think it could go back up to $20 to $30. Oh man, I need to go back. I keep going over to the Thinkorswim screen and just talking while I've got that on the screen, and I never pay attention to the fact that I've got a comment on here. So I apologize. Klaus Media, CCTL, 1 cent share for Bitcoin company. Get some before market crash. Not completely sure what you mean, but let me pull them up here real quick. CCTV? Yeah, I totally just butchered that. Hold on. I'm using one screen to go back and forth. I'm not cool enough. I have three work screens and only one streaming screen. So CCTL. CCT, CCT is closed captions. That's what. All right, let's see. Closed circuit TV, not closed caption. What am I saying? 1 cent. Coin Citadel. Yeah, I don't know. Let's go here. Yeah, yeah. I mean, listen, guys. I know people love penny stocks. We love us some penny stocks, don't we? And I'm not saying you can't make good money. It's risky. I'm not saying you can't make good money on penny stocks. But I'm not going to say if it is right for you not to invest in a penny stock. However, I learned very early the massive risk of penny stocks and what they've. Uh, I got burned on some penny stocks when I was younger, just trying to figure out how to trade things 10 years ago. It, although you can, and you can make money in the same day, like intraday, like if you want to day trade, you can, uh, but it's also massively risky. Plus, you're going to pay a commission. I don't know any brokers. I mean, maybe Robin does this, but I don't know of any other brokers that are not charging a commission still in these stocks. So you also got to think of market cap and volume. Yeah, so I look at this one. We talked about one yesterday briefly in the afternoon. It was the same type of situation. The market cap on this entire company, CCTL, which I'm very skeptical just based on the name Citadel, but you know, not that they're related to the Citadel with GameStop fiasco, but probably not Robin fiasco, but um, it just makes me think that someone's in there just it's like okay. Sorry about that. I had some work going on. So I'm just risky on anything that's related that says Citadel. It's like naming your company Walmart.com. It's like I don't know if they called Clean City that 10 years ago. They were called Clean City. They changed it in the past month just because they wanted that keyword search. But here's my take on penny stocks. You got to look at the volume. You got to look at the market cap. And here's the reason why. If you are to make money on something like this, you have to trade 100,000 shares. Right, so 100,000 shares times 0.16 is $1,600. So $1,600 is I make money. I don't make money. I mean, if you're going to try to make $100 on a day trade, you have to get 100,000 shares. Okay, the entire volume yesterday uh, for Citadel was 1.677 million shares. So 100,000 shares is one. I'm trying to think. Was that even might be no. Sorry, I was looking wrong. So your average volume is that is right. Yeah, sorry, I'm looking at the chart wrong. So 1.6 is about 12 or 7 or 8% of the entire company's shares traded in a day. You would have to trade just to possibly make $100, $200 on a day trade. And the problem is you're going to be the one that you're going to be the one person trading 8% of the entire company of their trades that day. So who's going to buy it, right? You buy 100 shares 100,000 shares cheap, try to resell it 2 hours later. Who's going to be there to buy it? Who else is there? Someone has to buy your shares. You have to buy your shares from somebody else, and then someone else has to buy your shares when they're selling it. That's the problem I think some of these very low market cap uh, penny stocks. And that's why you see the volume so massively low, the volume, not volatility, the change in price happens so slowly. I mean, how we see it with cost sometimes, and cost is a multi-$100 million company. I don't think they're at a but we're looking at a company here where if you have $1,000, buy out 100. How are you making how if you want to put $100 and buy 10,000 shares and then just see what happens in the future, great. Again, I'm not going to recommend that at all because the only way that I see anything happening is if they try to raise more capital and release more shares, and if they release more shares, it's just going to dilute yours. And it just doesn't make sense. So if you have any penny stocks that have market caps in the tens of millions, which I think there are some, then you might do something. You might have a chance because you're not going to be the one person in the whole world trading all of their shares in one day. So that's my take on CCT. I don't care if they're a Bitcoin company. They're not going to be the next Riot blockchain. I can guarantee you that. Um, I don't even need to click on their system to do any research on that because there's not a market cap. I don't even know how a company is public, even on the OTC markets. I don't even know how they do it. I mean, hell, I could start a company tomorrow where I could start a company doing what I'm doing right now. Get one advertiser to join me here on my other YouTube channel is worth $3,000. I could go public just on my other YouTube channel and value it at $3,000, sell some shares, and it's very likely going to keep going up in the future because I've got more advertisers this year than last year. Long story short, if you're going to mess with penny stocks, just go with the high because you're either A, going to get burned, or you can absolutely get lucky and make a lot of money. But on this particular one, you're not going to make a lot of money. You may make a good return, but you're not going to make a lot of money. If you want to invest $100, sell it for $200, which it's not going to get $20 to, it's not going to get anytime soon. But if you want to get in it with $100, try to sell it for $200 and pay your $7 to $15 commission on both directions, go for it. But you very low chance of actually making that trade happen within a day. So that's my take. So no, sorry, I'm not going to get in a share or CCTL on a company that has a valuation of $3,000. That is my rant. I'll click back over the news. Meanwhile, during my rant, Express topped out and then went back down. So thanks a lot. You missed that. I could have ranted about Express rather than CCTL. Let me go back here. Let's go back. What am I looking at? My names. Why does this chart look weird? Time frame. I don't know. One day, sorry. There we go. One day and 11 minutes. There we go. All right, let's turn up the volume and listen to what these schools are talking about.
Last night earnings delivering beats on both the top and bottom lines, thanks in large part to a quote unprecedented peak holiday shipping season. And this even as February's severe winter weather through much of the country actually cut operating income by some $350 million. Ground revenue surged 37%, even as average daily volumes, which were up a hefty 25% year over year, grew at actually a smaller rate than the yearly gains that we saw in the previous two quarters. Speaking of pricing power, as FedEx managed capacity and delivery performance, calling the company's role in vaccine delivery, quote, the most important work in the history of FedEx. CEO and Chairman Fred Smith also saying, quote, we expect demand for our unmatched e-commerce and international express solutions to remain very high for the foreseeable future. Now, FedEx expects, I should say, international air freight markets to remain tight for at least the next 12 months. It even issued guidance, which is something it hadn't done in a number of quarters. FedEx, like its rival UPS, has benefited from the accelerated boom in e-commerce amid the pandemic. The company does expect to continue to see that demand growth, even if after a slightly less aggressive pace could occur in the coming weeks, coming months. Now, this is something I actually asked COO and President Raj Subramaniam about earlier this month as well.
We have seen a step change and an acceleration of trends, or 3 or 4 year acceleration of trends. I don't think it's going back. In package terms, when we put these numbers together, there was 50 million packages in the industry per day in 2016. We expected that to double to 100 million packages per day by 2026. Well, we now expect that to happen by 2023.
So as you can see today, shares of FedEx are leading the S&P. They're up 5.5%. And actually, shares of UPS are trading higher in sympathy as well, David.
Yeah. Wow. Another good day. Still ahead right here, the Biden administration's first high-level meeting with China getting off to a bit of a rocky start yesterday. Very interesting. We're going to discuss how it could impact, well, the relations between the two countries and, of course, your portfolio as well. We're back in 2.
All right, guys, we're going to switch over to TD Ameritrade TV because these commercial breaks, especially in the morning on CNBC, are just
some disappointment, no question about it.
every 5 minutes are going to
Yields coming back down a little bit overnight, but now they're back to where they started ended the session yesterday, and that's I think leading to further selling pressure. This downside momentum is certainly something that is a bit of a challenge for the market currently, and I thought the tech sector was going to hold up here, and then once that started giving up some ground after yesterday's selling, we're seeing it now, taking another leg lower. It does feel at this moment, though, Oliver, as we see the bonds kind of holding here, that it does appear that it's searching for some type of temporary bottom. We'll see if it can find its footing here, but nonetheless, it's a disappointing start to the day.
Okay. We are right, like the point about bonds. I mean, we are right tick at the low from yesterday. So bonds just hit that, found a buyer, and then now we see if we can get back to where we were earlier this morning before that SLR news. So bonds firming in. I think it's a good point. Mike, Dan, sorry. What about hiding out in Starbucks? What do you think about the report here that Mike just laid out for us from Wedbush, the bullish case to stick with one of these consumer winners?
Yeah, not a bad place to hide out, Oliver, during a pandemic, I guess. So, the stock has performed admirably. And as you and Mike pointed out, some of the transitions that they're making during this process are going to benefit them, I think, moving forward. But when you look at Starbucks over the course of the last couple of months, yes, it is just coming off of all-time highs, but it really hasn't been too much outside the range that it's been trading in really since the middle of February. So, I'm looking at a similar trade to example to what we talked about last week, where I'm looking to collect some premium and bide some time with the opportunity to potentially pick up Starbucks at a better level, but also have a defined range, I guess, to the upside, where if it gets up there, maybe I'd be thinking about getting short the stock. So I'm looking at a skewed iron condor this week, Oliver.
Okay. Skewed iron condor. So you've got a preference to one side then?
That's correct. So basically, yes, it's a little tighter at the money or just out of the money on the put side. So again, I'm looking for the opportunity to get long the underlying at a better level, right around that, or just below that 50-day moving average, actually around 104.5. So I'm looking at a May trade here, Oliver, where you can sell the 105 put and buy the 95 put, defines your risk to the downside, allows you to collect some premium, and also sell the 120, 125 call spread in May to collect a little bit more premium, because I just don't see Starbucks really racing up to 120 here in the next 2 months. So again, playing for a range, collecting some premium with the opportunity, if we do see Starbucks slip here the next couple of months back down below 105, the opportunity to pick up the stock, and I think at a better level relative to where it's trading right now, given the fact that we're seeing this announcement this morning not really having too much of an impact on the stock.
Okay. So right now down about 1.5%, third day in a row with some weakness, but a bullish trade here to take advantage of a bullish note on Starbucks. Analysts looking for a new high. Dan, thanks for the thoughts here and the update on the market.
Thanks, Albert.
Appreciate it. Mr. Demings, Managing Director at KKM Financial. As we heard in the Starbucks earnings deep dive, supply chain an issue for the coffee chain, but what about for the most popular trade of the past year? The electric vehicle stocks have rolled over. Lately, the market's been more interested in buying Ford and GM. We'll talk about the supply chain for the sector next.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Let's talk more about the supply chain shifting from the consumer side to a different angle. Electric vehicles and the stocks that have been rolling over. Joining us is the analyst covering oil and gas at EP. And with that, some electric energy. Gabe Down is covering mobility technology at Cowen too. Gabe, you got a lot under the coverage right now. Let's talk about the electric vehicle space. How are they faring in this complicated supply chain environment as we've seen so much apparent pickup in demand? What's going on with the supply side?
Yeah, good morning, and thanks for having me. It's certainly a good question, something investors are focused on, and I think One of the things that we've highlighted and wrote about in terms of what could drive EV adoption is really the need for charging infrastructure. If EV penetration does accelerate at the rate at which we all think it could and represent 30% of vehicle sales by 2030, that'll necessitate the need for a tremendous infrastructure build out that at the very least could represent about $20 billion in investment throughout the decade. So investors are certainly monitoring charging station deployments, which business models are coming to the market, who are the key players involved. But it's certainly something that's necessary and will obviously benefit from the continued adoption of EV vehicles.
That continued adoption and the expectations of further adoption have fueled one of the biggest market events in years, which was the giant rally, not just in Tesla, but across an array of different companies, some of which don't even have orders yet, as we find out that there are a lot of expectations mixed in with reality. So is there enough demand to justify the supply buildup that's been coming? We hear constantly about new automakers and their plans to build, but do we know really that all that demand is there, or is it possible we're going to fall short if the economy doesn't bounce back, or if people have already bought their cars over the past year?
Yeah, certainly a good question, right? Everyone is certainly excited about the potential OEMs, investors, but you could argue you just need to get consumers on board, as you mentioned. So demand could certainly represent the key factor in that. Volkswagen just hosted their inaugural Power Day. They're anticipating getting to, I believe, 80% of electric vehicle sales by 2030. So there's certainly a lot of excitement across all key stakeholders, but you could certainly argue up to this point, electric vehicle sales have represented just a small portion of total vehicle sales. In 2020, electric vehicles represented just about 4% of global vehicle sales. So demand certainly needs to increase, as you mentioned, but throughout the decade, we do think it will. There's a number of supportive tailwinds on the policy side. Obviously, there's a renewed focus around greenhouse gas emissions and combating climate change. And the way to do that is to electrify mobility. So through the decade, we do think electric vehicles will continue to penetrate and represent 30% of sales by 2030. And again, that will ultimately necessitate the need of other, or demand, the growth and demand of other areas within the electric vehicle ecosystem, including batteries and EV charging.
So the charging side of it, one of the other things that's been interesting is the push out of metropolitan areas. We saw a lot of home building in the suburbs and folks relocating, given the work from home capacity. But at least from my kind of top-down view, it seems like a lot of the areas out, kind of the more suburban you get and kind of the more rural you get, the further you might be from a charging station. So how is that relationship playing out now? Are the folks living in some of these non-metropolitan areas owning EVs, and thus do they need the charging stations? How is that going to work?
Yeah, Oliver, definitely good question. Again, I think one of the key issues that has impacted to date wider scale EV adoption has been the cost equation. Currently, on an upfront basis, electric vehicles are still maybe $5,000 to $6,000 more expensive on a like-for-like basis versus a traditional vehicle that's powered by gasoline. So I think ultimately over time, really within the next couple of years, you should start to see that inflect, and electric vehicles will become, on a like-for-like basis and on an upfront basis, cheaper than a traditional internal combustion engine vehicle. And we think ultimately that could obviously attract to rural areas of the country. It could also attract to folks, middle America, that's obviously more sensitive to price. And then also what will continue to enable that is charging infrastructure. Again, we think ultimately that there is certainly a psychology in place, and we do think that many portions of the population won't necessarily go all in on EVs today because there is a lack of infrastructure. And so it's somewhat circular. You need more EVs in the fleet to drive an increase in electric vehicles, but then from the to drive an increase in infrastructure. But then from the infrastructure standpoint, you need to see more electric vehicles in the fleet to incentivize the build out. So it's circular to an extent, but I do think those two key issues, price and charging availability, will ultimately drive a continued acceleration in EV adoption across all portions of the population.
What role does the government play in this? Maybe the way to think about it is as currently priced into the markets or the demand equation? Do we need to see very real, tangible policy embrace by this new administration through either deeper credits or infrastructure build out specifically designed for EVs? Or, can this market do it privately on its own?
Yeah, certainly, like I mentioned, the policy tailwinds are in place. This administration is obviously focused on cleaning up portions of the transportation sector, as I mentioned. And also there's the Clean Act that was just introduced earlier this month. It's a 1,000-page bill that has earmarked up to $500 million of spending on electric vehicle charging stations over the next decade. So obviously that'll provide a nice tailwind for the sector, and you could argue will certainly be a positive for the stocks and for the sector overall. And then also there's obviously the infrastructure bill that Biden has obviously highlighted that could also earmark some funds potentially to additional infrastructure build out. And then on the tax side, as you mentioned, there are some supportive tax rebates in place from the standpoint of the electric vehicle charging station buyer. They could certainly they could receive tax rebates up to 30% or 30 grand of the total costs of the infrastructure, which could certainly enhance your economics as a site owner and also continue to drive wider scale adoption.
What's the best way for investors to play specifically the kind of infrastructure build out? I mean, we already have seen the excitement over the actual car makers, but for some of these, they're going to be very much involved in the infrastructure build out as well. I mean, is the best way still just to buy a Tesla, or is it to buy infrastructure companies that are going to bring EVs into their gas stations or into their retail spaces? Is it the charging companies like a Blink? How's the best way for an investor to look at this right now?
Yeah, so the charging infrastructure sector is largely new. A lot of these companies have largely come public via SPAC mergers over the course of the past several months. Blink, as you mentioned, has been a public company for several years, so maybe more well known in the public eye. But ChargePoint and some others are largely new, and we think this is an interesting way to really play the sector specifically just through a pure play company that's 100% exposed to this theme. So we do like ChargePoint.
Okay.
They are a hardware provider, and they do offer a cloud-based software solution that comes attached to the hardware. Currently, the company has about a 70% market share in terms of public infrastructure today in North America. Some of their growth initiatives include expanding into Europe, but obviously there's still a pretty significant and tremendous need in charging infrastructure here at home, and so in the U.S. and in North America. And so if ChargePoint could simply maintain their current dominant position in North America, we do think that obviously it would be incredibly attractive to the stock as you think about the next couple of years. So we do like ChargePoint. And another good way to play the sector is through Blink itself, a little bit of a different business model versus ChargePoint. They prefer to own and operate the asset themselves, and this leaves them exposed to higher utilization as more EVs are introduced into the fleet. That would necessitate a need for more charging, and so that could also increase utilization on charging hardware, which would then leave Blink positioned to capture that revenue as well. So we do like those two ways to play the space currently.
Okay. Gabe, been very interesting. Thanks for the details here, and this is going to be a fun one to continue talking about this year. Definitely. And expecting to see some of that tailwind from the policy side. Thanks for joining us here.
Of course. Thanks for having me. Thanks
a lot. Gabe Dowd is an analyst covering mobility technology, oil and gas, and EPs at Cowen. When we come back, let's get the chart master in here, and let's look at some of the other analyst moves from this morning, including Beyond Meat. Looking at a place it's been at many times here on the chart, up 3% this morning. Beyond, once again, trading back around $134. Will it find some support after a big drop? We'll get the take from the chart man next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock. but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full options for volatility course and a whole lot more.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full options for volatility course and a whole lot more.
It's time for the Chart Master, looking at analyst upgrades and downgrades today. Ben Watson will get technical with us here, Ben. Let's start with Beyond Meat. Looks to me like a place where this stock has found support in the past. What do you see? Is it going to happen again?
You know, that's the good question, right? It's down, you're right, on an area where it's found support horizontally. It's getting squeezed down onto that level from this diagonal downtrend line. And at the same time, this is a stock that's been moving in an intermediate to long sideways trend, really quite a bit along this 133 support. It's come down from that January high, which was up around the 221 mark. The question is it going to bounce here? Are we going to get a move higher out of that diagonal trend line? Or is it going to break down through this 133 that it's tested multiple times? And Oliver, this comes on the heels of major announcements in February from McDonald's and Yum Brands, both looking at expanded partnerships with Beyond. So from a fundamental perspective, we might be thinking bounce here. Now what we're seeing is really just kind of grinding, if you will, down into this corner on this descending triangle. So sentiment starting to maybe split the difference here. Intermediate term is uptrending to a higher high, higher low, falling a little bit, but long-term sentiment's starting to rise.
So the long-term sentiment starting to rise after this basically 2-month-long downtrend. We had that gap up, big move to 220, and they sold it right down. Obviously, it sticks out on the chart, and you know, you do kind of wonder how difficult it's going to be to get back to that height when it seemed like we were breaking out, but it was just this giant head fake. So, you know, the way you've got it drawn here means that if we do slip, then there's another level of support pretty close down below. And if we do bounce, then technically you've got a little bit of a shorter term higher low, which would be very good. It seems like you would want to see this bounce, or else that 200, 220 range looks like a long ways away given how violent it was up there.
Yeah, absolutely. I think the bounce becomes critical here. And maybe more importantly than the bounce is the break of this diagonal downtrend line. I mean, it can bounce to varying degrees here. There's a previous high at 149. There's another previous high up there at 156 that it could touch. I think as long as it gets above that diagonal downtrend line, which represents some pretty significant resistance in the near term, that becomes significant, because then that price could come back down, retest that diagonal downtrend line as support, and possibly move even higher.
Okay. So Beyond Meat with the bullish price target, I mean, this is a pretty bullish move. Steven's saying that it could trade back up to 190, right? A price target $190, yep, which would put us just below that 220. But the previous high would basically be achieved back in October. That was about 195. So we know that this can trade there. Question is, can this string of fundamental news that does seem very positive, partnerships with fast food chains and restaurants that should see some more traffic going forward in a reopening. So Beyond, maybe with a little bit of that type of you know, reopen theme. Then again, with folks not eating out, then there weren't a lot of options for Beyond Meat's competitors, it seems, to be pursuing partnerships either. So in some ways, I wonder if their kind of first mover advantage gave them a very big one over the last year. All right, Ben, let's go over to Kimberly Clark next. The old toilet paper play that got up to a high of $160 by the summer. It reclaimed its pre-COVID losses very early on by the first week of April, given the shortages that were out there. But it's now back to where we were at $130. You got to go back to February to get here.
Yep. And it's been in this kind of gentle, soft, fluffy downtrend, if you will, as it's been moving sideways, right? But it's been building a base right around this 130 horizontal support level. And we get this little bit of maybe an ascending triangle. It's gentle, it's subtle here, but it's under that 136 resistance. And I think if we can get a breakout above that 136 resistance, the natural point that we might see this move to, which coincidentally is the breakout target for the pattern, is up around that 141 mark. If it comes back down, I think you see it back down on the 130. But we get a little bit of a gap down rally today on the downgrade, maybe giving us a bit of a hammer type candle here. Now, you don't think of hammers and toilet paper in the same sentence usually, but you know, you think about it from that perspective. I mean, this might be a soft bounce up off that line. Long-term sentiment rising and oversold. It's not out of oversold yet. Intermediate term sentiment uptrending. I think there's some bullishness in the sentiment indicators here, you know, and you know, they also make diapers, and so maybe this is the birth of an uptrend.
All right, the boom there. Man, Ben, you fit a lot in there. All I know is looking at the chart, it looks like maybe the wipeout is done for this one in the moment. Okay, Ben, let's go over one more. By the way, the downgrade came from J.P. Morgan, who now says you can hold it after they had a buy on it. So they did drop the price target to 123, which is pretty substantial. They'd had it at 170, or sorry, they'd had it at 144. Last one, Ben, let's go over to SEDG. You're going with an overlooked stock here over the last couple months, because as the solar plays have slowed down, nobody's been really talking about them so much. But for Solar Edge, what does this look like? Is it a downtrend? Is it a pullback? How do we think about this?
I look at this from the perspective of being an intermediate term downtrend. It's really been channelized, though, since that January high at 375, and it's been moving in that downward direction. Most recently, we get the bounce down from the channel top there at 302. We're getting, I think, a little bit of a hammer candle type of pattern here. It was just kind of a neutral harami at the open of the market. Now, longer tail to the downside, it's rallying back up above their open for today, suggesting that there's some sentiment coming back in and pushing it higher. If it can break above the high of yesterday's candle, I look at this as potential reversal off of that mid-channel support right around 250, about 257. If it can do that, it can bounce to 297, which is the top of the channel resistance there. Long-term sentiment, though, falling down to oversold. Intermediate-term sentiment rejected the overbought and falling, maybe casting a shadow on this upward movement.
Okay. All right. So a downtrend establishing from the highs, but at least one that has formed a channel, and we can kind of think about the highs and the lows within it, and is still obeying some of those. Susquehanna upgrades the stock. $345 price target would put us back near the highs, but not at them, but still a pretty bullish note out. And then Morgan Stanley also still has an overweight, but they've brought the price target down to 323. So two analysts who say to buy, but neither say it's going back to the highs, which to me is a little bit of a tough gambit there to thread that needle of a rally, but not back to the highs. So, okay. Thanks, Ben. Appreciate the charts here, Chartmaster. Market meetup panel when we come back. Stocks weak when yields are higher, but as bonds firm now, the NASDAQ is trying to make a push. How far will it go? Can we get a bounce after yesterday's rout? Market is trying to make up its mind. It's been back and forth all morning.
(24/7) access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Yeah, I don't know what just happened, guys. Sorry about that. I just clicked over and realized that the TD Ameritrade TV was just completely frozen. So, I don't even know what happened. I clicked on it again and then it kicked forward. But let's do a quick update here of what we see on the market going on. And we've seen a little bit of a comeback from all these we see on the board, even Tesla down here, making a little bit of comeback from the 620s up to 645 and growing. GameStop making a little bit of a surge here, at least trying to get back to even. Cost is actually doing pretty good. It was a dog before the market and right when it opened, but making a nice little comeback. Express has been very up and down, but overall a good day. Up 9% or so. AMC, we're right breaking even at AMC. So AMC needs to get back up or above 14. Look at this. Look at this resistance at 14 and another resistance at 14. It did this yesterday at 14.4. It was creepy to watch. How it bounced off of it for like 2 hours. So hopefully that's not going to happen again at 14. If it gets above 14, let's get it back up. And then we got to see if it can get back past 14.4. Because look, it did it again in the after hours right here. Right at 14.4. Did not go above. Something weird's happening at 14.4. Anyway, let's see if we can get it there. Hopefully this means an overall turn in the entire market. Let's look at the indexes and see what they are looking at. Yep, NASDAQ is back up, which is fantastic, up 0.5%. The Dow and S&P are both negative, however, slightly trending up. So that's S&P is looking like it's going to trend positive here pretty soon. Dow's actually the one falling behind for the day, but it's on a little bit of an upward trend for the mid-morning right now. We're seeing the Treasury yield slightly go down, so maybe that's why we're seeing the NASDAQ go up here in the past little while. Another great day for Facebook. Facebook's not falling behind. Facebook's up 4% for these guys. Amazon up a little bit, Netflix up a little bit, Peloton way up. Peloton's doing really well. That's fantastic. Peloton up 5.5%. Zoom up 1.5%. Looks like some of the oil stocks are doing a little bit better day. EXPI doing good. Wayfair doing good. Let's see, Palantir doing okay. Airbnb is up. Kodak's up. DoorDash is up. So yeah, a lot of the stocks that I hold and or am watching are doing really well today. BlackBerry and Bed Bath & Beyond are up. So even though the market's not super taking off, a lot of the stocks that I either own or I'm watching are doing really well today. So that's good news. Let's look at my actual portfolio. Yep, it's up. It's up. We're doing good. Up maybe 1.5% right now, I'm thinking. So I will take it. So let's hopefully get that momentum continuing to go. That would be a fantastic way to end the week if we can get things where they need to go. So it looks like we're heading that direction. Let's go back to the
versus growth stocks has been playing out very, obviously very, very concisely. And every day the bonds have been down. We've seen the NASDAQ down. And when we do get a bit of a pause there, it's great. But the other rotation that's happening, some of the sort of the retail-driven names, I think is more of an interesting story, or as interesting the story of stimulus coming out, more money getting pushed into these stocks and people having more to invest overall. It's going to sort of change the fundamental game a little bit, it feels like.
So the fundamental game here has been shifting before our eyes as we look at new leaders holding up in market weakness like we saw yesterday. What was really standout is the banking group, which was the only sector higher yesterday. I mean, we know the rates connection at this point, very well understood by participants in the market, but to see really that it was almost this kind of safety play yesterday. The staples weren't up, utilities weren't up. It was the banks, Kevin. These are the types of things that we have to watch to see if it develops, because if bonds are not going to go up on days where the stock market is down, then you got to figure out what will.
Well, the interesting play on banks today is this news that broke really while you and I were going on the air, Oliver, at around 8 o'clock, 8:05, was this news about, is this going to cost the banks more money? The answer is yes. But is it going to cost them too much money that they may have to liquidate some of their bonds? Now, all the banks are heavy today, so that's weighing down the Dow. That's why you see the Dow underperforming. It's the banks, JP Morgan and Goldman are in the Dow. It's Nike that's also in the Dow and weak today on some issues getting their products through the ports and things like that. So there's weakness in the Dow, but the overall market, the rest of the market is starting to realize that this was kind of something put in to help the banks through the pandemic. And now that we're getting on the other side, they're kind of just easing it back and not renewing it. They're not damaging the banks here. Right. They just not making their life as easy as they made it. That's correct. So you're seeing over the last real hour and a half, Oliver, of us start to work through that process of understanding what this is. I think the market's firming up here.
All right. So I think that that came as a little bit of a surprise. For most of the stuff that I had read, it was indicating that they probably would extend it, but there's a little bit of political pressure kind of mixed in, and for whatever reason, they didn't. So now this is where I think watching the banks and the bond market, I think this is probably, the bond market's more sensitive right now, right? It seems like the banks are, as we just discussed, the winners in this rising rate regime. And for the most part, after all of the stress testing and requirements, it's hard to make the case that these companies are not, very well capitalized to handle a change to the rules back to where they were. To Kevin's point, it's just kind of going back to where we were pre-crisis. But Nick, for the bond market, this is where I think today gets interesting, right? Because we've got another piece of bad news for bonds, as this is construed as kind of being bond bearish for reasons Kev just explained. And so if we were able to firm today, then maybe we can start thinking about things being priced in. What do you think, Nick? I mean, is today going to be a little bit of a test to say, all right, look, we know the economy is warming up, and we know the Fed's not going to extend this thing, and we know their plans for average inflation targeting. What else is there for bonds, right? I mean, maybe if we buy today, it tells us something. What do you think?
I mean, it's a great just open-ended question, right? How high can rates really go? And is it a bond?
That's basically what it is.
Is everybody concerned about the bond market, or is it more about where interest rates are actually going and the real fears of inflation? And I think that's obviously extremely closely coupled and tied, but it's really hard to know. And I think seeing interest rates sort of go from, you look at the TNX, symbol TNX, and where it's come from, we're kind of back at the middle of the range over the last, call it 3 years. Right? So rates were higher than this, but the speed of this move is incredible. And I think that's what we really have to keep an eye on, is sort of the shape of that recovery. And if it becomes sort of this real V-shaped recovery in yields, and they continue to push higher and go past the, kind of the, call it 3 to 5 year historical highs, and that's going to be a little bit concerning, I think, for some of these other sectors. Right now, nice boost for banks. What Kev mentioned is true. But since banks haven't been able to trade, right, interest rates are a huge part of their revenue, and I think that's why you saw them up 3% yesterday, giving back call it half of that today. But overall, I think it's sort of the steepness of this curve and the steepness of the yield recovery that we really have to keep a close eye on. Because if we get there gradually, I think we're fine. If there's real shocks in the market, volatility, is bad for markets in general, right? People don't like uncertainty, and if we see this really steep, trajectory continue, I think you could see some other concerns come in.
Yeah. So that question of how much, real true inflation concerns are driving this thing, where the Fed told us everything the doves wanted to hear, and then now we got this mechanical thing out of our way, because that's, it's this kind of mechanical change to the bond market. So then if we just keep selling, then it seems to say that, look, there's conviction here that inflation is an inevitability and that we should see yields as a trend that goes higher. And if that's a trend that goes higher at the pace it is, well, so far the market's told us then the NASDAQ will probably trend lower with price as bonds do. But the Russell yesterday was a little bit of a scary one, Kev, because that's kind of been our reliable theme within rotation as well. Even if they take it out of tech, well, at least they're putting it into small caps and they're putting it into cyclicals. But that didn't work yesterday as crude got slammed. But we're seeing some relief there this morning. The Russell just turned around and now we're up about 0.5%.
Yeah, interesting side note on some of this stuff that came out today about trading bonds and holding bonds. Not sure that affects the regional banks. That's why you maybe see a very muted response in the Russell to something like this. So, I'm watching all these. You know what I like, Oliver? I'm looking at my screen. I now see Apple just went positive. All the FANG stocks are now positive on the day. Remember, before this market broke yesterday, you had Facebook really strong yesterday midday, and then it sold off hard in the end of the day. What happens? It absorbs this overall market. Facebook's up 4.5% today. So a big day. The FANG stocks are now leading this market higher, as now the NASDAQ's up 0.5%, Oliver. From a trader's perspective, we sometimes look at data, and I see this data. My first instinct was, this is a bad reason to sell off the market. A really bad reason. Just because they're taking those extra measures that they took and just easing them back to the normal measures, you want to sell off the market because of that? I buy that market, Oliver.
Yeah, okay. I think that's pretty interesting. And we want to test to see, if and when either the NASDAQ will break away from bonds, or if, let's just say, there is a correlation, either that breaks away, or then we find dip buyers just in general, right? I mean, the kind of test here is, can we push back towards the levels that we just came from in stocks like Tesla, where we're, a little change today, but yesterday we found some rejection, and a lot of these charts look like they were kind of rejected at important points. When we go into the weekend to see this tone, Nick, where do you think investors should have their minds? Is it on Any reopening news, any virus news out of some of the variants? I mean, it does seem like the weekend has more been about risk to good news than bad lately.
Yeah, that's a great point. You know, I think some of the potential bad news risk. I guess they got to put the risk hat on. You know, there's still such an uneven recovery around the world. Right? We're seeing some pretty depressing news out of Europe, and although they did reapprove the AstraZeneca vaccine, I guess so that they'll restart vaccinations there. But there's a real difference in how the rest of the world outside of the U.S. is vaccinating. So I think there's going to be an uneven recovery there. But I do think that the U.S. equities at least are pricing in a lot less of the open versus closed type trade. But it's become much more inflation based. And I think at some point when these valuations get hit, like Kev said, you have to ask yourself: are the Teslas and the Apples and are these companies going to fare poorly when the economy reopens? And you're like, well, no, right? They're not going to fare poorly, but the valuations maybe were overdone at the top when rates were so low. So I think that's more of the struggle. And I don't expect to get any kind of interest rate news over the weekend. So I would kind of expect maybe futures open Sunday night to be kind of the driver and see where bonds open up and how things look then. There doesn't appear to be a whole ton of other kind of global breaking news out there, although the U.S. and China are meeting up in Alaska to talk about some things. So we could keep an eye there to see how maybe global trade, if mentioned, could give us a little bit of a move one way or the other.
I like that point. I woke up for the first time in a long time to a push headline from a news outlet about U.S. and China that came back into the forefront. So a reminder here that maybe we'll get some more conversation on that this weekend. Kev, what are you guys trading today on Fast Market real quick?
How about this for a lineup? Apple, Amazon, Google Alphabet. Today on Fast Market, a true FANG Plus Friday.
All right, excellent. We don't even need the plus, just FANG there. Thanks, guys. Nick Dieterakis, Kevin Hanks. Fast Market's up next. I'll see you for Market on Close at 2 p.m. Central Time.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good morning and welcome to Fast Market. We made it. It's Friday, March 19th. I'm Alex Cost. Let's take a quick look at where things sit 90 minutes into today's trading session. Right now, we got the S&P's down 3, bouncing a little bit here. The NASDAQ actually in green territory now is up 51 points. The Russell 2000 also green, up 6. And the Dow Jones down 189. Let's welcome in the co-host of Fast Market, Kevin Hinks. Kev, 3,900 on the S&Ps, even with all this volatility and all these rallies and all the kind of back and forth action that we've seen, that's exactly what it's been. It's been back and forth. We're kind of where we've been for what feels like the majority of 2021.
Yeah, you know, this is a really interesting day, and it's a great day for traders because you had some news come out right at 8 o'clock Central Time this morning about that the Fed, there was some rules put in during the pandemic that relaxed some of the capital requirements to hold bonds and other instruments. And all they did, the Fed allowed that to expire and allowed the capital equipment requirements to come up. And that hit the market about 8 o'clock. And, you know, that caused some uncertainty in the market as people tried to figure out what exactly that meant. And that's why we started kind of in the red. But you've also got, and now that is slightly negative for banks as now their capital requirements are higher. But this is the trader in me, and I just talked to Oliver Rennick about this, Alex. The trader in me looked at that news, consumed and digested it, and said, that is a terrible reason to sell off this market. So that was my trading thought going into that news release. Now, everything is kind of recovered. You've still got the Dow down because of some of the financials are heavy today, JP Morgan, Goldman, and then Visa is extremely weak, or Visa and Nike are extremely weak today on Nike's earnings. So those are the really 3 or 4 stocks weighing down the Dow. The NASDAQ is showing incredible strength as now Apple is unchanged. The rest of the FANG stocks are all higher on the day, Alex. So this is the day where we're consuming some data that we had to figure out what exactly it meant. And it's turning out to be not so significant for the overall market, a little significant for the banks. But, you know, these banks, if you listen to JP Morgan, Jamie Dimon's, comments, they are well capitalized. So this shouldn't be seen as a big of an issue as it's being seen as. And so that's the way I traded this morning based on that. That's the way I'm looking at it. Now, the other things, you're still talking about the relationship between yields and stocks. And so it's nice to see the NASDAQ up now over 0.5% as a recovery. The S&P unchanged. It's really the Dow that's the laggard, as the Russell is up 0.4 as well. So we're actually having a pretty solid, healthy day, Alex, despite the news we got right at about 8 o'clock Central Time.
Kevin, there's tons to unpack there in your opening statements. To help us do that, I want to bring in some reinforcements here. The TD Ameritrade Network contributor, Sean Cruz, is joining us. Sean, first thing, it's FANG Friday. FANG Friday is back. We're going to be in focus on these names, likely on many of the Fridays here to come with earnings season now partially or mostly, I would say, in the rear view with Nike already reported. Kevin and I always talk about that being the unofficial end of earnings season, symbolic for us here on Fast Market. But I want to get your thoughts on the SLR, the supplementary leverage ratio that Kevin was talking about. My thoughts on it, and I'm sure you can expand a little bit more why this is important to banks and how it'll affect things going forward. But to me, the big takeaway was that this was a surprise. You wouldn't see a repricing of these instruments like a JP Morgan or some of its banking peers if this was the expectation. So that was my big takeaway. I'm always focused on expectations versus actual outcome. And this on the surface seems to be a pretty big surprise.
Yeah, I think so. And I think it actually really has a lot more gravity for the regional banks as well. It's certainly, you can look at JP Morgan and the banks, it's certainly affecting them as well. But, I think this was something that was put out there also to sort of help out the smaller regional banks who maybe have a little bit more exposure to what's going on with their local areas, and they're not as diversified in terms of all the different products and services they offer. So I think it's certainly something that could impact the regional banks. But I also think more broadly speaking, this was something the Fed was doing, was just to keep liquidity out there in the market, to keep people from stepping back and not offering any sort of loans, bridge loans, whatever it might have been. I think they wanted to make sure that, if nothing else, that during the pandemic, you didn't have the financial system almost lock up, which is something that they experienced in the 2008 financial crisis. So I think it makes sense. You gotta let that roll off sometimes. And I think a lot of people are watching the Fed now to see what they did during the pandemic, especially around this time last year and going into the summer, what they were doing then, and how they sort of pull that punch bowl away, and what sort of fits and tantrums that causes in the market. And certainly this first little opening salvo here seems to have hit the financials and the banks pretty hard. But like Kevin said, I don't think this is something where JP Morgan back down to 120 or anything. I do think it's going to create some volatility, but I would expect this to be something, maybe look at the regionals for maybe a little bit more of a noticeable impact than the major diversifieds, although today that doesn't seem to be the case. But over the long run, that would probably be where I see the most potential for a bigger impact.
It's a great point. We were looking at the heat map there while you were talking. You can see the Russell 2000 quite red on the financials. We can see that obviously the financials is a pretty big sector within the Russell 2000. Kevin, we talk about that quite often. You can also look at the S&P 500 on the heat map as well. And if you do that, you're going to see some pretty big red areas as well. But Kevin, kind of final thoughts on this. We're going to spend a lot of time talking tech today with it being Fang Friday, but I want to get your kind of thoughts on where this kind of decision from the Fed fits within everything we've heard from Jerome Powell this week and what the market's kind of anticipating. Because we've talked about how dovish the Fed has been, even though you see some of those dot plot dots inching higher and inching closer. It's not the majority. And Jerome Powell has, if anything, been as dovish as ever the last few times we've heard from him. To me, this seems a little bit counterintuitive to that language that he's used. Is that a bit surprising? Clearly, the market was kind of taken off guard by this, but is it surprising that he's pulling this punch bowl away, as Sean Cruz described it, while talking a pretty dovish game?
Let's say that we're in a room with Jerome Powell and the members of the Fed, and we're talking about this exact topic. My counterpoint to leaving these easing of restrictions on would be, you just said that we're upgrading GDP from 4.2 to 6.5%. You just said that we're lowering the unemployment rate to 4.5%. If the economy is doing so well, void of inflation, then why do we need these extra measures for the bond market? And I think it's a sign that Jerome Powell is saying that the bond market doesn't need any help. It can stand on its own. And this was just extra softness in terms of capital requirements put in at the beginning of the pandemic that should naturally come off as the pandemic comes off. I think it's a normal, I would have been much more concerned if they felt the need to extend them. I would have asked, why do you need to extend them if the economy is doing so well and you're changing all these, all your data points to more improved? So that's just the way I would look at it. That's the counter stance that I would take on this. I think the economy is healthy. I think Jerome Powell is saying the economy is incrementally getting healthy and the banks don't need this anymore, guys.
Sean, quick thoughts on that as we close that out before we dive into some trade management. Is that how we should interpret it? Or again, is this just different than what they were talking about 2 days ago on Wednesday afternoon?
Yeah, I mean, I know. I think that really is, Kevin makes a great point. I would completely agree. That is, if you're going to tell me that we're going to have 6.5% GDP growth, but you still think the banks need a little bit of a helping hand, those two statements don't really sort of jive with me. I think if you are expecting that sort of robust, not only just economic activity getting up to that level, but also the growth, the incremental growth it's going to take to get to 6.5%, and that's a lot of 6.5% of a multi-trillion-dollar economy, or getting up to that level, getting that amount of growth. That's a lot of activity, a lot of loans, a lot of banking services that are going to need to be provided to get there. I think that makes me think the banks should probably be just fine in that sort of a scenario. So it makes sense that the Fed is maybe pulling that one back, because I think that was, once again, just really given to the Fed when we weren't even sure how far into recession we were going to go. People were still wondering if it was going to turn into some form of a depression versus just maybe a run-of-the-mill sort of single-digit pullback of GDP. I think a lot of uncertainty was out there, and they certainly wanted banks active in lending in the markets during that time. Now that you're expecting 6.5% growth, it makes sense you start pulling back. Some of the more charitable, I guess you could say, programs that they were offering the banks to make sure they were still lending.
I hear you guys, and I don't necessarily disagree. I guess the other side is how much of that expectation is built in there, which it's a high bar. Let's note that as well. So expectations for the growth are very, very high as well. It's going to be tough to hit those, but how much of this is because we have easy monetary policy, we have fiscal support, and so we'll see where things go going forward. We'll have plenty of time to have these conversations as things unfold over the next several months and years here going forward. But let's talk some Nike here, Kevin. We got two earnings trades to look at from yesterday, example trades. Nike, we sold the Iron Condor stocks inside of our short strikes. We went out to next week, so there's a little bit of duration left here, Kevin. And so, therefore, we don't have a pretty big open profit or loss yet. But the stock has, largely, potentially made the move that it was going to make around this event. You take the weekend out going forward. If we hang out around here, this could look okay next week. Thoughts on this one? I think this comes down to it, Kevin. These are the two choices that I would see it as. Feel free to agree or disagree. If you put this on as strictly an earnings trade and your intention was to take it off as an earnings trade, you have kind of a scratch situation to do so. If you wanted to wait and see if time can work out in our favor, we can hold this one too.
Yeah, I mean, Joe Mazzola clearly extended the duration on this trade for exactly that reason. I think based on that, based on the move that is inside the expected move, still safely above our strikes, but still, I mean, a $6 move in Nike's not a small move. So I think this is a bare minimum. With the stock, reacting as it is, I think you hold it at least through the weekend. And remember, what are you doing over the weekend? Once the market closes on Friday, you are collecting theta. If the overall market recovers some today as it's fighting a battle to try to do that, that's probably only positive for Nike. So the news on Nike was kind of mixed, definitely issues with the ports and some of their supplies are holding them back. So I think this is a hold over the weekend at least, Alex.
And Kevin, we always kind of put this test on our positions when we're in that kind of situation where we have to make that decision. We oftentimes ask ourselves, given what's left in this position, would I put this position on here? And with $1.09 based off the midpoint right now, where we could potentially buy this back, a $5 wide spread, I think the answer in that case is, yeah, we would consider selling an Iron Condor for that credit. And so it makes it a lot easier to make that decision to consider holding it. And so that's what we'll do through the weekend. We can address that again next week. FedEx, on the other hand, we did the double calendar. This has been kind of the trade that we found ourselves coming back to quite frequently throughout this earnings cycle. And for the reason that a lot of these names have either underperformed the move or kind of moved right to one of their kind of targeted expected moves, there hasn't been a lot of outperformance. And so with that, this strategy, particularly on an expiration day, does well with a move towards one of our strikes. And in this case, we've gotten that, Kevin, a move towards our 282.5 call calendar with the stock trading just under 280. I know it traded a little bit higher earlier, but With it being expiration day, Kevin, there's still a pretty sizable open profit on this one as it's trading for 329 just on the call calendar side of the equation.
Yeah, I mean, this is, there's a reason why, and traders get comfortable with putting on strategies that seem to work, especially when you have no clear direction on where things are going. Look at this. You would have almost thought, that Nike was going to have good news and FedEx maybe be struggling. No, the exact opposite is the case. So the good news is we were prepared in our strategies for both these moves, and we've got profits to show for it. Alex?
Kev, I went ahead and took off the call calendar side. It's expiration. That's the move we were basically looking for, open profits on the overall position. However, on the put calendar side, Kevin, we're going to leave this. So if things were to kind of accelerate through the end of the day, we closed around this price with our 252.5 puts that were short expiring, this week. We'd anticipate, there's no guarantee, that those would fall off, expire worthless, and our position come next week is essentially just going to be, we're going to be long 3 of the 252.5 out of the money puts. And so we've had it happen before. The probability is not great, but effectively, if there's a massive correction in FedEx, we're effectively long puts. So we could stand to benefit from that,
right.
But we're not necessarily counting on that. There's just not really an incentive to take it off either. We'll just see kind of what happens there. But let's talk some Apple here. It is Fang Friday. We know the importance of the mega cap companies, particularly Apple, not only to investor sentiment, Sean, but really just mathematically to the movement of the NDX and the SPX. And they've been our laggards so far this year, and it showed as the NASDAQ has underperformed some of the other major indices here in the U.S.
Yeah, I mean, I think it makes sense when you look at really what is the primary story that's going on right now. It's interest rates, and I think you could extend that a little bit and say it's interest rate volatility and uncertainty around those around what those rates are going to be doing in the near future. And then you could take that a little further and say people are trying to figure out, are rates going up because of GDP or inflation, or maybe it's some mixture of both. I think when the market's a sense that rates are moving around a lot because of inflation expectations or uncertainty about inflation at the very least, that is really going to be something that can spill over into equity markets, particularly in a lot of these high-flying multiple type names, because an important valuation method that Wall Street uses, interest rates are a key component of that valuation method. And as you start to get those interest rates flying around and those interest rates becoming more uncertain, it actually is going to impact how a lot of people put some sort of an idea around how to value the future cash flows of all these stocks. So I think it makes sense that they've been really moving around here quite a bit, especially going into this Fed meeting. I think a lot of the economic data we're getting lately is really hard to read into because the weather-related effects were so drastic in February. It's sort of putting it into a little bit more of a foggy area of trying to really get a finger on the pulse of what was in that data. So I think we're going to need to, as we move forward, maybe focus on high frequency data, start to get a look at things as we, get out of that weird inclement weather that we were getting in February, but also as we start to get to more and more of a sense of, these relaxed standards, a lot of the restrictions are getting relaxed, more vaccines out there. I think that's where you're going to want to maybe get nothing else, a little more certainty around what's going on with inflation or what the glide path of inflation is going to be. And just by doing that, you should probably expect to see markets maybe settle down a little bit and not be as volatile. But this choppiness and frothiness, I do expect to maintain this sort of behavior, at least for the near future.
Sean, we'll talk a little bit about an example trade. I know you had one for us just to kind of set things up from a stock performance standpoint. I've been looking at the performance since 1/1 of 2020 quite often till the present day because it captures just so much of the major events. We have the sell-off as a result of the beginning of the pandemic. We have the subsequent recovery, and now we have kind of our movement towards potentially a post-COVID economy. And even with this kind of recent interest rate story pulling down the stock, arguably quite substantially from, its peak in the mid 140s, it's still up 60% since the beginning of last year. It's had an extraordinary run. And that builds on some strength that it had for really several years leading into the pandemic as well. So, Sean, talk to us. How do you trade a name that's got some recent volatility, but this is all building up on a name that's performed extremely highly and very, very strongly for investors? You know, it's a dip, but is it that much of a dip in the sense of the overall grand scheme of things?
Yeah, so I mean, this is one of those names where you're right. Is this just a temporary minor dip, or is maybe this is a start of Apple, getting back to some sort of a valuation level that would put the price around 110 or 115? That's always difficult to see. I think one thing is, if you're looking at this though, and you're seeing, look at that 115 level when we were in peak sort of fit mode over interest rates. That 115 level actually looked like an interesting support. You can maybe look at where we're at now, 120. I also saw 126 on the upside is an interesting price level. If you want to maybe put yourself in some sort of an example of, here, I think maybe it's going to turn around and start to glide higher here. You can, instead of maybe going out and selling out of the money puts, maybe the premiums just aren't there, or you've got to get a little bit closer where the risk reward, doesn't really make sense for you. If you're also someone who maybe was just looking at going and buying some calls, where you're just paying up for that premium all up front, and then you're going to experience time decay, the value of those options slowly eroding, every day that ticks off the calendar. You can look at buying an at the money call spread. And there's a few things that a lot of traders say, look, I try to be a seller of premium, or I try to have some sort of a short aspect in terms of my options trades when I'm looking at these things. One example is just buying what is called sort of the at the money call spread. And so what you actually do is you go in the money a little bit, and you buy a call, and then you go about the same distance out of the money and you sell a call. And the key there is, if you see you go in there and you're buying this Apple call, the 120, and you're paying, $2 or $3 for it, that's all up front. You're paying $2 to $3 a premium, and every day that's just going to whittle lower and lower and lower if you don't get that move higher. By going slightly in the money and selling one slightly out of the money, you almost put your break even right where the stock is trading at, or around where the stock's trading at, depending on what you get filled at. And so now it's really more of a dollar for dollar type of a risk reward scenario. And you're also balanced then on your probabilities, because the probabilities are going to be about 50-50. But the thing to think about here is, where does it put your break even? That's going to be the number one key thing to look at. Your break even is usually going to be around where the stock's trading at that moment, versus if you just buy that 120 call, your break even is going to be a couple bucks higher. It's going to be 120 plus whatever premium it is you pay.
And this is a beautiful setup here for us, Sean, in terms of explaining the thought process. But say we went out to next week, and the one that you sent me was the 119, 122, the call vertical, the debit spread. Kevin, we don't often talk about debit verticals as much as credit verticals, to Sean's point. But the way that it's structured in this case, where you're buying an in-the-money option, selling an out-of-the-money option, the point of doing this is, one, you lower the break even. You don't need quite as much of a move to be potentially profitable in this trade. You change the risk reward parameters to essentially 1-to-1, risk one to make one. But even further than that, you really kind of start to chip away at that theta decay component working against you. And depending on the underlying, and many times you can actually get this to a positive number even when you're buying debit spreads, depending on how you set these up. So Kevin, thought it was a beautiful setup here. And it's also a very interesting trade because it allows us to participate in upside in a risk-defined way, in a capital-efficient way, but also in a way that's still strategic, even buying premium.
Yeah, I think it's a nice tribute on Friday to do what Frankie Walsh loves to call the in and out spread, Hinks. It's the in and out spread, which means you buy the in the money call, sell the out of the money call. Now here's the trade-offs that are good and bad. The good trade-off on this spread is that, like Sean said, the break even is basically at or even possibly lower than where you are. So all you need is, if you are aggressively bullish a name, this trade breaks even basically right where you are, right? The bad news is it's a little more capital intensive, as these come with a larger debit, and therefore the risk on the downside, if you're wrong, is slightly larger. But if you are bullish on a name, this kind of a trade, unlike other ones that may take a while, it'll pay you quickly if you're correct, guys.
Well said. And with this case, because it's only a $3 wide spread, risk one and make one. If we're filled at $1.50, right, it's still fairly, again, capital efficient, accessible for many. And so if we're filled at $1.50, that is the risk. The debit spent on this particular trade is the risk. So if we're filled at $1.50, it's $150 in risk. And to find the break even, it's quite easy. You take that debit that we spend wherever we're filled at, and we add that to the 119 call. So in this example, if 150 was the fill price, $120.50 would be the break even, which is about 29 cents higher than where the stock currently sits. Sean Cruz, it's always a pleasure. We appreciate you stopping by here on this Friday. We're going to work three of these. The midpoint's 147. So the lower we spend on this one, the better. But Sean, thanks for stopping by. I look forward to talking to you again soon. Have a great weekend, sir. And potentially we'll see you next week. Kev, we're going to take a short break. When we get back, we got a great conversation to have with you guys. We're going to talk some more mega caps, some more FANG with some Amazon and Alphabet conversation. But we're also going to unpack the Like Folio Fear Index and take a look at what investor sentiment is online versus maybe some of the traditional indicators like the VIX. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Welcome back to Fast Market. I'm Alex Coffey, joined by Kevin Hanks. Kevin, it's FANG Friday, about halfway through the program here, March 19th. It's been a busy week, a lot of market action. The S&Ps right now back in red territory are down 1350. The NASDAQ approaching.
All right, boys, let's get a quick update here of the market, see where we're going with this. All right. So what we have here on the screen, let's look at the stocks that we're following. AMC is just refusing to budge. Right now it's hitting some massive resistance at $14. You'll see it right here. When it first opened, it went up and then immediately came back down to 14. Right there, right there, right there, right there, here. That's crazy. I mean, it's absolutely crazy that you can't eke above 14. I think it did slightly right there, and then maybe right there, right here, but if any, it was just a penny over. So it's not tanking, it's not going down, it's just not going down above 14. So it's doing the same thing it was doing yesterday at 14.4. But other than this dip right there, it has literally been since 9:13 in the morning, and here it is now 10:30, and we're seeing it just hovered right below 14. It's bananas to see that. Express is kind of seeing the same thing. Let me zoom in on Express down here, but it's seeing that resistance at 5.5. It was obviously was above that earlier this morning, and then went down, up, down, and then ever since then it's really been right at it barely squeaked out above right there, but that one hit right at 5.5. That one hit right at 5.5, and right now it's right at 5.5 again. It just cannot get above 5.5's massive resistance. And look how low some of these volumes are. On AMC and Express down here. And some of these volumes are in the, is that 96 or is that 96,000? That must be 96,000. 24, 36. I mean, really not that much trading happening with Express or really any of these AMCs the same. Cost looked like it was making a run and then has fizzled out. It's not. I don't think it's really suffering from the same resistance issues that Express and AMC are, but it's just not performing super well today, down 3%. GameStop thought it was making a run up here after a bad opening, and it's kind of seeing the same resistance at 192. Let's see if we can get above it right now. It's knocking on the door. But geez, like other than this one run right here, it is just pinging off 192 right there. It is crazy to see this happening with these like different stocks, but the volume is so low. Also, look at some of these volumes on GameStop: 18,000, 20,000. That is super low. You know what I think I can do? I need to. There it is. I can see the various individual trades happening with AMC up here. Tesla was making a big run after it opened up poorly, went down to 625 and shot up to 653, and then now it's kind of hovering around there, but still down 1.5% on the day. Come on, AMC, 1393. It's got a lot of buy orders in it. Jeez, it's not going anywhere. What is the deal? See what else I've got in my portfolio that's doing okay. Wayfair is doing well. Redfin doing a little bit better. Peloton doing well. A couple of the oil stocks doing well. GBTC, the Grayscale Bitcoin Trust doing well today as Bitcoin has gone up the last couple of days. FSR doing well, but it's been up and down a lot over the past a couple of weeks. Oh, look at that. I just noticed Express just went above 5.5, and look at that. Little shoot right to 5.6 quickly. Hopefully that means something. I really hope so. Finally got above 5.5. Let's see, DoorDash doing pretty well today, but overall, I mean, I've made a lot of money on DoorDash, but my current holdings are underwater because they dipped a ton. I only own 9 shares of DoorDash right now. I sold a bunch when it peaked at like 225 a few weeks ago, but what I currently own it at 141, and it's at 136 right now. So even though it's having a good day, it's still down. My holdings and then it's down. Bumble's up, Bed Bath & Beyond's up, BlackBerry's up, and that's about it. Apple's down slightly, Amazon's up slightly. So yeah, it's just, to me, it seems like a very low volume, just kind of, to me, this is a take a breath kind of a day. I know a lot of other people think take a breath day is when the markets crash, and I think they're crazy when they feel that way after, a huge charge, but to me, this is when it's low volume and nothing really happening. No volatility, nothing really high, nothing really low, a lot of things sideways. So overall, NASDAQ is up, less than half a percent. Dow is up, or down a little more than half a percent. S&P's just hovering around the line. NYSE composites also right around the line. So, I mean, about the best we're really seeing today is Bitcoin. I see nearly 59,000 again. That's about it. It's about the only exciting thing we're seeing today. So, we'll get back. I might switch back over to CNBC though, just because their coverage gets better during the middle of the day, and these guys just answering about individual stocks.
Does that bother you, or do you actually believe they are still legitimately do you believe crypto is still ironing out very large kinks here?
Absolutely, crypto is still ironing out very large kinks, but you have to look at it in context and look at what you're comparing it to. Yes, we still have kind of the haters of Bank of America coming out and saying that, but if you look at the number of institutions who were skeptics 3 years ago relative to today, that number has declined dramatically. And that's a result of the infrastructure growing in maturity. You were just talking about a second ago Visa and some of the kinks that Visa is still ironing out, whether that's in terms of high fees. Yes, there are high fees in Bitcoin and Ethereum as well. But a lot of that hand wringing, I think, is very misplaced, because if you look at the trajectory of the technology and you look at the problems that it's solving, it actually, even today, stacks up very well relative to the legacy system. I don't know when the last time you tried to do a bank transfer to Zambia was. I tried to do one a couple weeks ago, and let me tell you, I was very tempted to call up my counterparty and ask them if they could just accept Bitcoin instead, because it would have been an easier process.
I'm tempted to ask you why you were transferring funds to Zambia, but I won't. Feel free
for another day.
Yeah,
for
another day, perhaps.
A donation.
I've been surprised. Good. I've been surprised over the past, say, 5 years how little success there's been in blockchain startups, like in the mainstream. And it struck me over the past week that part of what this NFT thing has done is get the mainstream, not just investor, but person on the street, talking about the applicability of blockchain beyond Bitcoin, beyond Ethereum. And that's exactly what Metakoven, who bought this Beeple piece, was going for. It wasn't just because of the value of the piece. It's part of this move by crypto capitalists to expand what we think blockchain can do, right?
That's exactly right. And what's really cool to me is, for the first time, we're seeing people using this technology, whether it's on the artist side who are creating the NFTs, whether it's on the consumer side. People are using this technology without realizing what it is in many cases, without having blockchain even enter the conversation, which is exactly how it should be. For too long, the emphasis on the value of the technology has been wrapped up in the technology itself. People are excited about blockchains for the sake of blockchains. That's not right. People need to be looking at the unique things that blockchain technology is enabling. And, I loved that you had Beeple on the show. I've spent a lot of time talking to musical artists, other artists who are coming in and making use of this technology. And again, just like I was saying about Bitcoin relative to the financial system, artists are flocking to this because they can see the existing system of how they get treated, of how they are intermediated, of how they do not accrue the value that they're creating for the world is broken for them. And they want something different. Now, whether NFTs and blockchains as they exist today are the exact version of the solution that makes the most sense, I'm still a bit skeptical of, even myself. I think there's a lot of evolution still yet to happen there. But artists are saying there's value here that I can't get from the existing system and infrastructure that exists around me today.
So interesting, Jill. And I'd like to ask you to take a look beyond blockchain. There's so many companies in the Slow Ventures portfolio that really touch on the way consumer behavior has changed during the pandemic. And in particular, I want to ask you about Clubhouse, which we've talked about a lot here on Squawk Alley. I'm curious if you see a new rise of a new type of social network, social audio being a new phenomenon, and where you see Clubhouse going from here, especially considering the role it's played in some of these conversations about trading on, say, Robinhood, which is another one of your portfolio companies.
Yeah, absolutely. Well, I was joking the other day that I think Clubhouse has been the most well-timed product launch since Bitcoin. Of course, Bitcoin came about in the midst of the financial crisis, post-2008. Clubhouse came about almost exactly a year ago, right as the pandemic was kicking off. And we're all searching for new ways of connecting with each other, of creating serendipity. And Clubhouse has just played directly into that. And yeah, I mean, if you look at all of these themes that we're talking about, NFTs, Clubhouse, the rise of audio, Robinhood, the rise of retail investing, all three of these things play into the same trends, which is around the amplification, the empowerment of creators. And so whether that's, sort of podcast hosts porting their communities over to Clubhouse, whether that's brands creating their own spaces within Clubhouse, that's going to be a really important use case, I think, of that technology and that platform going forward, is the use of it by, again, companies, brands, and so forth. That's all sort of very much in line with, again, what we're seeing in the NFT space, which is creators looking at new mediums, getting really creative with how they bring their products and themselves to market. And then with Robinhood, it's a different form of creator, a different form of influencer, but the rise of, Wall Street bets, the whole GameStop phenomenon, I see all of three of these topics as very much interconnected. And I think that it's a really exciting sort of evolution or revolution as empowerment gets transferred back to creators and individuals across all of these platforms.
One last thought on Bitcoin, Jill, before we let you go. One of the stats, and it's not the first time these have been made, but this week somebody did say that energy consumption of Bitcoin is equivalent to, say, an American Airlines, which flies 200 million people a year, equivalent to the U.S. government, which employs 2 million people. Do you think ESG is going to wind up being a significant headwind for large-scale investment in Bitcoin?
Look, this topic has been so well covered. I think that the first and foremost thing that I would say is, to me, it's actually really exciting that we're having this conversation, because to me, that's a sign that we're reaching a point of mainstream adoption where people are starting to care about these implications of Bitcoin. Now, if you look at Bitcoin, I know that, CNBC has had Pompon and many other people who've covered this in depth. But if you look at Bitcoin mining, miners are incentivized to find the cheapest, most efficient energy out there. And by and large, that is green energy and renewables. And so Bitcoin miners are taking advantage of that. I'll also say, there's been a lot of worry about NFTs and their impact on environmental implications. And there again, if you look at it, there are blockchains today that reduce by 99% the impact that proof of work-based systems like Ethereum and Bitcoin have. There are options out there today for people who are worried about these things to still be able to engage with this technology, and they should look there as well.
Jill, obviously, as Julia said, so many topics we could cover with you, and we hope you'll come back to do that. Thanks so much.
Absolutely. Thanks for having me on.
Well, a reckoning is in store for a higher education. How deep will it be? Well, our next guest saying 1 in 4 U.S. colleges could soon be out of business. Chegg's CEO joins Squawk Alley next. Stay with us.
This Women's History Month, we're looking at successful female entrepreneurs. Sandra Olin founded KiwiCo back in 2011 when she was running eBay's fashion business. The company started as a subscription box with STEM crafts and projects for kids, but now it offers creative and technological activities for people of all ages. The company is debt-free and profitable.
KiwiCo was born partially out of personal need. My oldest two kids were getting to the age where I wanted them to get hands-on, be creative, and hopefully kind of build their creative confidence. I remember talking to one of our early investors, and the advice that I'd gotten was centered around the notion of leaning in and just kind of keep on. I mean, it's a little bit like Dory, like just keep on swimming. One of the big lessons and takeaways for me has been to focus on the customer, really trying to gather an understanding of what it is that they need, where they're coming from, but then also coming up with solutions that may not be obvious. I was described as driven. So certainly always wanting to get things done and achieve goals that were put in front of me. I was also probably described as being fairly well-rounded, so interested and curious about a lot of different topics. I think that still holds very true.
Welcome back. Our next guest says the pandemic is speeding up the reckoning for higher education, warning in Fortune that 25% of colleges could go out of business, and soon. Joining us now is Chegg CEO Dan Rosenzweig. Dan, good to see you. First, let's set the table. I know, Chegg, your revenue growth has been impressive. Profitability growth has been impressive. Your focus is on high school and college and the end user, not the institution. How has the pandemic changed the end user's tech adoption curve, and how are they going to force change at institutions along the way?
Well, thanks for having me, John and team. And that's actually the perfect question, because change is going to come because the students are going to force it, not because the schools want to do it. As you know, because you've been following startup companies and tech companies forever, that the empire always strikes back. They're going to try to go back to what was, and what was failing. 43% of all college students don't even get a degree, but they graduate with substantial debt. We have $1.7 trillion in debt and 44 million Americans in it. And as you know, there's 3.5 million jobs that can't be filled because we're not educating them on the right categories. So what we did was too expensive, not accessible to the diverse communities that make up America. The college student is getting older. So with that in mind, what we've seen in the tech adoption, to your specific question, is we've surveyed students before the pandemic, in the middle of the pandemic, and actually just a week ago about online learning and what they want. So in the case of online learning, 75% of all students now want hybrid learning, online and in person. They want the ability to take certain classes online, watch them when they want, be able to work. 40% of all students work 30 hours a week or more while they're in school full time. The interesting thing is professors are now up to 44% believe that they can and should teach online, but it's overwhelmingly at business schools and at community colleges. So we still have a lot of work to do with the four-year colleges because they're not experiencing the same problem that other students are experiencing. They're not experiencing housing costs. They're not experiencing the commute time. They're not experiencing having to choose between.
But they're about to, Dan. I mean, isn't that part, because the demographics are shifting. That traditional view of the student who's 19 years old and doesn't have any kids and goes on campus to have an experience and figure out what they want to do with their lives, that's sort of going away, right? I mean, the full pay student is going away. The complexion of the student body is getting more diverse. And the median student, right, is 30 years old or so, female, has a kid. This is not the 19-year-old typical student of the past.
That's absolutely right. So I think you're going to see three things happen. I think you're going to see the very wealthy schools continue to be the very wealthy schools, and they will feign diversity, but essentially they will be educating people who are already born in a way that allows them to be ahead of the curve when it comes to the education between 18 and 22. The rest of America, 70% goes to state schools. Over 10% go to California community colleges alone. Those folks are going to look to move online. They are older. They do have children. They do have jobs. They cannot afford the debt. And so you're going to see many of those people move to online. Two of the largest schools, maybe the two largest schools in the country, not for profit, are online institutions. Southern New Hampshire University and Western Governors, they grew by 30% during the pandemic, while other schools went down. That tells you everything you need to know. And then the third category, which Chegg is very excited about, is the skills category, which is, I think we're going to see a revolution of people saying, is there a faster way to go from learning to earning where I can do it in 6 months, be skilled for the tech-enabled economy?
It looks like a Marvel supervillain. These dark, dark sunglasses. Anyway, check out what's going on at GameStop. Quickly shot 191 and just kind of doing nothing. Had that resistance at 192, which is right there, other than this one point right there. And then finally shot through and shot way up to 210. Interesting shoot up there. Let's see if this little dip right here brings it back down, or if it actually shoots it. There's just a little dip and then it shoots back up. That'd be very, very interesting to see GameStop jump up. I don't see any news. Let me do this real quick. Let me go to the news section. Let me try to GameStop, see if there's nothing else crazy. GameStop earnings likely to this point on weak holiday schedule. Are they posting earnings here soon? Q4 earnings on Tuesday. Ooh, interesting. Likely underwhelmed due to disappointing holiday sales and in fall conversations about the company's stimulus payments. It's interesting. But it almost seems like the news is transcribing the sentiment from Wall Street bets into the news on things like GameStop. That's just crazy. Anyway, so if you're in GameStop, you're either going to have a great day next Tuesday or a terrible day next Tuesday. I have no idea. On a similar note, looks like AMC is finally poked its head above 14, but not by much. Yep, there goes GameStop again. Let's see what we have GameStop. Switching a little closer. Costs doing a similar dance, but not as great as GameStop and Express. Tiny bit more 13.6. Again, it got best hits level, which is 5.5, and it's kind of following something. So we're seeing some movement here on the meme stocks. We're seeing movement here on Tesla too, around the same way, not as dramatic, but it's going up too. So let's go, guys. Let's go.
How seriously do you take it? Is it a pipe dream on the left?
Oh man, look at
And if it were to
GameStop
become
running
like
up.
a legit discussion
210,
in this
211.
country, how would that affect all the dynamics
And
of
for
the
all you
tech?
guys who might have gotten in there at 189, might be on something here. Making a pretty good clip in just an hour. I mean, that's up, what, 20 bucks a share in 20 minutes? Come on, GameStop. I don't have GameStop, but if GameStop makes a run, you're going to see these others make a run. Because again, a lot of people have all of them at the same time. They're in all of them. And so I do have a stake in AMC and Express, and I love especially Express to shoot up because I'm overwhelmed with my cost basis on Express, but I also feel good about it. All right, well, we're just going to sit here and watch it. It's a slow moving train. I wish things would move faster so it'd be more exciting. But we're going to go back to the news. I'll turn the volume up back on this Marvel supervillain, and then we'll just watch these windows down in the corner.
It indexes to people of color or first-time college students, and it's not right and it's not fair. But the system needs to be cheaper, needs to be on demand, needs to utilize online, needs to expand its curriculum to be skills-based as well as knowledge-based, and it needs to have a scalable support system like the one that Chegg offers. That's why we're so popular. It's because we're the only people that can scale with support that answer any question you have when you get stuck. Schools can't do that. They've not made the investment in technology the way they need to.
Yeah. Well, access to opportunity is what it's coming down to, and technology enabling that. Dan Rosenzweig, thank you. And Squawk Alley will be back in just 2 minutes.
Before we go, guys, Facebook is working on a kids version of Instagram, with Instagram CEO Adam Mosseri tweeting, quote, kids are increasingly asking their parents if they can join apps that help them keep up with their friends. A version of Instagram where parents have control, like we did with Messenger Kids, is something we're exploring. Carl, over to you.
All right. Well, we'll keep an eye out for that. They did have some interesting demonstrations of some AI tools as well yesterday, so we'll watch that. Overall, guys, we know it's quad witching, so be prepared for all kinds of changes in the intraday trend. But the S&P has, in fact, gone green. We're up 5.5 points. Dow session low was down about 350. As we saw that pronounced weakness in the banks earlier on, but that also has reversed a bit down now. Really only the worst day since yesterday instead of March 4th. Have a great weekend. Let's get to the judge and the half.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Why one strategist's contrarian call could be the key to the markets and your money. The details and the debate begin right now with the Investment Committee. Joining me for the hour today, Steve Weiss, Amy Raskin's here, the Chief Investment Officer of Chevy Chase Trust. Degas Wright is the Chief Investment Officer of Decatur Capital Management. Pete Najarian along with us today as well. Take you to the wall, show you what stocks and rates are doing. As Carl said, okay, the Dow's down 107. It's off the lows. For a change, it's a reversal because the NASDAQ is the one that's getting a lift today, up by 100 points. Why? Because all the way on the right-hand side of your screen, bonds are up, yields slipping just a smidge. 171 is the 10-year. So, Pete, we're focused today on this call by Tony Dwyer of Canaccord, okay? Most of the banks are down because Tony Dwyer has downgraded the financials and says, quote, the two most contrarian calls in today's market would be to expect the 10-year U.S. Treasury yield to peak near current levels and to expect a correction in the financials driven by the banks. Now, you bought the XLF today, okay? Does that mean you disagree? Yep. Do you disagree with Tony Dwyer?
Well, you know what, Scott? This is a great example of, I think Tony's been unbelievably spot on. He's talked about banks and tanks. He goes all the way back to late last spring, early summer, and he's been right. And a lot of people were fighting against him on that. I think what we're seeing now, though, is the acceleration that we'd seen out of the banks that started really in November. You can't sustain that forever. So I actually do expect some pauses, some pullbacks. And one of the reasons that the XLF was intriguing to me, Scott, they weren't just going into April or March or something with the very, very short-term options. They were buying a little bit of time because of the fact that they're probably expecting a little bit of volatility, some bumps in the road, maybe the pause that we're seeing right now potentially out of the financials would be a reason why they wanted to buy a little bit more time. They were going out to May. They were going out to September. They bought 100,000 of the May 37 calls yesterday. As a matter of fact, they have bought 25,000 of the September 40 calls. So there is some understanding, at least my opinion of how I dissected it is, they're looking out in time and they think that the XLF still has some room to the upside, but it might be in a bit of a pause. And in that case, they've got time and they've got low volatility, low implied volatility while they wait. So those are good things. And so I'm right along with them. I continue to have a very, very large positioning in the financials. I'm not getting out of them. I don't disagree with Tony, but I think it's more of a pause rather than a pretty sharp pullback. We'll see how this all plays out. But for right now, I'm holding on to all my financial positions.
Seems to be influencing the way, Steve Weiss, things are trading today. I want you to listen to what Jim Cramer said this morning about Tony's call and why it's so important to everybody's money.
That was a bold call. I endorse it. Those stocks have moved way up too fast, but that money has to come out of there first before we see tech bottom. I salute him, by the way. I mean, I'm watching all these stocks.
Okay, Weiss, I mean, you take this in two different directions. Number one, do you agree with Tony's call? And Cramer makes an interesting point, right? A lot of money's gone to the banks. You need money to start coming out of some of these cyclical areas like the banks and elsewhere, and it start to going back into tech for tech to have bottomed. Do you agree or disagree?
Well, I disagree. I think that financials can pause, but what happened with the SLR today in terms of not extending it, I think is an indication that the Fed's also ready to remove some of the constraints that they have on the banks and their ability to pay dividends and buy back shares, as well as the loan loss reserves they've taken over the last year or so that will come back into earnings. So yeah, there may be a pause, but like everything else, they're going to trade in lockstep with what we're seeing in rates right now for a bunch of different reasons. So you can take the name off of any chart and put it out there, and it will look no different than the banks, than the cyclicals, than the tech stocks.
No, but
with the exception of maybe a sell-off.
But
here
Steve,
and there.
the point is, if rates are topping out, as Tony suggests,
right,
the banks are going to stop working. It's that simple, right?
Yeah, no,
the money's going to come out of there.
I'm not arguing. I'm saying there. Right, I'm saying there will be a pause, but rates will go up again. So rather than paying taxes on these massive gains that people have had in financials, just be patient. There are other areas of your portfolio where I think you take profits because those stocks are ahead of themselves and won't recover. Does anybody doubt that rates are going to go to 2% and over time possibly 3%?
No, but I mean they don't have to go to 2%. They don't have to go to 2%.
You doubt the economy.
They don't have to go to 2% next week. I mean, they may get to 2% by the end of the year, but there's a long road between now and the end of the year, Amy, right? I mean, let's be clear about what we're talking about here. So if the banks if rates pause and then the banks pause, and then you've got a real window of, I don't know, 8-9 months for these tech stocks to start working again because everybody's all scared about where rates are going. Look at what banks have done in over the last 3 months, okay? It tells us the whole story of the market. Bank of America is up 33%, Citi 23%, Goldman 41%, JP Morgan 28%, Morgan Stanley 29%, Wells Fargo 37%. Why? Because rates have gone up, as Steve said, in lockstep.
I wish you were going to be right, and I wish Tony was right, but I don't think that's the case. I think rates are going to continue to go up. I didn't realize until reading his note this morning that it was been the fastest 10-week rate of change in history. So they're certainly going up faster even than I expected, but I don't think we're going to get an 8-month pause here, or even I think we're going to be above 2 probably in the second quarter. I think we're going to continue this march higher because the fundamentals warrant it. I mean, we have incredible fiscal stimulus. We still have an easy Fed. We heard from Powell on Wednesday. We have vaccination rates that are increasing. The growth is going to be strong. That's going to drive a steepening of the yield curve. I think that's still going to help the financials. At some point, it will reverse and it will stop, but and I don't think we're there yet.
I mean, you have JP Morgan and Goldman Sachs, so you're right in the game here.
Right. We're right in the game. We've been underweight financials for a really long time. At the end of last year, we saw this coming and we went market weight. I still think long term, there's too much capacity in financials. I think some of the new entrants are going to be competitive. On the margin, what the Fed announced today with the SLR is a negative for them. So I don't, I'm not making a huge bet of the portfolio from a long-term stance on financials, but I do think we are in a steepening cycle, largely driven by stimulus. And, we're going to have really strong growth. And there's, 1.7 just doesn't make sense in my opinion, as the place for the 10-year to stop.
I mean, Degas, you've got, according to Bank of America and their fund flows, which we like to follow all the time on this program, record inflows into global financial stocks over the past 4 weeks, right? I mean, the money continues to go there, regardless of calls like Dwyer and whether you think rates are topping out, follow the money. The old adage, the money continues to go into the financials and into the cyclicals.
Yeah, Scott, I'm going to go off of what Amy just was talking about. The money center banks are doing well in this short period, as you said, the last 4 weeks. What we're really seeing is that will the money center banks be disrupted? And we're seeing that happen with PayPal, with Square, and also with the card, like MasterCard, for instance, Visa. We talked about that last time I was on. This is the direction that money is really flowing, and the tide is really becoming more disruptive against these money center banks. This may be a short trade, but we think the longer term play and investment would be into companies like a PayPal, companies like Square, MasterCard. These are the companies that we think the tide is really turning towards as we look at disrupting the money center banks.
All right. Tony Dwyer, by the way, is going to be on Fast Money tonight at 5. Which I'm filling in for Melissa for. So I'm going to talk to Tony at 5 o'clock tonight. So I look forward to that, really drilling down on what his call is. But Weiss, I mean, the bottom line then is you can't buy tech stocks. Because if you think that, you can't buy many tech stocks. If you think that interest rates are going to continue to go up, those stocks are going to continue to be hurt. I mean, it's like binary at this point. Rates up, tech down. Is it just that simple?
I think it has been that simple. I don't think it'll be that simple going forward. The market is going to eventually distinguish between the Zooms and the Teladocs and the uber valued stocks that will never grow into their earnings or their DCF valuations with ones that have had consistent high earnings growth, more than double what the market's had historically and going forward. And that's where the true value is in the market. It's not in the cyclicals, it's not in the financials you mentioned, although I still see value there, because I ascribe to what Amy's view is, that rates are going to continue to rise.
Where's the value there?
So,
what value do you see there?
I think you can buy stocks.
What value do you see there?
I see the semis.
No,
I see
in the banks.
I see stocks.
In the banks. Where's the value still? Yeah, where is it?
Well, you've got a steepening yield curve. You're going to have earnings continue to go up. It doesn't matter. It matters somewhat if the 10-year's at 2%, but if it's a flat yield curve at 2%, then it doesn't matter for the banks. But the curve has been steepening, and that's where they make their money, in the margin.
Steve,
these stocks are up. And that's going to continue.
These stocks are up a ton, right? I mean, Goldman Sachs is up 76% in 6 months. At some point, the banks have moved.
They were down a ton.
Yeah, they were down a ton, but they anticipated a higher move in rates. They've continued to anticipate that. I mean, how much is already in those stocks, Pete? Right? That's what you got to ask yourself. How much is already in? When I tell you those gains, 51% for Bank of America, and JP Morgan's 55, and Morgan Stanley 65.
Well, let's go back to, Scott. Look at how long it was that people said, oh, you don't want to be in the banks. They do nothing, right? I mean, we heard that story for years. So, yeah, they just did not perform. They lagged for a really long period of time. And now they've had their shining moment, right? I mean, we've been watching, and you said in this very short period of time, many of these names are up anywhere from 30 to 50 to 60% or more. It's pretty extraordinary. But I think they're finally getting to the point where they're actually approaching what I would consider to be a little bit closer to what I think is closer to fair value. By the way, as we're going, Tony just hit me up and he said, hey, look, I'll tell you something, and you need to let these guys know. I did not call for a big drawdown. I'm just saying it's a pause. And so I'm just reiterating what Tony just said to me.
Not.
So,
but he's also trying to make a contrarian call here that, you know, if the 10-year has peaked in the near term, you know, maybe those stocks are going to stop going up, which is why he did a relative downgrade. I never said he's calling for a big downdraft. I read specifically from his note.
I know.
Now I'm going to have to get into it with Dwyer at 5 o'clock. Tell Dwyer we're going to get it on at 5 o'clock.
I just wanted to clarify that he wasn't calling for a huge pullback after this huge move to the upside, right? So it is a pause. But, you know, I think when you look at a lot of these names, forever they looked so undervalued. I think they're getting close to what we would all probably consider to be at least closer to a fair value. And that's important. And we talk about that all the time. We talk about, you know, the different ratios of what they're doing and lending and all the rest of that. And I think the banks are really well positioned, Scott. So I think because of that, I think they do have more room to the upside, but I would expect it to pause, just like we'd seen out of technology. I'm going back for a second. You were just talking about technology. I think the quality technology names are the ones that took that big run to the upside, then they paused. I'm talking about Apple. I'm talking about Facebook. I'm talking about Netflix and whatever names that you want to put out there past FANG even. I think a lot of those names are quality names, and when you look at what they are and what they do and the growth perspective, look at Facebook today, for instance. Look at that run that it's on today. This is a stock that has actually been steadily moving up from the mid-200s, and now here we are pushing towards the all-time highs, which was a little bit over 300. So I do think that there's room for those names, Scott, and I don't think it has to rotate from the banks just to get into some of these technology names. But to Steve's point also, oh, go ahead.
I agree with you, right? Let's be clear, Pete. I tried to say this yesterday. Let's make a line here. We're not talking about the FANGs, right? We're talking about the 40 and 50 and 60 and 100 times earnings stocks, right? The high-flying tech ones with the massive valuations that ran way up. And now the move up in rates is causing a reset and an adjustment of those stocks. I put the FANG stocks in their own sort of category.
Okay. All right. Well, I will tell you this, though. When we talk about those no PE or extreme PEs of triple, quadruple digits, whatever, yeah, I think you're right. I think, though, Scott, I think those were pandemic-type names, not necessarily because of the fact that people were running and a lot of new investors coming in and everybody trying to go after all these various high-flying type names, right? And everybody was trying to capitalize on that. I think the problem going forward with many of those types of names, especially the ones that were directly related to what was going on with the pandemic and the shutdown, I think as we open up, and you and I have talked about this a million times, but the hybrid society that we're going to be in. Did you see the latest thing even on a Target where they're giving up 1 million square foot
in downtown Minneapolis.
Their office, downtown Minneapolis. That's because of the fact that these companies are moving with what's going on in the world. And I think that's the hybrid. That's what we're talking about, how things are going to change. And I think those are a lot of names that have those incredible PEs that probably got swept up for all the wrong reasons because of the pandemic, because we knew at some point in time things are going to get better. We still think that, right? I mean, things are going to get better. Yeah. As they get better, a lot of those names that are out there are going to feel the reality of, at some point in time, you've got to find out what you really are and can you make money? Because a lot of these companies cannot make money. They haven't made money. And in some cases, I don't know if they'll ever make money.
Let me ask you this, Amy. Let's move it from financials, because we could substitute, some of these other groups of cyclical stocks. I'm curious as to what my viewers are supposed to do with the Caterpillars, the Deeres, the Boeings, which are up 59, 69, and 58% respectively over the last 6 months. Now, I know the stocks were down a lot, but they've moved up in anticipation of this great new world that Pete says we're going to be living in, and people are going to go nuts in the second half of this year, I think, once you get broad vaccination and so forth. The cruise lines, for example, names like Carnival are up 82%, Norwegian Cruise Lines up 70%. The hotel stocks have run a lot. What do you do, Amy, if you're in some of these names?
Well, I think a lot of those names have gone too far too fast. So we are not in a lot of those quote, quote, reopening plays. You have to remember the stock market is a discounting mechanism. It projects the future. The economy doesn't project the stock market. The stock market itself is a leading indicator. So those moves, I think, reflect what will happen in the economy. And then the question becomes, what's the second derivative change of that? And I think that's where the rubber's going to hit the road, and we're going to have some problems because we're going to be comping a lot of stimulus and just extraordinary growth. So we are not in a lot of those quote, quote, reopening plays. But just to comment on something that Pete was talking about, the high flyers, the really, very expensive PEs and stocks trading at multiples of sales, multiples of 100 times earnings and things like that. I think those were all related to just the discount rate and interest rates falling. Those are all stocks that have a lot of growth. And when you discount that growth back at zero, you can get infinite valuation. So I think it's a little bit different than the pandemic, stay-at-home plays. A lot of those weren't necessarily stay-at-home plays. They were just stocks that people were projecting very strong growth out for a long time and just, getting the benefit of lower rates when they discounted that back.
Degas, what about those names that I just mentioned? Pick your cruise line, pick your hotel, pick your industrial. What should viewers do with those now?
Yeah, so what we would say to our viewers is that let's look at the underlying company. First, let's talk about Southwest Airline. Southwest, majority of their passengers are domestic, approximately 80%. 20% are international. We expect domestic to recover first, so Southwest will do well. Also, what they were able to do with their liquidity is that they had about $11 billion in their cash. So they were able to cover their current debt, which is $200 million. So they're liquid. Lastly, they're able to now continue to do well in this market because they reduced their costs by $600 million, and they expect that to continue in the future. So Southwest is well positioned. Another company that you mentioned, Hilton, a hotel company. We really like the fact that they have a capital light model, business model. They basically have about 70% of their assets are in the third-party management or franchise, they only own about 20 to 30% of their properties. So they're building a fee-based system that's going to give them smooth out the roughness of the cyclical part of hotel. So these are companies that are doing things very well, underlying the opportunity that we're going to see in 20 and 21. So we're looking at those companies and we're going a little bit deeper than just looking at the surface. We're saying, how can this company continue to do well and how did they manage through the 2020? So we will say to our viewers, look at the underlying company and understand the business model and what makes that company different from the rest of the industry.
Well, let's be clear. I mean, you're thinking a lot about the reopen and the reflating of the economy, if you will, because you're all over oil and materials, especially materials. Vulcan Materials is a new buy for you. Nucor is a new buy for you. EOG is a new buy for you. Am I going in the right direction here?
You are going in the right direction, and that's what we're seeing. And the reason why, and all these companies are unique, and we're going to really talk about why they add value here. EOG Resources is an energy company. They obviously do oil, natural gas. What we like about EOG is that they have a lot of growth opportunities. What they did with their senior management, they tied their senior management bonuses to reducing their emissions. How many energy companies do you know that are that's doing that with their management team, tying it to the transition plan? Because we took a deep dive into their corporate social responsibility report and found that that's the type of energy company we want to hold, because we understand that there's going to be a transition period. So we will still need fossil fuel and natural gas. A company like EOG Resources is doing the right thing and tying their incentives to reducing their emission footprint. Vulcan Materials is another example of an aggregate company that produces the gravel for cement and road construction. You know, we talked to some, I have a good friend that's in the construction industry, and what he shared with me about Vulcan is that they're able to really manage the price exposure because this industry is very fragmented. And what we see is that with infrastructure, you're going to need that aggregate material to build roads and to do these the projects. Mm-hmm. Lastly, Nucor is a company, it's a steel company. Now, what makes this unique is that they're using a process that uses scrap steel to generate their product. The other companies use raw iron to produce their steel product, and the using of scrap steel actually produces emissions 1/4 the basic oxygen furnace method. Mm-hmm. So Nucor is a company that's doing the right thing as it relates to the environment, and that's why we said this is a buy. So we're getting ready for the infrastructure push because we're seeing that that's going to be the next thing the administration is really going to focus on, and that could be somewhere in the ballpark of $2 trillion into infrastructure. The American Society of Civil Engineers indicated that the infrastructure gap, is about $2.6 trillion. So if the Biden administration can move forward on infrastructure, that's going to do a lot to close this gap.
Okay. By the way, now Pete's being all nice to me on email, right? You're the best. You rock. Whatever, Tony. 5 o'clock. It's on. It's on big time.
It's on.
All right. Steve Weiss, let's talk about FedEx, okay? FedEx earnings, mm-hmm. right? Stock's just been a monster. You own it. You own a couple of the others too, UPS, XPO, et cetera. What now for viewers who own it?
Well, it's going to keep going. Look, FedEx has restructured their company. They're raising prices. The digitization of the economy is just growing. It's not shrinking. And the stocks are cheaper than they've been historically. So why wouldn't you own it? UPS, same story. XPO Logistics, breaking the company into two. They'll have an extremely valuable logistics company, and then they'll have the freight company. So I think it's a great place to be. Again, very cheap stocks. I'd much rather own those than own energy, which is more than double.
All right, guys. Market's been open for almost 2 hours. Let's see what at AMC is just killing. Am I killing it? I mean, killing me. What the
So
hell?
that's where I'm putting my money in terms of the reopening.
Okay.
Because the
Slightly
airlines,
above
they get
14
free
here,
momentum.
right back down.
As
Just
more and more people fly,
this
as the TSA numbers
insanity
continue to
level of
go up,
resistance
and I
at
know their
14
balance sheets
dollars.
aren't what they
It
were.
blows my mind.
They're not even a shadow of what they were.
GameStop
But they're
shot
going to
up,
trade the
and then
momentum
now
and the
it's just hovering
fundamentals
here
as the
at
market has done,
209-ish.
as the market will continue to
Cost
do.
kind of did the
So that's
same,
where I
shot
want
up,
to
and
be,
it's
and they're
hovering.
not anywhere near
Express
where they were
shot up and then
pre-pandemic,
is
and they
shooting
will get
down.
back to near those levels.
All right. Let's
So
talk,
we're
Andy,
starting to
about
see
Nike.
a lot
Okay.
more
Investors
disparity
are a lot
between
below Nike.
the different
What
charts
we're
rather
watching,
than
okay?
just tracking each
Stock's
other.
down on these supply chain issues. What
Tesla
do you
also,
do now with Nike?
it's
JP
drifting
Morgan's
up.
Matt Boss, by the
Still
way,
down,
he is the #1 rated
but it's drifting.
retail analyst on Wall Street. He raises his price target to
Oh
176
yeah,
from
let's see what
170.
Nike
He
did today.
reiterates his overweight
It's all right,
call
Nike.
on
They
the
had
stock.
earnings yesterday.
Nike finishes
And
this all
they
good?
beat estimates, but
Expensive?
also had a somewhat
Sounds
negative
expensive,
outlook
but
because
it's
of
all good.
supply chain
I would
issues
encourage
and things
everyone to
like
listen to that
that.
call. It was a wonderful call.
So
They're doing
let's see where
everything
they're
right
at.
in
So
terms of
they
their innovation,
dropped,
their digital
three and a
strategy.
half percent today.
I think what's underappreciated about
Nike
Nike
target
is
to
just how much
176. And
margin they can capture if
that's
they
a
can
pretty good number right there. I
continue to
do
increase
still
their
think
direct
Nike's a good
sales,
company
which is what they're doing,
to
and take out that
that I
middleman.
would want to invest in for the right
They
price.
just
They
really, I
had a
mean,
rough
42%
last
growth
3
in
months,
China,
last quarter or
like
so,
a
and
$2
now
billion
the
business.
best the
Just
last 6
really
months.
firing on
Say
all
like
cylinders.
maybe
I think
10%
the
in the last 6
Olympics will
months,
be a
but
benefit for them.
um,
Sports are coming back. Their
last
innovation
year
engine is
they're
as
double.
strong as
So
ever. Their
they
supply
got that
chain,
going for them, but
they
that's
had
obviously going back
problems
to
with the ports, which so
mid
did
March,
everyone
things
else.
were
And
the
their back
worst. But
office
even back
and their high
to the
frequency RFID is
pre-pandemic
better
peak of
than anybody
104,
else's.
they're still up
So we just think there's
32%.
a lot of opportunity for Nike. It
So
looks
yeah, I mean, I think
expensive,
Nike's
but
still
they're
a good
going to
stock. I
continue
mean,
to
over
surprise on the
many
upside with
years, it's
margin.
just
So it's not as
trucked
risky
up
as
in
what it
value.
seems.
Okay. So,
Um,
Pete,
I don't see it being
Lulu
a bad
is
stock.
more expensive than
I mean,
Nike.
it's
You're,
go back
you're a
40 years
fresh
ago
guy,
to
right?
it's gone
Used to
up
be. Probably still,
91,000%.
get in the gym. We don't
So,
get it.
it's maybe it's a good
Why do you
return
like
for
Lulu?
stock
Why do you
now.
like
But no, I
Lulu
think
over
Nike's a good
Nike?
company. And they're still, I
Lulu's
don't
more
see them
expensive, and we've
giving
just
up
said that
their
Nike in its own
market
right is
lead and
expensive.
what they do.
Yeah,
So I think
Nike's very
Nike's going to be
expensive for Nike, and Lulu with
weak
what
show,
they've got in
weaker
terms
than
of
some
history.
expected show.
Actually, it's been coming
Yesterday,
down,
so I think
down,
it's a
down,
good stock.
and the reality is when you look at where they trade as a PE, it's just barely above where Nike's trading. And what I think is
Overall, my
interesting is
portfolio is
when
doing
you
pretty
look at
good
what
today.
Lulu's got, they've got better
Definitely
margins, number
best
one,
day in the
and they've
past
got
few. So
unbelievable DTC. So
yeah,
when
it's
you look at
interesting to
the
see
two
that price target
companies,
to
they
176.
don't
And you
have
get in
to
now
they
at
don't have to sit
139
there and
if
go,
you want
well,
to.
this one's
If you want
great,
something
this
for
one's not.
136, you
But
want
I
to take
think that
advantage of
when
that.
you look at the numbers themselves, they
It's
speak
raised
for
its price
why
target.
Lulu has potential to go a
So
much
yeah,
higher
missed
rate, I
revenue,
think,
but it
than
beat
Nike. I look
earnings
at
per
Nike as
share.
one of those stocks.
Interesting.
Steve was talking about some of the names have just run to the upside, probably for the
Well,
right
got a
reasons.
little bit more
Nike's
movement here in
basically did a great
GameStop.
job. But when you look at margins, Nike's
214.
margins versus the margins that you're looking at when you look
Now,
at a Lulu, for
Jesus, man,
instance,
look at
it is a
AMC. Good
significant
God.
difference. And when
What
you
is
look at
going
some of the other
on?
growth categories, that is a
And it just
significant
makes you
difference.
wonder
So
if
for
there's
that
like
reason, I've been in Lulu
some
for a really long time,
institutional
multiple
something
years.
that has like
I like Nike, but I just think at this point in time, it's
all
gotten very
just a
overvalued. But
massive
that's
amount of
why it's pulling
sells or
back.
Well, I
buys.
mean,
Or
speaking of pulling back,
just
Lulu had a huge
they have
rally
these
around. It's been
transactions,
pulling
some of
back.
these
I mean,
little
it's a
transactions are
loser
like
over the last
13.90,
few months, running nearly
13.99,
18%. All right, we'll take a quick break. Coming up, as well on
and
Ford. Those shares are up 40% this year.
and they're
We'll
just
take a
basically
break
showing
straight
them
ahead. You can
themselves
always watch or
to
listen to us
show that
live on the
there's
go as
nothing
well on the
going on.
CNBC app. We're back in two.
I mean, that's some conspiracy theory stuff. But who knows? It's just, I can't imagine how retail trade is creating this line of 13.99 and never above. Just blows my mind. Look at this. Look at the day chart. From here, really all the way back to here, but definitely from here all the way to there. That is over 2 hours of just hugging the line of 14. Hey, it's 14:03. Hold on. Hold the phone, boys. Let's zoom in a little bit. Not running too far. 14.3. This is the highest it's been since in the last 30 minutes. Well, let's give it a watch because GameStop's also making a run. So let's watch these.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. A federal grand jury has charged 4 members of the far-right Proud Boys with conspiring to impede Congress during the Capitol Hill riot on January 6th. All 4 are leaders of state chapters of the Proud Boys. President Biden has picked a former astronaut and senator to lead NASA. Bill Nelson represented Florida in the Senate and also flew on the space shuttle just days before the Challenger launch accident. Surgeons have performed a double lung transplant on a COVID-19 patient using lungs from a patient who once had the disease. Doctors at Chicago's Northwestern Medicine say that they tested the donor lungs to make sure that they were virus-free. And for the 4th year in a row, Finland is the happiest country in the world. That's according to the UN's World Happiness Report. Now, despite the pandemic, the U.S. actually jumped 4 spots to number 14 and also moved ahead of both Canada and the UK. So, Scott, apparently we're happier this year than we were last year. Who would have thunk it?
And hopefully we'll be even happier in the months to come. Rahel, thank you. Rahel Solomon. All right, Barclays today, upgrading Ford to overweight from equal weight. Street high target, $16. It's our call of the day on Ford. Pete, you own Ford.
Yeah, I do. I own some calls in there, Scott, and I've owned those for a little while. We've had a lot of option paper in here. I love this name. I was in GM, but it's made such an unbelievable run to the upside that I trimmed. I think Steve might still own that one, but I love both these two names. I think they've done the right thing. I think in this case, Ford's partnership that was established not just recently, but in the last few years for sure with Volkswagen, I think that is really going to be something that's going to be a huge boost for Ford in the EV market, in the AI market, all of that. I think the combination of those two working together will really be something that could drive this stock a lot higher than it is right now. Even though it's had great performance, I think there's a lot more room to the upside.
Okay, now brings me to Steve Weiss, who couldn't wait to come on today and talk about his new buy. He's so excited about it. He reminded the producers to tell me during the break. So, Steve, tell America, what is your new buy?
Well, first of all, my excitement dissipated when you beat me up on the financials, but let's put that behind us. Look, my new buy is Porsche. So Pete referenced Ford. I sold Ford. I sold a little early. I think they have governance issues. Just put 2 more family members on the board. So if you want to own a family company that's been mismanaged 50 years, then have at it. In terms of Porsche, though, they are the leader in EV. Forget about your Lordstown and all those others. This is the place to be. They have more EV models than any other company out there. They're investing more in the infrastructure, including battery plants, including charging stations, charging networks. And I'll tell you this, Porsche is the way to play it because they own 31% of Volkswagen. They have a couple other assets in there. But this company is selling at a discount to the other European automakers. It's selling at a discount to the U.S. automakers. Yet the fundamentals much better. And you've got this asset in VW, which is called Porsche. And if they ever spun out Porsche, the company said they wouldn't. Think of this. That would be worth more than the entire company. You've got Ferrari that's trading at 45 times earnings, where sales were down 10% year over year. Porsche, which is about 10% of VW revenues, their revenues were up 14%, Porsche alone, year over year. So what's that worth? It's not worth the 7 times earnings that market is assigning to it. So I think this stock will do incredibly well over the next year, 5 years, and 10 years. Particularly, they've got a leading market position in China. So everything stacks up here. It's new management, the diesel scandals behind it, the other liabilities will be behind it. It's just clear sailing. Great balance sheet for an auto company. I just love this one. It's one of my top positions now, actually.
Well, I mean, the stock is actually absolutely getting a rip as you're talking about it. It's up 11%. It is worth noting, I think I'm correct. I think I heard, didn't the CEO say that the 911 is not going to go EV, right? Isn't that, I think that's noteworthy out of this announcement, right? I mean, let's not, I mean, it's a 911, Steve, right?
Well, they have others that have gone electric.
I know, but it's a
the
911.
Tarkan you can't buy, which is I know, and I had a 911, and
okay,
hey, you know what?
Go.
Electric cars happen to be faster.
Here we go. I had a 911.
You know, what can I tell you? What can I tell you?
Oh my goodness! You can't.
Hey, come on! You got to play, buddy. You can't be all about work. You know?
Apparently so. I mean,
Now,
channel
Pete
checks.
could fit into a 911, he'd have one. Yeah.
All right, stocks ripping like 12%. Thank you, Steve Weiss, for the trade and the fact that you had a 9/11. All right, up next, Pete has his latest trades in unusual activity. Plus, March is Women's History Month. We are spotlighting some of our CNBC contributors. Here's Boston Private Chief Investment Officer Shannon Sakosha on breaking barriers.
We need to see more women in the seats that are meaningful in the corporate world, CFOs, CTOs, CEOs. And we need to no longer accept that as we break through a particular barrier, that we should be happy to be there, just happy to have a seat at the table. We need to keep our foot on the gas so that female leaders that come behind us can start from day one in making an impact.
We're back. Pete Najarian, unusual activity. What do you got for me?
Here's what you got, Scott. So we talk about this, and we didn't talk as much on the A block of TV, but we see energy, we see materials, and they've been absolutely exploding to the upside. I've got one of each right now for this. So Par Pacific, it's a name that I had not seen before, Scott, and it's a refining company. It does a little bit of this and then a little bit of that, but I like what we're seeing in there because we had a really large buyer. Stock was trading around $15, and we had a buyer of 13,000 of the June 17.5 calls. So they're out in time a little bit going out to June and up in terms of where the stock, they're expecting to see this stock go. Traded for about $1.20. They hedged those off against the June 20, selling those. But these June 17.5, that's a very large trade there. So that one stuck out for me. Secondly, I've got a chemical stock, so materials area. Huntsman. Now, we haven't talked about Huntsman in a really long time, I don't think, on the show, but the April 29 call, seeing a lot of activity there. About 3,000 of those were bought, Scott, for about 55 cents. They were also selling downside, so basically financing themselves, and if they actually got the stock actually moved to the downside, they'd be put the stock, and then they'd be owning the stock. So that's telling you just how bullish they are right now on this name going to the upside. I'm in both of these two names. I've got these out to April and Huntsman. I'm also in the other name where I'm all the way out to June.
All right. Thank you, Pete. Good stuff there. Ask Halftime is coming up next. Please send in your questions by video, too, and we'll play it on the air. Email us, askhalftime@cnbc.com. We are back right after this.
Let's go GameStop. And GameStop and costs are trying to make something happen today. Costs up nearly 5. That's a damn good spike right there. GameStop back up nearly 10. It was doing crappy out of the gate. I mean, look at this. Out of the gate, it just tanked. 3 hours. Good. You got it.
All right, time to answer your questions. First up, Steve Weiss from John asked the desk what they think of Petco's report and the future. All right, I'm asking you.
Well, look, I own a couple of dogs, no Porsches, but a dog, and you spend a lot of money on them. And with the pandemic, you can't even adopt a dog because so many people have. So I think that's a great thing. However, this is a retailer. It's taken them a long time to grow into the valuation that they have. So the momentum will be there, but I'm not a buyer of this. There are other retailers that I'd much rather own.
Okay, Pete, for you, it's a video question.
Still want to get it up to about 40, but
Halftime, it's Sal from Sayville, New York. I'm looking to position myself for the future of legalized gambling and also a reopening play on the casinos. I currently own DraftKings, MGM, and Fox, which has the Fox Bet platform, and I'm looking to get a little more exposure with Round Hill Gaming, BETZ. I'm wondering if you guys recommend having that ETF as part of my portfolio moving forward. Best 60 minutes on TV.
Well, I appreciate that, Sal. And the question, of course, Pete, what's the answer for Sal?
Yeah,
cost.
thanks a lot, Sal. Really appreciate that. Everything was great. I would say this: I'm not a huge ETF fan, and my reasoning is I like better beta. I want something to move at a much different pace than what you're generally going to get out of most ETFs. So because of that, I would just increase my exposure in one other casino type play. Maybe it's Penn Gaming, maybe it's Wynn, whatever. But that's the way I would approach it rather than going the ETF route.
Okay, good stuff. Again, thank you very much for the question. All right, Digas, to you. Giuseppe in Italy. Ciao, guys. Love the show. Watch it every day. As travel exposure, how do you see Airbnb, which I own, versus more classic hotel chains like Marriott for the long term? You talked about a hotel chain you owned earlier, but what about Airbnb, Digas?
Both AMC and GameStop have done pretty well.
Yeah, so Airbnb is a disruptor. It went public in 2020, and what we're seeing is a new company. It has nothing to gain from the status quo of the hotel industry, whereas Marriott, was the one she referred to, is a company and an industry that may be being disrupted. So I would say if you're looking at these two, it's a young company, go with
Airbnb. Okay, that's the call there. All right, Amy, lastly to you, Joan in Chicago, any advice on Fiverr? You own it.
Sure. Fiverr's been the gift that just keeps giving. It's been an incredible stock. Even though it's pulled back 30% from its highs, it's still up 14, 15% year to date and up over 800% last year in the last 52 weeks. So it's been a great stock. The freelance market is still very fragmented. Fiverr has the opportunity to be the winner here and consolidate it. It's a $7.7 billion market cap company. So in terms of the opportunity, we think it could grow, but there's no way to justify the valuation right now. And it could get caught up in just this macro rate move, being one of the stocks that I talked about earlier that just benefited from lower discount rates and is going to run into some valuation headwinds as rates go up. So I take a small position if you don't have any and potentially wait for better entry points.
Okay, thank you for that. All right, Pete, let's run it back. Okay, I want to talk about some of these moves you've made. You made a bunch today that we didn't get to yet. You bought calls in.
Sure.
I'll go one by one, all right? Just give me something brief on these here. Emerging markets, EEM, sure. Calls, why?
Yeah, I think that we're seeing a lot more going on around the rest of the world as we're coming out of this pandemic, and I think that would be a smart play. You get a huge exposure to China this way.
You can't lay off Intel, can you, Pete? You're still out there hoping, right, on the underdog. You're still betting on the Jaguars. Hey, they're going to get there one of these days.
They're going to get that quarterback, right? Well, I'll tell you this about Intel. I think what Intel, I still have all the reservations about certain aspects of Intel, but we had some huge call buying in there. And Steve was talking about the semiconductors being a potential opportunity. I also have Taiwan Semiconductor. I added that as well. So both of those two names, I just think can sweep up, especially Intel, can get swept up a little bit with the semis when they start to have a little bit more of a rebound.
Why'd you buy calls in Uber, new ones?
Yeah, and by the way, this is a great example. From the other day, you were saying, hey, Pete, what are you talking about? You don't like these big, high multiple, no multiple stocks. This is a great example of that. But I will trade them, Scott, and we had some huge buying in there. So I just decided that it made sense to play the option side of this thing because those things can work on some momentum up and down, and I think maybe it's an opportunity for the upside. I tell you what, if it breaks through the strike, I will absolutely be out of that very, very rapidly.
What about CCJ, Camco?
Yeah, I got out of this name not for any bad reasons. I love what they're doing. Uranium is a play that not a lot of people talk about. It's had a nice move to the upside. I was out of it, and I was out of it for all of about 24 hours. I bought back in the second I started to see a lot more positive activity, bullish activity coming into that stock as well.
Aflac, Pitney Bowes, the others, International Game Technology. We ripped through them, Pete. Good stuff. We'll take a quick break. We have more trades coming up.
You're the man.
And as we go to break, take a look at some of the top S&P gainers for the week, including Hartford Financial, Discovery, Lennar, and Facebook. It is time now for the Futures Outlook week ahead. Jeff Kilberg keeping a close eye on equity futures. Listen.
Well, Judge, certainly is a lot to unpack for next week, as it is the last full week of trading in the quarter. But let's look what happened this week. Look at the S&P 500 futures as well as the Dow Jones futures. They put in a record high on Monday. Then we saw rates move higher. Yesterday, we did see the 10-year note touch 1.75%, and that really presented a bit of a problem. And I know we're obsessing about the NASDAQ 100 futures, but let's take a big, deep breath. Last month, we certainly have seen the NASDAQ 100 futures drag about 10% to the Dow Jones. But if we look back and rewind a full year, the NASDAQ 100 futures are up about 70%, while the Dow Jones is actually trailing by about 15%, as it's only up 55%. So I think as we go forward into next week, certainly be mindful of a couple data points. We have existing home sales, new home sales, we have durable goods, and of course we're going to be noticing GDP. GDP is certainly a data point that the Fed's looking at, so we'll be looking at it as well. But I'm remaining positive on the equity market, specifically in the futures markets, as we go into the end of the quarter.
All right, thank you very much, Jeff. Final trades are next. All right, it's final trade time. Pete, I'm going to you first. By the way, Dwyer, he's ghosting me now. Totally ghosting me.
I apologize, man. That's on me. I'm going to give you rack space, Scott. I like the cloud services area right now.
Okay, good stuff. Amy?
I can't wait to watch at 5, but I like Illumina this is the stock to own for the next decade.
All right, Degas?
Yeah, Amphenol, solid free cash flow.
Okay. Steve Weiss, 2 things real quick. Tell me something on Vuzix, right? I've got some people asking me on Twitter about that. You still own it?
I still own a lot of it, more than I owned 3 weeks ago. Look, they keep announcing these partnerships. They've got one with Medtronic that are using their glasses. They announced one with Cooper yesterday, the contact lens firm, and their business is just growing 100% a year. Okay. That's what they did last quarter. It's going to keep going. It's the only solution out there for AI glasses.
Monster move. Give me a quick name real quick. I got a buzz.
Jumia, they did an offering. The stock's going to lift after they price it.
Okay. Thanks, everybody. Thanks for watching. Good weekend. The exchanges now.
Thank you, Scott, and don't ghost me. I'm Andrew Sorkin. Here's what's ahead. Speculation, not diversification. That's what Bank of America says about owning Bitcoin. Why? Well, we're going to ask the man behind the call. Plus, more calming words from Fed Chair Powell. Not enough, though, to give investors confidence as rates continue to rise. Is this creating buying opportunities? That's the question we're asking. And in a move that will definitely be met with controversy, Instagram considering a version of its app for users under the age of 13 years old. The details straight ahead, but let's begin with the markets this hour. My good friend Dom Chu has that. Dom.
My good friend, Mr. Sorkin, I do have the markets for you, and we are mixed in trading. And the general color scheme that you're seeing here has generally been the theme throughout the course of the day. It's been underperformance a little bit in the Dow Industrials, financials to the downside, leading that kind of group lower. And the S&P 500 just about 0.25% to the upside. The NASDAQ composite outperforming. Some of those big cap tech names we'll get to in a bit are bouncing just a bit. But at the lows of the day, the Dow was down 357 points. So to put that move in context, we can check that out. Interest rates continue to be a focus. Let's show you a one-week chart of the 10-year U.S. Treasury note yield. It's been a huge focus for traders, not just bond ones, but equity ones as well. 1.717 is the last trade there. At the highs that we saw this week, 1.75 roughly thereabouts was the high for interest rates. We've pulled back a bit. That's lending at least a little bit of a bid to some of those growth names in technology and media that we've seen. And speaking of, NVIDIA, on the chip side of things, up about 1.25%. PayPal, 1.5% gains. Netflix, 1% gain. 1.75% for Uber. So many of these growth-oriented names that rely on an interest rate differential in the markets that lends to their upper valuations are catching a bid today as interest rates pull back. So it's a theme we'll watch throughout the course of the afternoon. Andrew, I'll send things back over to you.
Thank you, sir. Nice to see you midday. Meanwhile, Fed Chair Jay Powell out with an op-ed in the Wall Street Journal today. He's highlighting economic progress, but saying there's still a lot of work to be done. Here's what he said. He said, quote, "The recovery is far from complete, so at the Fed, we will continue to provide the economy with the support that it needs for as long as it takes." His promise of further support, not though calming investors' fears, though as rates continue to rise and the tech sector is, as we've been watching all week, on edge. Let's bring in David Katz, Chief Investment Officer at Matrix Asset Advisors. Also, Guy Labaz here. He is the Chief Fixed Income Strategist at Janney Montgomery Scott. Good afternoon, I should say. I was going to say good morning. Good afternoon to both of you. David, I'm going to start with you. Can Jay Powell control this situation? And is it a problem that he's effectively not saying that he has any ambition to do so?
On a daily basis, the answer is no. On a intermediate term basis, if the Fed keeps rates at zero or near zero, they can provide a lot of liquidity to the market. And we don't think the market should get overly concerned about the Fed's actions. There are other things to worry about, but not the Fed in this case.
Okay, so but before I get to Guy, the rotation we're seeing, you think is not Fed related then?
Well, but the Fed is doing what the Fed is supposed to be doing. The rotation that we're seeing, we think, makes perfect sense. If you look at the last 14 recessions and the aftermath of the last 14 recessions, value has outpaced growth. Last year, you had an enormous overvaluation in a lot of growth in technology stocks. As the world is normalizing, as the economy is opening up, some of those stocks are coming back to earth. We think that makes enormous sense. The S&P is at 21, 22 times earnings. There are a lot of value areas, a lot of sectors in the market that are 14 to 16 times earnings. Money is starting to go to them. We think that is a much more sensible thing, and we don't think it's the Fed's job to try to control the stock market. Their job is to try to help the economy and to try to allow for liquidity so that none of their actions are hurting the overall economy or businesses.
Guy, what do you think about what David just said?
Well, I think today is a really great sort of microcosm to almost pay attention for the broader equity fixed income markets to just how myopically we seem to be on Fed policy. Now, this morning, the Fed made a relatively modest regulatory announcement that's probably going to have very minimal effect, certainly very little effect, if any, outside the banking sector. And yet we have this massive instant market reaction and sort of breathless commentating on the matter in the morning. So when it comes to the long end of the yield curve, to some degree, it's a similar story, right? Most of the drivers of long-term interest rates aren't going to be what the Fed does on a day-to-day basis. It's going to be where inflation moves. And what the Fed is doing is simply allowing it to move higher, in theory, should those pressures eventually emerge, allowing it to move higher than perhaps in prior cycles. Now, I don't think this needs to, without at least unhinged trading on the long end of the curve, which we're very far from. Without that, I don't think it needs to have a negative feedback effect to the equity markets.
David, I got an equity question for you. I think there's a view. I think there's two schools of thought here. There's one school that says, welcome to the Roaring 20s, and here we go. There's another school that says the Roaring 20s just happened. We actually, oddly enough, already lived through it. And come 2022, 23, when the stimulus rolls off and everything else, that we're going to be back in the soup all over again. Which school are you in?
We're down the middle. It's very interesting. If you look at earnings growth over the last 70 years and its effect on stock markets, there's a very low correlation. It's about 1%, which is almost near zero. So we think the most important thing that we want is a better economy, better corporate earnings. And we think in terms of the stock market, if you want to look at stocks on a valuation basis, you did have a very strong stock market in 2020 when the economy was just horrible. So we think that you're going to have a very good economy this year. That doesn't mean you're going to have a very good stock market. We think the overall stock market probably is 8 to 10% over the next year, maybe 2 years. And that can be happening during a improving economy and a lot of expansionary policies.
Just to clarify, 8 to 10% annually or 8 to 10% over the next 2 years?
No, 8 to 10% annually. You know, our best guess for this year is you probably get 8 to 12% when all is said and done. A lot of areas are higher than that. We think that can continue to trickle up, but we do expect volatility this year. And we think the best advice is to not chase what has been working, but rather go where things are going to work in the next 6 to 12 months. So we think some of the areas of the market that have really done poorly, like healthcare, consumer staples, telecom, utilities, are going to be a better place on a go-forward basis. And we would not be jumping in with a lot of new money in technology. If anything, we'd be buying dips in technology, but don't chase the rally days.
Guy, final word to you. Look in your crystal ball for 2 years. You in the same place that David's at or no?
Well, look, I'm pretty optimistic on economic growth here. I think there's a lot of things going for us. Also inflation. There's more forces pushing inflation higher than at any point really since the 1960s. Don't get me wrong. That doesn't mean we're certainly going to have inflation, but there is some upside chance there. That tends to come along with faster degrees of economic growth. There's tons of reasons to be optimistic. And I say that as a bond guy, we're a naturally pretty pessimistic breed.
I like it. I like it. Gentlemen, thank you. Have a great weekend.
Thanks a lot.
Appreciate it.
Thank you.
You too.
And folks, if you're looking to buy consumer names, Goldman Sachs has a list of 13 stocks with 10% upside potential. And you can head to cnbc.com/pro to see some of those names right now. Meantime, the underperformance in the healthcare sector, which we just referenced there, has led to some outsized dividend yields among blue chips in the sector. And Dom Chu is back with some of those names. Dom.
All right, so Andrew, a great conversation that you guys just had about some of the value metrics investors are looking at. One of those value factors is something for dividend yield investors. If you look at the overall underperformance of the S&P 500 healthcare sector versus the S&P over the last year, it's handy. The market has really outperformed about 63% of the upside there. Healthcare has underperformed. It's only up by about 40%, respectable, but still a 20 percentage point gap. One of the factors that investors are looking at right now from a value perspective is dividend yields, because take a look at this. I'm going to show you the last 10 years in terms of dividend yields for the S&P 500 healthcare sector versus the S&P 500 overall. The yellow line is the S&P 500 and the green line is the healthcare sector. As you can see, for the better part of the last decade, the yields on healthcare stocks have been below the overall market. Well, check out just what's happening right here. It's the first time in around 8 years where there's a significant yield premium for healthcare stocks versus the overall market. So that might be something some investors are looking at. And Andrew, these are the stocks within mega cap biotechnology and pharma that have some of the biggest yields in the S&P 500 healthcare sector. We're talking about AbbVie with a 5% yield, Pfizer 4.4%, Merck at 3.5%, Bristol Myers Squibb a little over 3%, and then Amgen at 3% as well. These are the stocks that have been somewhat underperforming the overall market that could be due for a bit of a, at least, rotation into if you see those value factors coming into play, Andrew. So keep an eye on healthcare and some of those big dividend players. That dividend yield differential is something to watch for. Back over to you.
Dom, thank you for that. I should just tell you, I love when you do stock analysis inside the subway station. I think it's just, it's a great look for you. And it warms my heart to know that you're spending time in the New York City subway there.
Yes, every once in a while.
We'll see you in a little bit.
You got it.
Have a great weekend. Coming up when we return, Bank of America says Bitcoin has nothing to do with diversification, volatility, or inflation protection. The only reason to own it? Speculation. Why? We will ask that question straight ahead. And here's a look at the biggest losers this week in the NASDAQ after what's been a very volatile couple of days. Take a look at some of these. You got Tesla, we got Zoom, so many others. The exchange is back right after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. We have talked ourselves into believing a lot of things about Bitcoin and cryptocurrency. We hear things like great place to diversify, inflation hedge. We see big banks now working on access to crypto for individual investors. We have Visa, MasterCard allowing customers to make payments with it. But Bank of America's global research is trying to debunk some of these ideas, saying the only real reason to own Bitcoin is speculation, chasing higher prices. It's higher today, trading above $58,000. Francisco Blanch is here. He's the head of B of A's Global Commodity and Derivatives Research. Joins us now. So the question is, people may own it for speculative purposes, but at what point does the train ride end, if you will, if that's the case, right?
Right. Well, look, I think at the end of the day, Andrew, this is about supply and demand. We know the supply of Bitcoin is capped at 21 million coins. The supply growth rate of Bitcoin is halving every 4 years. So there's less and less Bitcoin coming in. So ultimately, it's exactly what you said, is when does the demand for the cryptocurrency stop growing? And ultimately, that's a question of adoption. So if adoption starts to falter, I think prices are going to come down pretty quickly. But if it grows a lot more, then we have a different problem, which is the energy consumption of crypto, which is one thing our report highlights, is that prices at the end of the day drive energy demand, drive CO2 emissions. And the question is, do we really need to have such a polluting instrument at the time when we're trying to essentially go to net zero emissions in 30 years here?
Okay, but I think the question that we should be asking here is, let's say it's a speculative instrument. And by the way, I think it's almost impossible to say right now that it isn't. But if you believe that it is some form of digital gold, it sounds to me like your view is that the current folks who have money in Bitcoin won't actually hold it when it gets to some kind of steady state that feels a little bit more like gold, because you'll think to yourself, I don't have a 10x opportunity going on in the future, therefore then I sell, therefore it pushes the stock down. I'm asking you, at what price does that happen?
Right. Well, I mean, I think it's impossible to tell, but one thing I'd say about prices in Bitcoin is that, remember, in 2017, 2018, we had a big run up in prices that was led largely by retail investors flowing in. This time around, there's been a lot more institutional investors coming through into the market. And we also know there's a lot of hedge funds in this trade. So I think if the hedge funds somehow smell that there is downside risk, they're all going to try to get out. And the other thing that we observed from Bitcoin in our report is that it's driven by liquidity to the upside. And that's something unusual. Most asset classes, Andrew, when there's more liquidity, prices stabilize. In the case of Bitcoin, there's more liquidity and prices go up. That's kind of a very, very peculiar
what do you think the downside risk is at $58,000? Since I'm struggling to get you to give me an upper end of this, what's your lower end of this?
Well, I mean, the reason I can't do that is because we don't really have price targets in our report. So we haven't really kind of come down to that. But one way to think about downside risk in Bitcoin is the actual cost to produce it. Remember, it takes a lot of electricity, it takes a lot of computer chips, and today we think the cost of production of that Bitcoin, the cost of mining it, so to speak, is right around $20,000 per coin. So that sets in a way some reference to the actual cost. There's no real intrinsic value, but that's one way to think about it.
But if it look, $20,000, if it were get back to 20, that's still actually higher, meaningfully higher than where we were even 6 months ago. So it's interesting because literally a year and a half ago, you could still mint these coins for $7,000, $8,000 a coin.
Right, and of course, costs of production are variable, Andrew, because they are pretty much lined up with the amount of hash power coming into a network. And they are somewhat linked to prices. Today, if you wanted to buy mining equipment, you really wouldn't be able to get your hands on it for probably another year, because there's such a shortage of chips globally, and also the companies that produce this mining equipment don't really have any more capacity to deliver that to you.
I don't want to go too deep into the weeds, but one of the things that's actually to me bullish about Bitcoin relative to the climate issue, and I just wrote about that in the New York Times 2 weeks ago, is this idea of some of these off-chain networks that are being developed, like a Lightspeed and other things that are happening, so that effectively people can transact without being on this very energy reliant blockchain, if you will. Does that not is that technology not a bullish sign for you?
I think it is in terms of potential adoption. And I saw your article in New York Times, great article. I think medium term, and I get this question all the time, aren't we going to go to a fully kind of renewable energy driven blockchain and Bitcoin network? And I say, yeah, it's possible. But look, I'm an energy analyst by training. I've looked at energy for more than 20 years. And I can tell you, when you can't just shift overnight, you can't just snap your fingers and drop all your carbon emissions. It's going to take many, many years. And my particular worry in case of Bitcoin is that if prices rise too fast because we adopt it too fast and we don't let that technological advance kind of play through, we are going to end up with a major environmental problem 12 to 24 months from now, because of the speed at which this is happening.
Right.
But you're right. I mean, medium term, there's solutions that are starting to show and that could help bridge this problem in 5 or 10 years, but not overnight.
Clearly we're seeing retail get involved in Bitcoin in a major way. We're starting to see hedge funds get involved. Some major banks are now allowing clients to get exposure to it. Morgan Stanley recently, but exposure through funds, not directly, which I think is an important distinction. The question I'd ask you is how you think about corporations, pension funds, endowments, and the like, thinking about putting some of this on their balance sheet, and whether you're hearing more of that, or you think that's pausing out after obviously some of the more famed names, including Elon Musk with Tesla doing something like that.
So I've heard more noise about it, but the one thing I'll say is that when I ask the question, why do you want to have Bitcoin in your portfolio? What are you going to pay for, or in terms of your input costs if you get Bitcoin? If you're a corporation, I'm not talking about investors. Investors have a different set of parameters when you make decisions, but corporations, and the answer is always the same. It's like, oh, we will have it in case it goes up. So again, speculation, which I mentioned. And then some people mentioned hacks. If we get hacked, we may want to have some Bitcoin to pay for the hack, which I'm not even sure is necessarily a legal reason to have it, but that's one reason has been argued. So again, speculation, or maybe you're facing a hack. That's the reason all corporations are against us in terms of why they would own Bitcoin. So investors have different priorities. So that's a different conversation.
Francisco, we got to leave it there. It's a longer debate. I'm so glad we had this conversation. I hope we can come on back and we can continue it at some point in the future. But thank you for the report and have a great weekend.
Thank you.
Absolutely. When we come back after this, it is the story that has Wall Street buzzing. Junior bankers at Goldman Sachs raising concerns about hours and conditions. One firm wants to stay ahead of that scrutiny, is trying to do it with Peloton bikes and Apple Watches. We'll tell you about the details of that, and we're going to debate the whole thing after this. You don't want to miss that conversation. And don't forget, you can watch us live anytime. You can do it right now on the CNBC app. The exchange is back after a short break. Welcome back to the exchange. Stocks are mixed with the Dow down 357 at the lows. The S&P has now been hovering around break even. The Nasdaq sitting near the highs of the day right now.
For the love of all that is movie theaters, look at AMC. Like this hugging the line at 14 is getting even more pronounced. This is a full day view here. Look at this. I've never seen anything this ridiculous before. I mean, let me go back and let me go back to the 5-day fall. So yesterday it did something similar right about here at 14. I've never seen this where it is doing this for this long. We're going on 10:42, so nearly 2 hours of just this BS at 14. Look at this crap. Look at this crap. Look at this crap. It's like there's something mandatory in the stock market that won't let it go above 14. That's insane. Absolutely bananas. At least GameStop is having some movement, although GameStop, Cost and Express are all flipping here for the past maybe hour. So that's no good. Anyway, let's see what, man, don't get me started on this Deshaun Watson thing. I can't tell if this is legit or if this is just people talking about, talking crap about him just because a lot of people in Houston just don't like him right now, which I really hope so. I mean, I hate the thought that there might be some people out there making up that stories, but the thing I hate more is the fact that this actually could be real. Deshaun Watson could have done this crap. And, it's one of those things like you hope it's real because you don't want people to be lying about it. You don't want it to be real because you don't want it to have actually happened. So I hate these types of, sexual assault allegations that come out. But I would say 80, 90% of them that happen, once they kind of unravel the story, you find out it's real. Man, I mean, that is bad news for Deshaun, for Texans, because now they no trade Deshaun. And of course, it's terrible for the for victimized legend. Outright sucks. All around just sucks.
Will appear at a House hearing on misinformation, while President Joe Biden will hold his first formal press conference on Thursday. Plus, as supply tightens and mortgage rates climb, we'll get new and existing home sales for the month of February. And with states relaxing COVID restrictions, we'll get a check on how the consumer is faring with personal spending and consumer sentiment. KB Home, Winnebago, Darden Restaurants, and GameStop all reporting earnings. Traders will be closely watching GameStop's results, trying to justify its huge 1,000% gain so far this year. That's your Friday Fast Forward.
Okay, it's the moment you've all been waiting for, because I've been waiting for it. We want to catch up on a few stories that should be on your radar. It is time for my favorite, Rapid Fire. Here with their takes on all of it, John Ford is here, Julia Borston, and CNBC contributor Tim Seymour, CIO of Seymour Asset Management. Good afternoon, everybody. Here we go. We got so much to get through here. We've got our first topic. Facebook reportedly developing a version of Instagram for children under the age of 13. According to BuzzFeed News, an internal company post saying Instagram has identified youth work as a priority, and they're going to be focusing on building a version of Instagram that allows people under the age of 13 to safely use Instagram for the first time. So, meanwhile, Facebook is up 9% since Monday for its best week since January. It's now on pace for its best month since August. I think everybody here is a parent on this rapid fire panel. Julia Borston, I'm going to start with you. You know, I want to get off this stuff myself, let alone have my kids on it.
Well, I feel the same way, Andrew, but here's the thing. Instagram has confirmed they're doing this. Adam Mosseri, CEO of Instagram, tweeted about it. He said that they want to find a safe way to allow all those kids who want to be on Instagram to do it in a way that's legal and safe. So I think what they're seeing here is an opportunity. They probably know that there are a lot of people under the age of 13 that are using their service even though they shouldn't be, and they figure if they could do it in a way that parents can feel good about it, maybe that's a growth opportunity. And the key thing here, Andrew, is then they get access to that youngest demographic before they're harder to hold on to. So they want to make sure they can catch them early in a way that's not totally illegal.
Okay, I get it. John Fort, though, I will tell you, so my son's been on YouTube, for better or worse. He created a video once, and then he started to get, you know, likes and comments. Some of the comments, he didn't like the comments that much. So how would you... Do you think they're going to be able to construct something that feels good?
No, they are not. Andrew, you know that. I mean, same boat. I've got barely 2 kids under 13, a 12-year-old and a 10-year-old. And there is no good version of this, of a platform where you're posting something and then waiting for people to like it or respond to it, right? And you're kind of living, you know, on the edge, waiting for the validation of other people. There are perhaps less harmful versions of it, but what really needs to happen, especially for kids that age, is for their self-esteem, their sense of value to be based in other things other than the opinions of strangers. So the earlier you introduce them to this, I think the worse it is. They need resources to be built up in other ways before they dive into this, you know, cesspool.
Okay, so I'm with John and Julia on this, but Tim, as an investment, this might be fabulous, actually, because, by the way, my kids are going to be desperate to do this. I'm not going to be able to stop them, and then they're going to get hooked even earlier.
Right. So my parent hat's with everyone else here. My investor hat is there's a reason why Facebook trades at a discount, I think, to its growth level and its dominance. Look, and last quarter, their ad growth, everything we know about the core businesses, including Instagram, is what should have the stock trading at more like 30 times. But look, you know, if you put up $14 2022 earnings per share on a 20 multiple. I mean, it's a $280 stock. You know, to me, Facebook trades at a discount for a reason, and it's a lack of trust, not just on the level that we're all talking about, but I think from an investor's perspective, I think with how they value their core business and they're being one step ahead of regulators. So I don't want to own it, and I think the valuation makes sense.
Okay, we're going to pivot to topic number 2. We're talking about the subscriptions to streaming services because globally it's now surpassed 1 billion for the first time ever. And with more people watching from home, box office sales collapsing in 2020, down 72% year over year. How much of a rebound can we expect this year? Julia, you're our Hollywood watcher. How much of a rebound can we expect? And by the way, at some point, if there is a rebound on that end, does that mean that some people are going to cancel some of these streaming services?
Well, don't get ahead of yourself, Andrew. I think there will be a rebound, but the question of how big the rebound is, I think in a lot of ways depends more on the vaccine rollout than anything, because there are going to be so many movies released in theaters, particularly in the second half of the year, that were held back from earlier, whether it was the James Bond movie that was delayed many, many times, or all of these Warner Brothers movies that are going to be available at home, but also in theaters. So yes, there's going to be a ton of amazing content. This is going to be event content, superhero type content that typically gets people into theaters. I think going forward, we will see an increase. Whether it goes back to pre-pandemic levels this year, I think it's going to be too early. But I don't think that's going to cannibalize the subscriptions that people are getting a lot out of at home. And I think that the bar is just going to be higher to get people out of their houses and into theaters when they're going to be able to watch a lot of this content at home right now.
John Ford, what do you say?
I think we're heading for like streaming musical chairs. I mean, there's only so many hours you've got in a day, so many dollars for the most part. Eventually, there's going to be a bit of a downturn. And then, you know, that boomerang subscription or, you know, whatever, like there's something that is going to go away. And I think it's going to be, you know, maybe Netflix, Disney Plus are going to stick around. People are going to think about Hulu, how locked in or into a larger Disney bundle are they? But now's the time to position yourself so you're not that, you know, that first chair to get pulled when the music stops.
Hey, John, technology question for you. When does Apple or somebody else develop an app that they say is consumer friendly so that you can turn on and off these streaming services almost at will by month? Because that to me is when this all changes. And I could see Tim Cook coming out the way he's gone after advertising. He might say, look, what's good for the customer is to be able to turn these things on and off, not to get suckered in to these things and then get stuck with it for 6 months longer than they ever watch it.
Never. These things are roach motels. Like you get in, you can't get out. I mean, the same thing with Apple. Like so many things are easy with Apple, but quitting their services is like the least easy thing.
Tim, which roach motel are you buying right now?
Like I'm long Disney, and I think, you know, their streaming business and the multiple re-rating there. Like if Netflix is trading at 53 times, Disney's now at 40 times. So first of all, to be clear, I think it's had that re-rating, and you can make an argument that maybe, you know, AT&T and the Time Warner and the HBO Max assets are things that still need to revalue. But look, I think the multiples are staying high. I think this is the nature of where we are. Linear TV is dead. I think the traditional distribution system is dead, and I would not be fading those winners from COVID.
Okay, let's go to topic number 3 right now. As more people getting vaccinated, retailers, they are getting ready for a surge in demand. A new survey from NPD Group saying that more than half of U.S. consumers plan to buy apparel in the coming months, making it the top category of anticipated spending, followed by footwear and beauty products. What do you think? I mean, I haven't bought anything, but I do know like signature sleeves are a big deal, right, for women, and people are talking about peacocking.
Why do you know that?
They're going to go out and they're going to peacock with bright colors.
Why do you know about signature sleeves? I don't even know what signature sleeves are.
We just had Dion von Furstenberg on the show on Squawk Box yesterday. Signature sleeves are for Zoom. If you're a woman, you have signature sleeves because that's what pops on the Zoom, and so. This is what's going on in the fashion world, but you don't.
Why
need
just women peacocking?
Strike.
Come on.
Well, you're peacocking all the time, but Julia,
I mean, come on.
What do you say here?
I think that there's going to be this new world where people want to look like they're wearing regular clothes, but they also want to be comfortable. And we're starting to see this in some trends, like with Express. They're having flexible fabric. So people are going to buy things that look like jeans, but maybe they're a little bit more comfortable. The one thing I think is going to have a hard time, yes, people are going to want to get dressed up again, but high heels, man, I used to run around in 3-4 inch heels and not think twice about it. But now I'm going to be thinking about the sneakers and flats I've been wearing. So I wonder where the trends are going to go in the shoe department.
Tim, are you wearing sneakers right now? I kind of think you are.
I'm wearing socks. Sorry, I hate to really give everyone more probably information than they wanted, but they're athletic socks too, so it's an even worse look than you're imagining. I think the beauty trends are the ones to play on too. I think Ulta over Lululemon is the trade based upon the weakness in the stock, and I think beauty continues to be a great segment.
Well, I should tell you, I'm wearing Lululemon ABC men's pants. Ralph Lauren suit on top, pants on the bottom.
Yes, you are.
I'm just telling you. Meantime, finally, on the same day that Goldman Sachs, that survey went viral, junior bankers, of course, back then complaining about a crushing workload. We should debate that too, by the way. Jefferies sending out a memo that says that more than 1,000 of its analysts and associates, not just thanking them for their work, but saying they can now get a gift from the company, including a Peloton bike with a 1-year subscription, a Mirror home workout system, or an Apple package. They're giving out an Apple Watch, an iPad, and AirPod Pros. First of all, before we even get into this gift-giving situation, who is in the crowd of sympathy for this overwork happening on Wall Street, these highly compensated people? Are you sympathetic? Are you unsympathetic?
I'm sympathetic.
That to me is the debate.
Gifts, are these like the little fluttering things that come to the tributes in the Hunger Games? It's like, if you survive, then you get to use this thing. I mean, I know that there's this culture on Wall Street where it's like there's a whole herd of people and then we thin the herd to see who survives. There are probably a lot of really smart people who could do a lot of really great work who don't want to be hazed that way. It probably doesn't serve Wall Street really well. There are better ways, I think, of getting work done.
Tim, it sounds like you have a small violin out. What's going on?
No violin. Look, I was lucky if they bought me a pizza when I worked all night in my early analyst days. So no, I tells me that the bankers are making too much money right now. I realize Wall Street is competing with other industries, certainly tech and startups. But look, paying with a Peloton or other perks may actually be much more cost effective than some of the other just paying them, cutting them checks. But no, I don't feel bad for bankers. Sorry.
Julia, how do you feel? And which one would you take if you had the choice? You have three options.
Well, I think for the health of these bankers, maybe the Peloton would be a good thing if they're sitting there in the same position all day. But I think that these banks are going to be competing increasingly with Silicon Valley companies, with startups for top talent. And I think that burning people out is not the best way to get the best out of them. There's so much data about how important sleep is, how people think better and are much more productive if they can get a little bit of rest. So I think ultimately it's in the best interest of everybody if they can work out a system where 90-hour weeks are not necessary in order to succeed. It's not going to help the banks over the long run if that's how they figure out if your ability to go without sleep is how they figure out if they want to promote you or not.
Julia Borston with the enlightened take on all of it. John Fort, thank you. Tim Seymour, thank you. What fun. I told you guys this was going to be the best segment of the hour, and we just did it. Thank you. Have a wonderful weekend, everybody. When we come back after this, e-commerce has been booming over the past year, and according to the founder of Jet.com, it is here to stay. And Nate Foss is going to be joining me to discuss what that means for retailers and his latest venture next. And it is Women's History Month. We're spotlighting some of our CNBC contributors. Check this out.
Ann Richards, former governor of Texas, used to say in a crowded room that Ginger Rogers did everything Fred Astaire did. She just did it backwards and in high heels. Beyonce, she always says, never let success go to your head, and more importantly, never let the failures go to your heart. And finally, some dime store advice from me: work smarter, not harder. Most important, believe in yourself, because if you believe, you will be believed.
welcome back to the exchange this afternoon. COVID lockdowns accelerated e-commerce adoption in a major way. 2020 seeing over $860 billion in online orders, up 44% from the previous year. But all of these orders have created a figurative and yet literal mess. The sheer volume has now slowed delivery times, and just think of all the cardboard. A startup called Olive is attempting to offer a solution. And joining us right now is Nate Faust. He's the founder of Olive and a former executive of e-commerce supply chain and logistics at Walmart. Nate, it's great to see you. You do have a solution. Explain what you're trying to do here, both with cardboard and with shipping times.
Yeah, absolutely. Thank you for having me on the show today, Andrew. So, probably about a year ago, right at the beginning of the pandemic, I had this epiphany while taking out my own recycling and trash that it's pretty crazy that we're this far into e-commerce and the status quo delivery experience is a cardboard box filled with air bubbles. Nearly 10 billion of them come to us each year. And so at Olive, what we're creating is a solution for both consumers and the environment to eliminate the hassle, eliminate the waste, and also reduce the number of last mile stops of trucks at your homes that drop off all these packages, which are an equivalent part of the environmental impact.
Okay, so I have two questions. Before we even hit the cardboard element, one of the things we all love, and we were, for better or worse, becoming accustomed to, is the idea of 2-day shipping, if not 1-day shipping, if not, give it to me in an hour shipping. That's not great for the environment. Do you think that you're going to be able to change people's habits, or is that not on the cards here?
No, so I think what we've discovered through extensive consumer research, and even before that, I've been part of a lot of those speedy shipping launches over the last decade, and including taking Walmart to 2-day shipping and the next day shipping while I was supporting the supply chain there. And through extensive research, what we've found is that there's other elements of the delivery experience that consumers would actually prefer over speed, but just aren't being offered today. And one of those is the elimination of the packaging waste. And the other, which is an even bigger benefit of the Olive experience when you shop through any of our nearly 100 affiliated retailers, all of your returns, we pick up directly off your doorstep. There's no labels to print, no post office trips. And so it's a convenience play for consumers more than a sustainability play.
Okay, so my next question is, for you, long-term, what the goal is. What's so interesting about what happens in the United States is an Amazon or a Walmart uses a UPS, a FedEx, somebody else, right, to ship everything. You go to South Korea, where Coupang, which is now a publicly traded company, they're end-to-end. And so they're actually, to some degree, doing what you're doing, right? They've gotten rid of the box. They'll come with something that's returnable. They'll take the return from you. Long-term, do you think that an Amazon or a Walmart does an end-to-end product, and do you become part of that?
So I think Korea, that market is a different dynamic. In fact, I actually helped Coupang launch their first e-commerce fulfillment center back in 2013, and they've done incredible things since then. It's a more densely populated country. Eliminating boxes and doing overnight shipping at the same time is a much greater challenge in the U.S. But I do think, as both consumers and environmental regulation around waste becomes a bigger part of the narrative, a solution that has less waste but also has benefits to the consumers is bound to take hold in the long run.
Well, Nate, we very much appreciate you joining us. I'm thrilled to follow your progress and see where this all goes, and I hope that we can continue this conversation in the future.
Likewise. Thanks for having me, Andrew.
Good luck, you bet. When we come back after this, if ending the pandemic wasn't enough to get people to follow COVID safety protocols, some companies are hoping that cold hard cash is. Yet we're going to be talking about companies that are effectively bribing their employees. That's what's happening, and that's what we're going to talk about next. Welcome back to the exchange. Businesses are starting to incentivize employees and customers to get vaccinated, and Elon Moore joins us now with more on that. Elon.
Well, Andrew, for anyone who is on the fence about getting the vaccine, maybe a little cash could change your mind. Companies like Kroger, Petco, and Bridgestone Tires, they're all paying workers bonuses if they roll up their sleeves and get the shot. Well, Love's Travel Stops operates nearly 500 truck stops and service centers across the country. It has 30,000 employees, and the company's offering $75 to those who get vaccinated. Love's president Shane Wharton said roughly 500 people have signed up for the cash so far, but he expects that number to grow fast as more workers become eligible for the shots.
We didn't want any of our employees to have any disincentive to go and get the vaccine, because in some cases they may have to wait in line for a while. So we wanted to make sure that we compensated them and provided incentive for them to do that.
Now, the company's even taking it one step further, holding a vaccination clinic today for the 1,500 employees at its headquarters in Oklahoma City.
I'm actually going to donate mine to a local charity on behalf of Love's. If I can use that $75 to go ahead and protect myself, and then in the end go ahead and help other people with it down the road, then I think all more the better.
Now, Love's will hold another clinic for cash on Tuesday, but what it's doing is still the exception, not the rule. A survey by the Society for Human Resource Management found that 88% of employers have no plans to offer incentives for getting the vaccine. But Andrew, it's worth pointing out that among those who are hesitant about getting the shot, nearly a quarter of them said that free money can make a difference. Back to you.
Well, that's what I was going to ask you, which is what dollar amount do we think makes a difference? If you're hesitant, if you're thinking, I don't want to do this, where's the line? Is it $50? Is it $100? What is it?
Yeah, so this is a fascinating behavioral economics experiment right here. You know, is this a reward for doing something that some say is the right thing to do to end the pandemic, or is this trying to change people's minds? One more wrinkle for this here, you know, the incentive so far between $50 to $100, but one more wrinkle is that if the amount is too high, then companies can actually be seen as doing something that's coercive to their employees and discriminating against those who don't get the vaccine. That could run afoul of the EEOC. So a lot of companies are asking for clarity on how exactly to proceed in offering these incentives.
It's so fascinating. But what happens if a company that's offered money to incentivize people, maybe they get to 60, 70%, but they can't capture that last 30%? Do they start offering more to the last 30% that are the holdouts?
Sort of like the wait list at an airline, right? You get more money if you wait to the end. Unclear. They haven't gotten to that point yet. I did ask the Love's president if he plans on making this mandatory for any employees. So far, they say that it's a personal decision. They're not going to require it, but they're trying to nudge people in what they feel is the right direction.
Love it. Elon, appreciate the stories. Some people call it incentive. Some people call it a bribe, and that's the debate. That does it for the exchange
You're
this
a parent.
afternoon.
You know how it
Power
works.
Lunch is up next after this quick break. Have a great weekend.
All right, let's see what's going on real quick. I got to get on a meeting here in a minute, but let's check out the market especially while they're being quiet on a commercial break. Oh, I'm hoping you guys are all watching the damn magic that's happening over here with AMC. Jesus, what in the hell? Again, will not go over 14. Absolutely not. You cannot tell me something weird's going on there. You cannot tell me that. I haven't looked on Reddit or Twitter or anything to see if there's other people noticing this, but holy crap. It's just mind-blowing. Mind effing blowing. Anyway, onto something that is actually going okay. GameStop's doing okay. It's down from its high, obviously. So is Tesla. So is Cost. So is Express. All of them are up. Well, Tesla's not completely up. The other three are up. So hopefully we'll finish out with a good day here in the last couple of hours of trading. But AMC, Jesus, it opened the day at 14, and it Absolutely insane. I really hope, I need to check Twitter, see if it's like trending, is like what the hell's going on with AMC. Maybe I need to click over to Matt Kors or one of these other guys and see if they're seeing the same crap I am. And listen to him. I mean, he knows a lot more about the technical trading than I do, but holy crap. Absolutely insane. Absolutely insane that we're seeing this happen with AMC. Anyway, I got to get to a meeting. I'll come back in a second. By meeting, I mean bag of chips.
Good afternoon, everybody, and welcome to Power Lunch for a chilly March Friday afternoon. I'm Tyler Matheson. Seema Modi will join us in just a moment. It has been a wild week on Wall Street. Stocks pairing early losses today as the rise in Treasury yields takes a little bit of a breather. Those yields, though, on the 10-year still above 1.7%. Plus, wild week for oil as well. The commodity bouncing back after tanking yesterday. We'll look at the crude reality with RBC's Halima Croft. And later, a fiery exchange between China and U.S. reps last night as tensions remain high. We will tell you the companies that could get caught in the crossfire of Chinese-U.S. relations. Power Lunch starts right now.
Welcome to Power Lunch. 2 hours left in trade, and two big names are weighing on the Dow right now. You look at Visa, down about 5% following reports that the DOJ is investigating it over antitrust concerns surrounding its debit card practices. And Nike falling nearly 4% after blaming supply chain disruption for some inventory issues during the quarter. Plus Tesla, the poster child of momentum stocks, down again today and ending an ugly week, down about 28% from its record high. But it's not all bad news. The NASDAQ heavyweights, take a look at Facebook, up 4% as CEO Mark Zuckerberg says the tech giant will benefit from Apple's privacy changes. And we are monitoring reports that Facebook, Instagram, and WhatsApp are all down. Now, for more on today's action, capping a wild week for Wall Street, Bob, what's catching your eye?
Well, see, but the problem with this week is the narrative is very jumbled. It's a little unclear what the primary issue traders should worry about. Are we worried about yields? Are we worried about COVID resurgence? Are we worried about oil dropping? It's a little unclear. Just want to show you the bank stocks, which are generally weaker on the day here. The Fed is not going to extend a pandemic rule that they had that allowed banks to relax the capital levels. They announced that this morning, and so the bank's going to have to apply more capital against their holdings. That includes treasuries. Some of them may decide to sell treasuries, so a little pressure on yields this morning. Maybe they won't be able to buy back as much stock. At any rate, you see the banks a little bit lower here today. But overall, the narrative this week is individual concerns about rising rates are replacing COVID. And as a result of that, we've seen some pressure on some of the tech names, but not as much as you might think. Overall, we are down a little bit on the major tech names like AMD and Xilinx, a little pressure in the semiconductors, but big cap tech has been okay. Microsoft and Apple only really down a minor amount given all the activity that we've seen this week. What I have noticed rather big moves in is those thematic tech ETFs. Everybody likes to invest in clean energy and solar and video gaming and cloud computing. There's the ARK Innovation Fund, Kathy Wood's fund. They've had significant hits this week and significant selling all throughout the week, but these are very, very overbought, so maybe not that surprising. What else is a big trend or I've noticed is the value stocks have become momentum stocks. So companies that we didn't used to pay a lot of attention to, like Whirlpool or Merck, that wasn't part of the big tech resurgence, obviously at the end of last year, have now been resurgent and are now actually momentum stocks. This is pretty noticeable. I think the question is whether this continues. And the problem, guys, is that this reports of a new lockdown in Europe, in Paris, and other parts of Europe is sort of throwing a monkey wrench into the idea that what we ought to be worried about right now is interest rates. Some people are saying, just wait a minute, COVID has not gone completely away, and I think that was a factor in why oil dropped so dramatically yesterday. Guys, back to you.
Robert, thank you very much. For more on what's next after this wild week on Wall Street, let's bring in Ron Insana, CNBC senior analyst and commentator, senior advisor to Schroders North America, and Michael Farr, also a CNBC contributor and president of and CEO of Farr, Miller and Washington. Gentlemen, welcome back. Ron, you last week were starting to talk about what you see as a major change in the, let's say, the context or the backdrop of investing, and that is how both Fed policy and fiscal policy are now favoring Main Street over Wall Street. Explain what you mean and what the consequence is.
I'll handle the first part first because it's easier. But yeah, I do think, Tyler, that investors going forward are going to have to deal with what I think are profound changes, both in fiscal policy, which we began to refer to last week as a move away from a 40-year trend of trickle-down economics to bottoms-up budgeting that addresses the needs of Main Street over Wall Street. I think the Fed's policy decision and the Q&A session that Jay Powell engaged in this week, when they delivered their decision on interest rates, it was equally profound insofar as the Fed has now suggested it will not act preemptively, which has been the case for the last 40 years since Paul Volcker, to cut off incipient inflation. They want to see the data, not a forecast. So that is a wildly different position that both the Federal Reserve is in now and the fiscal policymakers are in. And I think if we start to see something like a modification of the filibuster or an end to it, policy will get increasingly more progressive from the fiscal side, more aggressive from the Federal Reserve side, and that's something that I think the markets will have to contend with. It's going to create different types of winners and losers. I think that part still is to be determined, but I think that Wall Street needs to really start thinking about what I think is a very important sea change, both in fiscal and Federal Reserve policy.
So money directly in the hands of individuals at the consumer level, as opposed to tax cuts that trickle down allegedly through the system. And number two, less concern about anticipating inflation, more concern about actually seeing it. I'll come back to you and ask what kind of stock groups might benefit on either side. But let me turn to Michael for your reaction to that. I know, Michael, that you believe that right now, in the face of a wobbly market here over recent days and weeks perhaps, you say going to cash is foolhardy.
Oh, I certainly think it's foolhardy, but I always think that market timing, Tyler, is foolhardy. You know, I think that markets that were already feeling uncertain got kind of a wobbly and uncertain message from Chairman Powell this week. He said, you know, okay, the economy's growing, we expect inflation, and we're not going to do anything about it at the Fed. We intend to let it run hot, and don't you worry, Wall Street, everything's going to be okay. I mean, we're used to hearing a plan from the Federal Reserve Chairman saying, if things get dire, we're going to be there. We've got a plan to go forward with here. We're not hearing that. We're hearing we've got to wait and see, and we're going to see what happens here. We've had $900 billion in stimulus at the end of the year, another $2.8 trillion in stimulus in a single quarter coming into this market. I don't know how you sit in cash when you see this much stimulus in a recovery, the vaccines, the everything else. Share prices are going up. Can the Fed actually keep on top of this, or will they stay at the party too long? And will they kind of lose control of things? I think that's the fear on Wall Street right now. We're also at that end of the quarter time where there's not a lot of news and people kind of get a little iffy before you also get to April 15th, now I guess May 15th. But it's an iffy time of the year. We still need earnings headlines. We'll get them in April.
Maybe we'll just take off next week here at CNBC. I'm for that. Michael, before I go back to Ron, let me ask you this. Interest rates at 1.7, 1.72, that's on the 10-year. Longer rates. You know, the Fed has the ability to control the low end of the curve, not as much the high end. What is the market telling the Fed, if anything, here?
I think that the market's telling the Fed that they'd like some more clearly defined parameters, and I think the Fed's saying we don't have them. And it's a very uncomfortable message on both sides. If you look as an old Wall Street guy at what the 10-year is doing, basically you're seeing the yields edge higher, and when they rally back lower, they don't go quite as low as they've been before. So it still seems that the trend for the yield on the 10-year is higher. It's establishing, it looks like, a new sort of high or a bottom in prices, but we'll feel better once that sort of looks like it's going to set in. Stock price is doing the same thing as the tech shares are selling off, and the value shares that Bob Pisani was talking about, now becoming momentum stocks, are really starting to get a bid and a broadening of this market rally.
Ron, the 10-year yield now up 30 basis points over the last 3 weeks, and that certainly prompted a discussion around the outperformance in financials. JP Morgan, Goldman Sachs trading in record high territory. But then earlier today, Canaccord Genuity saying it's now time to sell some of those stocks, and perhaps that these banks can't continue to move higher here. Where do you stand on these names right now?
Well, obviously, you know, as the yield curve steepened, they benefit from the net interest margin that goes up on their loans, and that's why they've been rallying for the last several weeks, if not a little bit longer. And then there were the regulatory issues that the Fed discussed this morning that put a lid on those stocks. I think, you know, and something we haven't discussed yet is at what level of long-term interest rates, if the Fed is not worried about inflation but is more worried about employment, do they decide to impose yield curve controls and try to bring the long end down if it's at 2%? It's something that Steve Leisman asked Jay Powell on Wednesday. If we were to see something like that, you'd have to sell bank stocks because then it'd be capping long-term yields and there'd be no regulatory relief. So I'm waiting to get more clarity around that. I think the recovery trade is still on because we've got pedal to the metal both at the Fed and in fiscal policy. So I wouldn't necessarily walk away from that investment thesis, but I'd start to look very, very carefully and comb through comments from the Fed going forward and take a very close look at every piece of legislation that's heading through Congress, because as we get closer to the passage of an infrastructure bill later in the year, possibly including tax hikes, I do think, again, at the margins, it favors Main Street over Wall Street. And again, banks are going to be subject to two separate items, which will be the level of interest rates and regulatory risk.
Final quick question and answer, please, Michael. As Seema asked her question there a moment ago, I saw you bemusedly shaking your head. Why?
Oh, come on. Banks are well positioned for this rise in rates, a steepening of the yield curve. Asset prices are getting better. I mean, I think the banks are in the catbird seat for the next 12 months. I'd be very careful to trade out of them too quickly.
All right, Michael, thank you very much. Have a great weekend. Ron and Sana, same to you, my friend. Seema.
Tyler, the great reopening may be underway. The tri-state area taking its biggest steps yet. Increased restaurant capacity, return of sporting events, indoor fitness, and more. Consumers seeming to help fuel that revival. Restaurants seeing a big rebound in sales and traffic. Hotel occupancy at a 20-week high. And the TSA screening 1.4 million people on Thursday. Hyatt's Senior Vice President Asad Ahmed tells me that demand for events and weddings are on the rise.
Look at demand for events and weddings. We are really thrilled with the way that 2021 has kind of kicked off. Our lead activity into the system has been really strong almost since the new year. And if we look kind of even over the last 6 to 8 weeks, almost a week-on-week increase in interest and activity has been building. And we're really delighted that close to 60% of that demand is for 2021. Of course, people are looking beyond 21 as well.
Now, these group bookings are a big driver of profits, and Marriott and Hilton says they too are seeing an uptick in group events for later this year. The reopening trade, as you know, has been on fire. Tyler, we've been watching the hotels, the airlines, the restaurants post strong gains in 2021. And the question is, as we watched Europe re-enter lockdown, especially countries like Germany and France, whether this can continue.
You know, we have in our family, Seema, a wedding coming up later this year. Much less anxiety now about whether it's going to be able to come off. In fact, you're all invited, by the way. Just come on out. But I wonder about corporate events, big trade shows, big conclaves and convocations. Are those coming back, or is it the 250, the 150-person family event?
Yeah, that's a great question, because corporations, hotels, they really rely on those corporations to book conferences. That's a big driver of profits. Right now, they're starting to see demand for conferences and corporate events for the fourth quarter of this year and into 2022. But some companies are also using a hybrid model, Tyler, where some people will attend in person and others will attend from home. They'll sort of use technology where if you're at home, you can still feel like you're there by using a 360 sort of view. That way you don't feel like you're being left out. They're also partnering with Grubhub and Seamless so that those who aren't there in person can still get that advantage of having that free food. So you're starting to see some level of activity.
That's great. Seema, all right, thanks very much. Coming up, the U.S. and China exchanging in a war of words at their first meeting under President Biden. We're going to dig into the China threat for Wall Street. Tensions are running high. Plus, energy, the best performing sector today, but the worst performing sector this week as oil slides. Is there more pain ahead? We've got that one covered and much more for you after this quick break.
In the first bilateral meeting between China and the Biden administration, things got off to a, let's say, frosty start. Secretary of State Anthony Blinken and National Security Advisor Jake Sullivan meeting in Anchorage with their Chinese counterparts. The meeting that was originally scheduled as a 4-minute photo op turned into a 1-hour-long testy exchange between the two countries. The meeting also affecting the broader markets. Tesla is taking a hit as the Chinese government instructs officials to not use its electric vehicles over privacy concerns. And other U.S. companies with large China exposure have been under pressure, like Wynn Casinos and chip manufacturers like AMD and Qualcomm. For more on the state of U.S.-China relations and what it means for Wall Street, I'm joined by Ian Bremmer, president of Eurasia Group and G0 Media, and Liz Economy, senior fellow at the Hoover Institution and senior fellow for Chinese Studies at the Council on Foreign Relations. It's great to have you both on. Liz, I'll start with you. We were hoping that with a new president, the expectation was that this U.S.-China relationship would be a reset. We would see the political temperature come down. But given the fiery exchange we saw last night between both sides, it seems like we're headed for a more challenged relationship. What do you think?
Well, I don't know whether the relationship will be more challenging. I think that the Biden administration has reduced some of the inflammatory rhetoric, but I agree with you that the temperature remains high. And I think that's because at the core, right? We have very different visions for the future of the world, and we approach the international system from a very different set of values. And I think that's what the Biden administration wanted to do. They wanted to get out there and basically lay out how it was planning to approach the relationship with China, and more broadly, how it saw that relationship within the context of overall U.S. foreign policy.
Ian, the topic of trade and tariffs, that's where Wall Street wanted to see progress. But given the acrimonious start to talks between U.S. and Chinese officials, your thoughts on the likelihood of tariffs being removed for U.S. companies that import products from China?
Well, the Chinese didn't walk out of the meeting. They're still engaging with the Americans on the issues that we're both concerned about, and trade is obviously one of them. And over time, there's going to be potential for progress. But I want to be clear. The Biden administration was quite surprised with what the Chinese did during this meeting. They didn't expect it. They're in the middle of a policy review right now. This policy review will now be made much more challenging by those in the administration that were hoping to argue for greater interdependence and for calming down tensions, not only because of those inside the Biden administration that have a more national security perspective on it, but also because of the blowback that Biden will get from Republicans who are looking to paint him as being weak and the Chinese as, rolling over Blinken et al. I think it's going to be tough. And I think that there was a reset here. The reset came from China. The fact that the Chinese saw that the Americans were increasing sanctions against Chinese officials literally in the days before this meeting occurred. They met with the Quad at the head of state level before they had this working level meeting with the Chinese. The Chinese came in and said, yeah, we may have said we're going to do 2 minutes. We're completely throwing out protocol because we're showing you that we intend to be treated as equals. And as Liz just said, the Americans find China's worldview and their political and economic system in many ways deeply unacceptable. So it's hard to get a meeting of the minds on this stuff.
Liz, at the same time, the Chinese technology companies, Alibaba, Baidu, they're facing increasing pressure, not from the U.S., but their own government, Beijing. How do you see that story playing out? Because that certainly hurt their stock prices.
Right. I mean, I think it's difficult for them because they're at the, confronting a double-barrel gun at this point. You're right. On the Chinese side, look, the Chinese have their own concerns about these technology companies. First, that they're operating, outside the bounds of what, China feels, the government feels comfortable in terms of regulation. They're concerned about the information that these companies hold and aren't willing to share with the Chinese government. They're certainly concerned when it comes to companies like TikTok, for example, ByteDance and TikTok, that these videos and other things in terms of the information and ideas that are being spread, that somehow those are going to move outside of China's, very strong constraints, ideological constraints. And of course, there's just that issue of you have the Jack Ma and the Robin Lee and the Pony Ma. And, these guys are international superstars. And there can only be one international superstar in China, and that's Xi Jinping. So I think they're facing a number of challenges emanating from their own government.
Ian, I see a couple of differences between the Biden administration and the Trump administration. One may be rhetorical. One may be that the Trump administration paid more attention to trade and trade imbalances, and the Biden administration maybe more attention to human rights. But a key difference here to me is that the Biden administration seems much more focused on taking a multilateral approach that brings alliances in with the United States, where President Trump was much more inclined to go it alone. Do you see it that way, and which one portends better outcomes?
You're right that the key difference is not on policy. I mean, even on issues of trade and human rights, ultimately where the Biden administration want to get, the Trump administration want to get, not all that different. But the multilateral approach of the Biden administration to just meet very consistently and try to build coalitions on the Asia side with the Quad, on the transatlantic side with the EU3, the UK, Germany, and France, that's absolutely a very different orientation than the Trump administration, which was much more transactional and unilateralist in approach. The interesting thing is that the Biden approach is going to work very well in Asia, where most countries share America's concerns about what happens when China gets massive and they start imposing their rules and their preferences on these countries. Where in Europe, our most important allies historically, the transatlantic relationship, they do not see China as the principal national security threat at all. And if we are moving towards more decoupling and containment, the Germans and the French are not down for that. The UK might be, and they're clearly the most aligned of the European countries with the United States, the major European countries, but they're not a part of the EU anymore. So it's going to be very interesting to see how this plays out under the Biden administration.
And Elizabeth, the talks continue this weekend. Just quickly, what are you expecting?
I don't think we're going to end up with any kind of major accommodation. I think there might be an effort to take a step back from the really testy, fiery exchange that took place last night and kind of say, we've expressed our opinions. There's not going to be a joint statement coming out of this. They've already indicated that. Maybe there will be a statement to the effect that, we agree that there's room for future cooperation on climate change and pandemics and other things like that as a way of softening the blow. But fundamentally, this is going to be a very competitive and confrontational relationship moving forward. I do want to say I think there's more opportunity for cooperation with Europe than I think Ian indicated. We're going to have a political transition. We're going to have NATO engaged deeply. All of these countries are beginning to become more engaged in the security element against China. So I think things are brewing in Europe that may shift the dynamic a little bit.
We like it when our guests don't always agree. Liz Economy and Ian Bremmer, thank you for joining us today. Appreciate it. Ty.
Great conversation. Up next, FedEx is higher. After a big earnings beat, we will highlight that and more in today's Power Movers. Plus, Bitcoin's dirty little secret. Is crypto mining killing the earth? Wall Street warning about the growing environmental concerns as Bitcoin soars again today, up 916, 58,000. We'll explain the risks when Power Lunch returns. Welcome back, everybody. Bitcoin higher today, sitting just below the 60,000 mark. But Wall Street is warning about cryptocurrency's environmental impact. Kate Rooney now with the details. Hi, Kate. All right, let's step away from Kate and get the audio figured out there. We're going to explore the environmental impact, the power usage that is taken up by Bitcoin and mining for it. We're going to take a quick break. We'll be right back. I am ready. Kate Rooney is ready. Let's go back to Kate on Bitcoin. Hi, Kate.
It seems like I was on mute, Tyler. That happens on Zoom all the time, but we're back. Bitcoin is seeing a lot more pushback on its carbon footprint, and that's causing a dilemma for some fund managers. On the one hand, crypto has seen a lot of price upside, but they also need to weigh demand for some more environmentally friendly investments. To create new Bitcoin, it takes an energy-intensive process called mining. So you can't do this on a laptop. It's done through high-powered computers. An estimated 65% of global mining is coming from China, and about a third comes from the coal-burning region of Xinjiang. That's an area in northern China. Analysts tell me that the energy it takes to mine Bitcoin has gone up with demand this year. And according to estimates from Digiconomist, Bitcoin's CO2 footprint is now bigger than entire countries. That includes Chile, Austria, and Bangladesh. Bill Gates is among those warning about the impact. Bank of America warned about it this week in a note to clients. And one analyst from BCA predicts that the energy issue could cause Bitcoin to, quote, lose most of its value over time. Institutional investors have been cited as a key driver of Bitcoin's 100% rally this year. Any drop-off in that demand could weigh on prices. The crypto industry, though, argues that a lot of this Bitcoin mining uses excess energy. Jack Dorsey is among those who have predicted that Bitcoin will eventually be powered completely by clean energy. Tyler.
So, Kate, let me ask you the question that hangs in the air about this. What about investing in companies that buy Bitcoin and hold them on their balance sheet, like Dorsey Square, MicroStrategy, Tesla? Could Bitcoin investments then make it such that those funds that have ESG sort of goals can't go there?
That's right. It certainly muddies the water. Analysts that I've been talking to this week say companies that are otherwise pure play ESG investments, so if you think of Tesla, clean energy there, Square scores very high on diversity and ESG, their Bitcoin exposure might make fund managers think twice. But there's also no legal distinction, so it is very subjective. It's up to the fund managers, but it certainly complicates it. In that Bank of America note out this week, they also mentioned that it's not just environmental. They talk about some of the negatives that regulators have also worried about, including money laundering and other illicit activity.
All right, Kate Rooney, thank you very much. Meantime, let's get over to Rahel Solomon for a COVID update. Rahel.
Hi, Tyler. Hello, everyone. I am Rahel Solomon, and here's your CNBC COVID update at this hour. The White House expects the FDA to announce its decision on AstraZeneca's vaccine in the coming weeks. This as the administration defends the decision to ship doses of that vaccine to neighboring countries. Biden's coronavirus czar says that the action will not impact vaccine availability in the U.S. Bosnian hospitals and morgues are struggling to keep up with the most recent spike in infections and deaths. Morgues there are storing coffins in rows on their floors until they can be buried. Many in the nation's capital are comparing the scenes to the Bosnian War when Sarajevo was under siege. Idaho state lawmakers will not meet again until April 6th. That's after 5 members tested positive for COVID-19. The recess comes amid concerns that a highly contagious variant could be behind the outbreak. And House Minority Leader Kevin McCarthy says that he tested positive for COVID-19 antibodies in December. He believes that he contracted an asymptomatic case a couple months prior. Now, despite having the antibodies, Republican leader says that he actually never tested positive for the virus and is now fully vaccinated. Siba, I'll send it back to you.
Rahel, thank you. And to the oil market we turn, where the energy market is closing for the day. Dom Chu at the CNBC Commodity Desk. Hi, Dom.
Bouncing back, Seema. That's what we're seeing. Green across the screen so far. WTI U.S.-based crude prices up 2.5%, $61.46. World ICE Brent crude futures $64.57, 2% upside there. Gasoline also bouncing back, and energy stocks up about 0.5%, one of the bigger gainers so far today. If you look at the crude picture overall, over the course of the past year, it's been a huge move to the upside. You can see there WTI crude, remember, negative prices at one point during the pandemic. We've just seen a little bit of a pullback here, still a very winning trade so far, coming off very low bases, by the way. And then take a look at some of the moves in other parts of that complex, specifically the energy stocks. This particular energy ETF over the last week has lost a lot with the slide in crude prices, seeing a bit of a bounce today. And of course, those individual names, Tyler, that have been hit the hardest in the 5-day streak of selling that we've seen so far. Occidental Petroleum, Diamondback Energy, Hess, and Marathon Oil, each up 6%, 4%, 2.5% overall. Those bouncing back big for sure. Tyler, I'll send things back over to you.
All right. Thank you very much, Dom. Despite the sell-off this week, our next guest has a positive outlook for oil, believes the sector was overdue for a correction. Joining us now is our friend Halima Croft, RBC Capital Markets Global Head of Commodity Strategy and a CNBC contributor. Halima, welcome. Good to see you. You know, one would think with the reopening of the economy here in the United States, if not in more places around the world, eventually in 2021, that the demand side of the equation is looking firmer. What about the supply side and the Saudis being able to maintain their role and their control over OPEC and supply?
Well, Tyler, that's a great question. And really, I think it was the Saudis and their unilateral production cut in January that really gave this market a lot of momentum. And I think even with the concerns that we've seen about demand, with the lockdown restrictions in Europe, vaccine hesitancy, issues about potential softening in China with refinery maintenance, I think the key thing to keep in mind is Saudi Arabia seems committed right now to continuing to play the role of the central banker for oil. I think they're going to be very cautious about bringing back their extra 1 million barrels that's off the market. And the Saudi oil minister, His Royal Highness Prince Abdulaziz, keeps saying, he's going to be very, very cautious about bringing barrels back on the market. He remains concerned about vaccine hesitancy. He's not wanting to make any real sudden moves in this market. So I think we can expect the Saudis to continue to play that role in terms of keeping supply restrained.
It was just a year ago, I don't know if it was a year ago today or a year ago, a couple of days ago, or maybe next week, where oil went negative. It's now in the 60s. What do you see as the price band for oil between now and year end?
I mean, we are constructive on the oil market, particularly for the back half of the year. We're looking at, the recovery, particularly in the U.S., as more drivers get on the road, where we see the uptake of vaccines going well in the United States. Do we see a situation where, WTI can be in the 70s in the back half of the year? Absolutely. I mean, we think it's going to average around $66 in the back half of the year, but we certainly see, room for WTI and Brent to be in the 70s in the back half of the year. We will be watching very carefully, what happens though with OPEC. I think a really interesting question is really what is the price band the White House is looking for right now in terms of the oil market? Because traditionally, particularly under President Trump, we would see calls made to OPEC when prices were to go into the 70s. The interesting question is, will they be making those calls now?
Yeah, and the former president has been critical of the idea that gas prices, as demand comes back, are going to be up pushing $4 this summer. Do you have a view on what the Biden White House might do? What kind of jawboning they might bring to the table?
Yeah, I just don't think that we're going to see President Biden using the power of diplomacy to really manage the oil market. He's really focused on accelerating the energy transition. I certainly think a call would be made to the Saudis if oil prices were seen as threatening global growth, or if the oil price was moving in such a direction that potentially was giving the Iranians more financial bandwidth to withstand sanctions. So I think those are the kind of calculations that would be made in terms of when the call would be made. I think, though, that call may not be coming at $75. I think the Biden White House may making that call, 85 to 100. So I do think that OPEC has more room to run when it comes to potential pressure from Washington to cap the upside.
Halima, always great to see you. Thank you for your answers today. Halima Croft, we appreciate it. Seema.
Let's go over to the bond market, Ty. Rick Santelli standing by as we look at yields retreating. Rick.
Yes, it's been a wild week. It's been a wild 6 weeks. Look at a two-day of 10s and 30s. What's notable, they couldn't quite get over yesterday's high yields, but if they close in territory where the yields are a bit higher than yesterday as they are now, both maturities will be up on the day and on the week. Look at what's going on a year-to-date of 10s and 30s. What you want to watch is February. Now, if we go to year-to-date of Boons, you notice how Boons didn't take out their end of February minus 23 high yield close? That's key level to watch. Year-to-date of 10s and Boons, the spread of 201 basis points, 14-month wide. And finally, the dollar index overcame the Fed and closing up on the week. Seema, back to you.
Dollar at 91.93. Rick, thank you. Up next, solar stocks flying too close to the sun. The stocks had a huge run up following the election, but down big over the past month. Our traders will discuss next. Welcome back to Power Lunch. Solar stocks rebounding today, but tracking for a losing week. The TAN solar ETF down nearly 10% since Monday after its more than 280% rally over the past 12 months. The group cooling this week after Californian utilities proposed a change to a rooftop solar program that would charge customers a monthly fee. So is this hot group set for a deeper decline? Your Trading Nation team today is Craig Johnson of Piper Sandler, Danielle Shea of Simpler Trading. Danielle, we know this administration has made clean energy a big priority, but given the moves taken by certain states like California, is it time to lock in some of the gains here?
I think it all depends on your time frame. In the short-term time frame right here, the charts have shifted and they're definitely in a downwards pattern. With TAN in particular, you know, I can see it falling as low as about 70. But on a long-term basis, I love this area. I think in the next 5 to 10 years, this is an area that's going to continue to grow. And so for long-term investors who are looking for an entry place, I think it's a great spot to start looking.
Craig, you're tracking the charts. Is there a certain name here that really stands out to you? Strong balance sheet, and from a valuation perspective, also looks attractive.
Yeah, so I'm going to agree with Danielle on some of these things, but Seema, I got to step back and look at the big picture on this. Only 3 times going back over the last 30 years have I seen the 26-week price momentum in some of our work get as high as it is right now. And once we've seen those sort of high levels, it's rolled over. And the group has corrected for typically around 3 years before you find your next sustainable entry point. So from my perspective, Seema, I come back and I look at that TAN ETF from Invesco. We've broken the uptrend support line. We're trying to come back and find support at the 200-day moving average, which will get you to around 74, 75. So still meaningful downside from here. But where this group really, in this ETF really took off from was in the low 40s. So from my perspective, I'd be selling this relief rally at this point in time, not trying to buy it yet. It's too early.
All right, that's the solar ETF. Craig and Danielle, thank you for joining me today. And for more Trading Nation, head to our website. Tyler.
All right, Seema, up next, the NFL finalizing a new 10-year media rights deal with Amazon. We'll talk to the CEO of online sports network Overtime about what this could mean for the industry. Plus, as we head to break, the Dow remains negative, but check out tech stocks. Those are moving higher along with the NASDAQ. Look at Facebook up more than 4%. Power Lunch will be right back.
And now, the latest from TradingNation.CNBC.com and a word from our sponsor.
Every trader should accept that losses are part of the process. So in an effort to reduce your risk and define your max loss, consider using stop or trailing stop orders. This approach can help eliminate emotion from your decision-making and set you on the path to consistent trading. I'm Joanna Payne, and Schwab is the better place for traders.
Welcome back. Amazon scoring a touchdown with the NFL. The NFL finalizing a new 11-year media rights deal with all of its existing partners late yesterday. And Amazon Prime Video will be the exclusive partner for its Thursday night football package. It's the first time a streaming service will carry a full package of games exclusively. And according to sources, Amazon is paying about $1 billion per year. The Amazon deal runs for 10 years and will begin in 2023.
And Seema, that deal raising questions about the full future of sports viewing as college basketball's billion-dollar tournament gets underway. Our next guest runs a digital sports media company called Overtime that produces original content across Twitter, YouTube, Snapchat, and TikTok. Overtime has some well-known backers, such as NBA stars Kevin Durant and Carmelo Anthony, as well as top VC firms, including Andreessen Horowitz and Graycroft Ventures. Dan Porter is the CEO and co-founder of Overtime. Ms. Porter, welcome. Good to have you with us. What do you broadcast or what do you stream? What kinds of events?
So Overtime is what I call the leading sports network for the next generation of sports fans. A lot of times when I run into people and they say, "What is Overtime? Have you heard of it?" I say, take out your phone and text your kids and ask them if they know what it is. And if they're 16, 18, 21, they always do. We have 50 million followers across all platforms. We really kind of cut our teeth in high school basketball. Our specialty was kind of going into things that people thought were smaller markets than they were, and really programming explicitly for digital. But we're in basketball, we're in football, we're in video games. We're kind of in all the places where 75 million Gen Z love to watch and care about sports.
And you can carry your programming with you in the palm of your hand, as you would suggest. Are you advertising supported, subscription supported, or both?
So we're a mixture between e-commerce revenue. We really built a very strong community. People feel very passionately about Overtime. And so e-commerce is a huge driver for us, including all kinds of Overtime apparel. And then we work directly with brands, because I think there are a lot of brands that want to reach the next generation of sports fans that used to find them on television, don't find them on television anymore, and so they come to work with us.
A big deal in your space, as we just discussed with Amazon and NFL. Dan, I want to get your thoughts on this deal and whether you think more streaming giants will be able to get access to live sports.
Yeah, I think it's super interesting for three reasons. One is, I don't know, what does this mean for the end of the kind of multi-cable bundle? I think that change is incremental, but it's in process. The second thing is that Amazon is a very interesting player because they don't make their money from streaming, right? They have massive other businesses. And when you look at all of the other media rights businesses that bid for this, they tend to be generating revenue almost explicitly from streaming. And I think the third thing is that Amazon knows a lot about me, right? They know a lot about their customers. They know that I buy dog food. I may never have to watch a sports game and see a cat food commercial again. And I'd say as an asterisk, I think if you look at what Jeff Bezos did with the Washington Post and the pace of innovation that he pushed there, I think professional sports is an amazing thing. I often say when talking about Overtime, it looks the same as when I watched it in the 70s and 80s as when I was a kid as it does now. And I think there's a lot of excitement in the space around innovation in both broadcast and calling the games and in every aspect of the game that I think is ultimately going to push the future of live sports forward at a rapid clip.
Have you had conversations with other streaming giants about your platform and the great usership that you have?
Well, you know, we've just launched this brand new league, OTE, Overtime Elite, which we call like a new sports league for the most talented young basketball players in the world. And I believe part of the reason that we've done that is because there's a huge need in the market. They're not being satisfied in the way that they're getting trained and being prepared for a pro career, but also because, yes, I want to be in the media rights business. I mean, it's a tremendous business. There is a shortage of live sporting events that have mass audience appeal, and it's become critical tentpole whether you're streaming or a live television, broadcast network. And so that's absolutely a direction that we're heading.
The G League that the NBA sponsors is obviously already a threat to college basketball on the opening weekend of its biggest event. Will your league similarly be a threat to college basketball?
Here's what I would say. If you participate in our league and you're 16 or 17, we will pay you. People often say, well, are these kids giving up their eligibility? And I say, why is it about the young athletes in our league? Actually, it's the NCAA that's taking away their eligibility. And so I would love for them to play in our league and prepare for a pro career and be able to also play in the NCAA and in the tournament. But because we pay them for their work, there's some type of barrier there. So is it a threat? It's only a threat if the NCAA continues to expect athletes to be unpaid while generating billions of dollars of revenue. If we rectify that, then I don't think it's a threat. And I think we're going to be able to prepare athletes both for the NBA and the NCAA eventually as well.
Dan Porter, when we finish this, I'm going upstairs. I got two 15-year-old boys watching the NCAA. I'm going to ask them about about overtime. So
tell them I
they
said
better
shout
know,
out.
Dan.
Tell them I said shout out.
Nice to see you. Thank you for being with us. All right, good. Seema.
All right, stick around. We are going to get a final check on this market straight after this short break.
All right, let's take a look at how we're going to finish the market week here, Seema. The industrials are off by about 1/3%. It was worse earlier after the Fed moved early this morning to take some sort of technical moves regarding the banks. That sort of took the wind out of the sales of stocks. But back they came, as you see there, except for the Dow, off just modestly.
And the bond market has been a big driver of the equity market. Tyler, yields off the highs of the week, but just the speed at which the 10-year yield has moved. We started this year at 0.9%, Tyler, now at just around 1.7%. So that will, of course, be a big focus for this market, Ty.
Have a great weekend, Seema. Great to be with you. We'll see you all next week. Thanks for watching Power Lunch. Sarah and Wilf are right along with Closing Bell.
Tyler and Seema, thank you both very much. Happy Friday. Welcome to Closing Bell. I'm Sarah Eisen along with Wilfred Frost. Dow's down 100 points. NASDAQ is up 1%. It's a flip. of where we've been lately. Let's look at what's driving the action. Another leg higher in yields, putting a chill on sentiment. Although tech today is in the driver's seat, Facebook, chip stocks rallying. Cyclicals are lower for a change. We're also seeing momentum names rebound, Peloton, Zoom, Airbnb, all moving higher. And a push and pull in vaccine headlines. Acceleration in the U.S., but lockdowns abroad. Major indices set to end the week lower. NASDAQ outperforming, though. 59 minutes left. Small caps are the biggest losers so far on the week, Wilfred, down 3%.
Dow is down a little bit. The rest is higher as we stand. Ahead on today's show, Richmond Fed President Thomas Barkin joins us for an exclusive interview following this week's Fed decision and news today surrounding the future of a pandemic-era bank rule. That interview coming up in just a few moments. And later, will stimulus checks lead to another surge in retail trading? We'll ask the CEO of Robinhood competitor Webull. But let's start with the market, of course, capping off a crazy week once again in trading. S&P's up 0.3% today, down 0.4 for the week, Mike.
Yeah, well, if it remains a market of kind of offsetting currents, maybe swirling currents out there, it's really kind of push-pull between certain parts of the market based on what yields are doing and then benefiting others. It's netting out to not much of a move on a week-to-date basis, down a little bit less than 1% on the S&P 500, but it is a couple percent off all-time highs. Internally, there's been a little more of a correction in the growthy areas. We've stayed above pretty much last month's highs and also have not really done any damage to this immediate trend. A lot of folks were looking at levels just below 3,900 on the S&P, 3,870, let's say, which might have changed the story just a little bit in terms of whether this market has broken stride or not. One thing that is maybe giving a little more of a frictional feel to this rotation, take a look at just some real bellwethers of the mega cap tech or growth trade and, of course, the financials and cyclicals trade. You see this inverse action we've seen recently, especially in the last month or so with Apple and JP Morgan Chase. Now, this rotation looks very seamless, right? Apple sells off, JP Morgan goes higher, but that was JP Morgan when Apple was at its highs at 140. When Apple goes down here and JP Morgan is in the mid 150s, it's just a little bit of a different lift to actually get those value sectors working. It's really just a kind of a small binary trade to illustrate why this rotation maybe has gotten a little bit stretched or the energy has come out of it just a little bit in the short term. Take a look too at what has happened. We are right now at the best 12-month performance for the S&P 500 since at least the 1930s. We're pushing an 80% gain from the March 2020 lows. We hit the anniversary of that, of course, next week. These lines right here are the previous times when the 12-month return for the S&P was above 50%. And so actually, this is 1980. That's a typo. So this one is 1983. Here is the late 90s and early 1998. We did get there 2010. I keep saying it feels like a 2010 type market coming off that major low in 09. And then, of course, right here. What you'll see is none of these lines were at a major market peak, but there always was a little bit of a payback or sideways coming shortly thereafter, or not too far thereafter. So in other words, usually the market slows down a little bit. Usually we have this digestion. Maybe that's what has really already begun right here. And Frank Capillari of Instant have put this together for us. So I think that's just sort of a way to set expectations here after this amazing year in the markets, guys.
So is that just, Mike, because people are like, wow, I've got such good gains on a 12-month basis that I might as well take some profits, in the same way that maybe when we get to June, you'll start to think, oh, okay, well, my banks, my energy's not up that much anymore.
Right. Well, I do think there's a behavioral aspect to it, without a doubt. If you're a long-term kind of financial advisor or asset allocator, you're going to try to assume there's going to be mean reversion in returns. But also, I just think the buying power gets exhausted in the short term, and you basically have valuations that get a little bit out of hand and have to get reconciled with the fundamentals. So a lot of those things, I think, do happen. A lot of this happens off of a major low, like that was in 1982 and 2009. Although fascinating, the late 90s broke all the rules because that was just an acceleration from an already strong market that got you more than 50%, guys.
Mike, thank you very much. Mike mentioned JP Morgan there. Let's talk more about the banks and that development from the Fed and the rule change earlier today. After an initial flurry of excitement this morning for both yields and bank stocks, things did settle down during the session. The KBW Banks Index now down around about 1% or so, having been down much more than that around the open. The Fed announced this morning that the special exemption from the SLR, that's the supplementary leverage ratio, that banks had enjoyed due to COVID relief would indeed expire at the end of March and not be extended as some had thought. The SLR, by the way, requires banks to have capital equal to at least 3% of their assets, or 5% for the largest banks. It's basically one of the most stringent part of the annual capital tests and requirements. Last year's rule change for COVID meant that treasuries and cash kept at the Fed didn't have to be counted as assets, thereby lowered the capital restrictions and requirements that had to be held against assets. Goldman Sachs analyst Richard Ramsden described it as a modest negative this morning versus expectations, though doesn't think it changes banks' behavior much, and even in a worst-case scenario only hits EPS by 1 to 3% for the biggest banks. JP Morgan is likely to be the most affected. It's also the one down most today, but can easily rectify pressures by issuing preference shares, for example, to boost capital, or slowing deposit growth, for example, to reduce asset growth. One factor that softened the blow this morning is that the Fed said, quote, the board will shortly seek comment on measures to adjust the SLR, i.e. nothing is set in stone yet. Nothing is hard and fast necessarily, and it's possible there will be, in fact, some long-term changes to the SLR, which banks might then welcome in due course. And Sarah, yes, JP Morgan's down 2.9%, and the KBW Banks Index down 1.4%, actually slipping a little bit in the last half an hour. But the banks have been unbelievably strong of late, so you've got to kind of keep it in that perspective.
I think we should also note, well, for this has been politicized, right? Senator Elizabeth Warren, especially the Democratic senators like Elizabeth Warren and Sherrod Brown, have been against this. And Mike, part of their argument was that it constrained lending. Is there any evidence of that? Is there merit to that? Did that make this even trickier for Fed Chair Powell to make a decision because they were getting that kind of pressure?
Yeah, it's not clear that it's a one-to-one that it would constrain lending just because banks can hold more treasuries. I mean, what's really going on, and one of the reasons I guess that they did offer this relief in the first place is, you know, between quantitative easing and huge treasury issuance, there's just a lot of reserves being created in the system. They sit within banks, and so it's kind of like deposits in cash that are being required to have capital put up against it. That itself could restrict lending. I think one of the reasons also the market did not get excited, too overexcited or alarmed about this decision today is apparently in the interim, a lot of the treasury holdings, for example, are no longer at the holding company level for the banks. They've kind of put it down into the subsidiaries. They've found workarounds, in other words, to this point. I do think one of the issues was going to be, and maybe will be, what is going to be the net demand for treasury securities as we try to fund the stimulus and the deficits from here on out. So it's not so much that banks are going to have to all of a sudden start liquidating things. It's a matter of, you know, can we take down the supply as needed down the road?
Yeah, interesting, Mike. In fact, the Goldman Sachs analysis of this did suggest that Citi and Bank of America will be able to rectify things quite quickly by moving it from holding company level down to different entities, whereas JP Morgan might have to do a little bit more finessing, but nonetheless all fairly achievable. But Sarah, to your point, and as Mike kind of alluded to, one could actually argue the opposite as to whether it restricts lending or not. But the general point, which definitely was part of that politicization, is that banks have rallied aggressively. They have benefited a lot from various measures, not complete bailouts like last time, but various measures. And this is not really something that we need extended. And so much has changed since November for the banks, whether you're talking general economic outlook, vaccination rates, all those sorts of things, steepening of the yield curve. And therefore, you can understand that the overarching point and political pressure, do we really need to keep extending more measures that help them make more money in the short term? And I think that's what's really
and help
really
them buy back more stock, I guess, is another part of it. Yeah.
True.
Yeah.
Well, we're going to talk much more about the Fed's decision today and also the Fed's decision on Wednesday on interest rates and inflation when we speak exclusively in just a few moments with Richmond Fed President Tom Barkin. He is a voting member of the Federal Reserve. That interview coming in just a few minutes. The Dow's down 105 points. The NASDAQ, though, tech stocks and momentum are in rally mode. You're watching Closing Bell on CNBC. Another volatile week on Wall Street. The NASDAQ right now is bouncing back after falling 3% yesterday. It is still lower for the week. This is the 10-year yield. It's 14-month highs. Joining us now for an exclusive interview is Richmond Federal Reserve President Tom Barkin. Welcome back, President Barkin. Good to have you.
Thanks, Sarah. Good to be here.
We've got to start with rising Treasury yields. We're going on 8 weeks in a row now. Started the year with the 10-year below 1%. We're now at 1.75. I know you and other Fed members have said you're not particularly worried about it because it doesn't look disorderly. When would you get concerned about the move we're seeing in bond yields?
Well, I think market functioning would be the thing that would make you nervous if we're the fiscal agent for the Treasury. And at some level, if you weren't see the Treasury market functioning, you'd have some concern. But most of the days it's increased, it looks to me like it has something to do with optimism on the economy, whether that's vaccine rollout or fiscal stimulus or higher inflation expectations.
Are you worried about it causing a disruption in the markets and in financial conditions overall? Places like the housing market, which has really been humming along on lower rates?
Well, there's a lot of momentum in the economy right now. I think we're going to have a very strong summer, a very strong fall as pent-up demand comes back in the economy, as vaccines roll out. And I think the economy is going to be strong enough to take somewhat higher rates.
Do you think, therefore, given, as you said, that you think summer and fall are going to be very strong, inflation will jump quite aggressively for those periods of time, even if you think it's then going to settle back down afterwards?
I think we will see price pressure this year. As you suggest, the first thing we're going to see is the deflationary reads of last spring roll off. And so the 12-month numbers will go up just because the baseline changes. And so that will happen. By the way, we had very strong price pressure in the fall. And so by the time we round over that, that'll get normalized. But you can't, help but hear these supply chain issues people are having filling their stores. I really do think, I'll speak for myself, the desire to get back into the economy is quite strong. And I think that kind of demand will lead to price pressure. As you suggest, though, the fact that we'll see price pressure over 6 months is not the same thing as saying we're going to see inflation over the next several years.
President Barkin, just want to play for you a clip from Chair Powell's news conference just 2 days ago on this topic of inflation. Here's how he characterized it.
Inflation expectations are strongly anchored around 2%. We know that inflation dynamics do evolve over time. There was a time when inflation went up, it would stay up. And that time is not now. That hasn't been the case for some decades.
Is that your view? Do you feel confident in saying that any inflation that we do see rising will just not last? Because it doesn't work that way anymore?
It's impossible to predict the future, but what I think is there are these long-term disinflationary trends. Think of them as headwind. Global access to labor and global access to product would be a good example. Technology, which allows you to check prices on your phone, is another example. The power of big retailers like Walmart or Home Depot and their ability to negotiate strongly with people who might want to raise price. All of those things have been working against inflation, in addition to what the Fed and other central banks around the world have done, which is, stable and consistent messaging around inflation targeting. And that means, I think, that you've got very stable expectations. I'd note that inflation expectations have come back toward our target, but don't seem to be moving out of line in the markets. And as I talk to executives, they may see short-term price pressure, but as I probe them on the question of, well, your normal routine is a 2% increase every January, are you thinking about changing that to 4%? I don't hear them saying that.
President Barkin, you mentioned that you're not too worried about the level of treasuries in the short or medium term. What if credit spreads did gap up? I mean, clearly they haven't yet, but if they did, would that be a worry for you?
Well, I have to say credit's been one of the really positive stories of this economy. You might expect in a normal downturn significant upticks in defaults, both personal and commercial. We certainly saw that in 2008. And you just haven't seen that the same way now. And so, to me, credit spreads ought to be related to credit performance. So far, I'm encouraged.
Just for those, President Barkin, that see the Federal Reserve estimates for growth going to 6.5% this year, which was above consensus and a really good, strong story for the U.S. economy, and inflation going well above 2%, and wondering, why isn't it the time now to be talking about tapering the emergency stimulus that's in the economy? What would you say?
Well, we've given very clear guidance that's in line with our new framework. That guidance says, and you could play another tape from Chair Powell if you wanted to, it has to do with maximum employment. It has to do with hitting the 2% inflation target in a sense that you could moderately overshoot for some time in an effort to return expectations closer to 2%. And when we hit those, and similarly on asset purchase, when we hit substantial further progress, then I'm ready to taper and I'm ready to move rates. But I'd like to do that when we hit those targets, which I hope and think we've communicated pretty clearly.
I wanted to ask President Barkin about the SLR. Obviously, this morning we learned that the current removal of banks having to abide by it to the end of March won't be extended. There was an interesting line in the release that said the board will shortly seek comment on measures to adjust the SLR. Is that just going to be applying to how you bring it back in at the end of the month, or could there be long-term changes to the SLR for forevermore?
Well, I think we took a bunch of extraordinary measures a year ago. Many of them are now, it's time to wind them back as the economy comes back. And you heard my forecast for the rest of the year. You saw we have facilities that are winding down at the end of the month as well. My take on the release is it's a longer term look at the SLR, not a this month look at the SLR. And the question, as we operate in a much more significant reserves regime than we have before, where the outlet for those reserves are and whether it wouldn't be appropriate for some of those to be held in more increased levels by banks. But that's something I think we're going to go out to comment from, as the statement says.
Want to dig into your forecast a little bit more. I know we're not supposed to pay too close attention to the dots, but the dots are out there, and an increasing number of Fed presidents and Fed officials do expect to start raising rates next year. Is that you?
Well, I expect to start raising rates when we meet the conditions that we've talked about. And my personal forecast has a very strong year this year. It has unemployment coming down, somewhat slower than the strength of the economy, because I think that labor force participation's going to increase. We're going to bring people back into the workforce. And as I said earlier, while I see inflation and price pressure being strong this year, I don't see that yet as a strong multi-year phenomenon. So there'll be some creep back. And then when those conditions are hit is when I want to increase rates. And I'll just give you my view on the forecast is there's a forecast and then there's rates. There's not rates, then a forecast. So I don't have a sense that there's a timing, there's a year, there's a month, there's a quarter that I'm thinking about. I'm trying to figure out what's happening in the economy. And when we meet that is when it's time to increase rates.
How close are you watching yields around the rest of the world, which obviously have been even lower than here in the US for the last decade or so, often still in negative territory? If they suddenly started to rise, and one can imagine the delta when they do being quite significant, do you think it will pull US yields higher? And is that something you're potentially concerned about?
Well, if international yields rose, I guess I would hope and expect it would because some of the struggles they've had in terms of bringing their economies back might be behind them. Some of the struggles they've had in hitting inflation expectations might be behind them. So I could see that happening as a very good thing. I have to say, we're blessed in this country. Our economy's been quite vibrant. It's bounced back faster. I think our yields are actually a sign of strength. Inflation expectations are stronger here than they are in places like Japan and Europe. I think that's a sign of strength. And assuming that their yield increases were related to increases in their real economic forecasts and, a move of inflation back toward their targets, I think that would be a good thing too.
What are you hearing from your district? The Carolinas, DC, Virginia, West Virginia, Fifth Federal Reserve District. What do you hear as we are about to get another $2 trillion in fiscal stimulus for relief from COVID?
First of all, great relief that the vaccines have been rolled out and are being administered. And you can see in all of these states, us moving down the progression. And so I just hear a lot of optimism about the future, because once you have people you know and friends getting those vaccines, it just seems like the back end of this gets closer and closer. I've talked to retailers even this week who've seen the impact just in the last couple of days of the stimulus checks, particularly low to medium end retailers who have seen money coming into the economy and coming into the economy quite strongly. I think as retailers and restaurants, movie theaters I saw today, reopened across the country, I think you're seeing just a real sense that spend's going to be strong. There's tightness on the labor market. That's been true for the last several months in technology and healthcare and in manufacturing and construction. But even the people in hospitality are nervous about whether they're going to be able to find enough workers to get back to the capacity that they project. The folks who, of course, are I'll call it the least confident, are those who are dependent on businesses getting back to work and dependent on business travel. That's probably going to lag still somewhat, but I hear a lot of optimism in our district, and even those business organizations, they're starting now to have those conversations about coming back and how's it going to be, and it's all starting to feel a little more proximate. I think it's a promising time.
Tom Barkin, thank you very much for coming on and sharing, President of the Richmond Fed. We appreciate it.
Glad to be with you. Thanks for your time.
We have 35 minutes left of the session. We are well off the session lows, of course. Still in the red for the Dow, but only down 120. We were down 350 at the low. Coming up, facing reality, Mark Zuckerberg weighing in on the upcoming privacy changes to Apple's operating system, which could have a major impact on Facebook's future. But we'll tell you why Zuckerberg remains optimistic. That's coming up next. As we head to break, though, check out some of today's top search tickers on CNBC.com. 10-year yield once again on top, followed by Tesla, Apple, chemical company Linde Gases, and GameStop. We're back in a couple. Welcome back. Upcoming changes to Apple's operating system could have a major impact on Facebook's advertising revenue, but CEO Mark Zuckerberg is making new bullish comments about the privacy update. Julia Borston's got that story for us. Hi, Julia.
Well, Facebook is taking a new tack in its battle with Apple over its operating system change. That change will ask users if they want to opt out of being tracked on their devices. Facebook now saying it could actually end up helping its bottom line. Yesterday in a Clubhouse interview, Mark Zuckerberg saying, quote, a lot of these changes are going to make it harder for small businesses and developers. Now, Facebook has said that if they can't use data from tracking, advertisers will generate 60% lower sales based on those ads. But in a twist, Zuckerberg says this could end up helping Facebook because of its investment in e-commerce, saying, quote, Apple's changes encourage more businesses to conduct commerce on our platforms by making it harder for them to basically use their data to find the customers that would want to use their products. Now, Zuckerberg announcing that Facebook already has more than 1 million active shops with more than 250 million people interacting with shops every month. So that's a sign of their investment there. Now, along with Spotify CEO Daniel Ek, Zuckerberg did criticize the fees that Apple charges, saying they take a bigger cut than what Facebook takes. Guys?
Julia, speaking of, we've got to talk about this Instagram version for kids. And I know the company's going to face a lot of criticism for targeting a younger demographic under 13 years old, but I actually think it could be good because if the kids are going to use it anyway, at least they should use a safer version. Tell us about it.
Sarah, that's exactly their argument. That's exactly what CEO Adam Mosseri said. He tweeted out confirming this report because it first leaked out as a report. Mosseri said kids are increasingly asking their parents if they can join apps that help them keep up with their friends. A version of Instagram where parents have control, like we did with Messenger Kids, is something we're exploring. We'll share more down the road. But Sarah, you're absolutely right. They figure if kids are going to be trying to skirt the rules and get on the app anyways, they'd rather have them do it legally. Of course, there are lots of questions, hurdles about parenting groups and parents who might not want their kids to do this. But Sarah, of course, there are already risks of bullying on different mobile platforms and digital platforms. And these are all things that Facebook is going to have to worry about when they're dealing with the under 13 set.
Agree. Parent controlled is key. Julia Borston. Julia, thank you. If your kid's going to use Instagram, Wilfred, at least you should control it.
I mean, social media in general for kids has got to be just appalling. I think these controls are a good idea, but then people will just end up moving on to other forms of platforms, I'm sure. But anyway,
right.
One of the great battles of the generation. We have 30 minutes left, and we're up 0.2% on the S&P, down 1/3% on the Dow, and the Nasdaq leads the charge up 0.7 today. Rebounding from some softness earlier in the week. Let's have a look at some individual market movers. Wedbush upgrading Starbucks to outperform from neutral, saying it now sees more upside and long-term visibility. Earlier today, Starbucks chair Melody Hobson weighed in on the COVID-19 recovery and where she sees Starbucks' business going from here.
I do expect this economy to be very strong coming out of COVID. We've been calling it the roaring 20s like many others. And at Starbucks, we also think this will be a very robust period for growth.
Starbucks shares are down 0.25% or so today. Deutsche Bank adding Molson Coors to its short-term sell catalyst list. The firm says the call is based in part on short-term concerns around a cybersecurity breach in March, adding it likely caused disruption in Molson Coors' operations. The stock climbing quite a lot intraday. It's now just about in positive territory.
28 minutes left of trading. Time now for a CNBC News Update with Rahel Solomon. Hi, Rahel.
Hi, Sarah. Hello, everyone. Talks have resumed between U.S. and China officials in Alaska. Both sides are accusing the other of grandstanding and showing little interest in meaningful dialogue. The House of Representatives holding a moment of silence, calling on everyone in the chamber to pause and remember the 8 people killed at 3 Atlanta area spas earlier this week. In Texas, police are looking for a man that they say stabbed a fast food worker after being told to put on a mask. It happened at a Jack in the Box near Houston. Store manager was hospitalized with 3 knife wounds, but has since been released. And in Connecticut, most businesses are enduring their first day in about a year without capacity limits, though distancing restrictions do remain. And Connecticut is not alone. Get the latest on all the state reopenings tonight on the news with Shepard Smith. Sarah, I'll send it back to you.
Rahel, thank you. Still ahead, our weekly doctor's appointment. Former FDA Commissioner Dr. Scott Gottlieb will be here to discuss the growing debate over whether vaccinated Americans do still need to be wearing masks. And as we head to break, a check on bonds for you. Yields, the story of the week. Mixed across the curve today. The 10-year yielding around 173, got higher than 175 yesterday, but still 8 week in a row where we have seen rising yields. It's wreaked havoc on the NASDAQ and on stocks in general. We'll be right back.
We have 24 minutes left of the session. We are well off the lows, now down less than 100 points on the Dow. The S&P's higher. The Nasdaq's up close to 1% now. After the break, we'll take a look at the global economic recovery and what it all means for banks when we speak with former Standard Chartered Chief Executive Lord Davis. And later, stimulus and stocks. We'll ask the CEO of Robinhood competitor Webull if he's expecting an uptick in trading as stimulus checks hit bank accounts nationwide. We're back in a couple minutes. Bank stocks under pressure today after the Fed said it will not extend emergency capital relief enacted amid the pandemic. But despite today's move lower, the group has been on a tear this year, with the KBW Banks Index higher by 24%. Joining us now for more in a Closing Bell exclusive is Lord Davis, chairman of Letter One and former CEO of Standard Chartered, amongst many other things. Mervyn, good to see you. Thanks so much for joining us.
Nice to see you.
The last decade, whether we're talking European banks, Asian banks, US banks, could arguably be said to have been a bit of a lost decade for banks, certainly relative to certain other sectors on the stock market. Do you think the next decade will be quite the opposite?
Well, you know, as chairman of Letter One, which is a long-term investing company, we see from the variety of industries we're involved in, you know, the impact of the digital revolution, and that is affecting banks all over the world. You know, you look at the valuation of Stripe, you look at the valuation of Klarna, there's just so many new entrants encroaching into the banking industry. And I think, you know, with the impact of COVID, the digital revolution is going to speed up. And, you know, I still see huge value in their customer franchises across the world, but increasing competition for the industry.
So will only the tech-enabled banks survive or grow their share price over the next decade? And does that mean the bigger players are perhaps better positioned than the smaller players?
Well, I think if you're a small player and, you know, you're technologically savvy and you've got a good customer base, and you've got a modern workforce that really understand the changes going on in society, then you will do well. I think the challenge for the big players across the world is legacy systems. How do they handle that? But I think the other issue, which is, you know, you've heard lots of bank CEOs, I've been out of mainstream banking for over a decade, but I see it in Letter One. You know, the way in which you manage the culture of an institution has changed as a result of COVID, the way people work, the work-life balance. There's so many issues that are going to come out of COVID that are going to be on a CEO, not just multinational, but also bank in their intros.
I have a question on that note. Wilfred pointed out to me the work that you did in the UK starting in 2011 to get more women on boards and ended up doubling it in the years that you were there, but still I think at what, 25-26% of the FTSE. How do we double that number, especially as big companies here in the US are grappling with those questions of how to include more gender diversity and racial diversity on their boards? Why is it not happening fast enough?
Well, I think, you know, look, if you're a chairman, a CEO, or a board member of any company, it doesn't matter whether it's public or private now, and you don't understand the impact of ESG on your business, then either the youngsters will leave the company or your customers will leave you as a brand. So for me, you know, ESG is a wonderful development. It's changing the way we look at capitalism. And as part of that, you have just got to be a diverse institution at the board table, but also right across the workforce. And I think one other challenge as a result of the digital revolution is that, you know, some years ago, you know, boards of directors, the youngsters in a company would be looking upstairs for wisdom. And today, the boards of directors are looking downstairs to the youngsters to see exactly what's going on in society because it's so fast moving. So it's not, you know, diversity and inclusion at the top of a company isn't just about ethnic diversity or male and female. It is generally also about ages. And I think that's quite a challenge for boards.
A good chance to ask you about one of Letter One's big investments, an L1 Energy, oil and gas company, Lord Davis. I was going to ask in terms of whether you see that as a strong decade ahead for oil and gas. Clearly, it's been in the short term rallying pretty hard, but had a bad sector performance over the last decade. But I guess two parts to the question, that, but also how do you square that with a strong view on ESG?
Well, I think, you know, we've made a declaration, or Ben Sheldare has, on being net zero by 2030 and getting rid of flaring, etc. So, and we're also investing in new clean forms of energy. So I think the oil and gas industry will continue to be an important part of energy sources, but they've got to modernize and they've got to, climate change right across the world is now one of the issues of the day, and and inevitably oil and gas and oil and energy companies have to adopt their strategies. I think the other thing is, you've got climate change, you've got health and wellness, you've got a range of issues now really hitting every industry. And I see, from Letter One's perspective, because we're in retail, we're in healthcare, we're in tech, it doesn't matter what industry you look at, you're in a bit of an industrial revolution and you have to adapt. And oil and gas is no different.
Just finally, Lord Davis, are you surprised not to have seen a better improvement in relations between the US and China since the change of administration here? Or do you expect this to be the norm now, some kind of tensions for the foreseeable future?
Well, I think this is the issue. This is the elephant in the room, as you described earlier on. I think that, the world needed America to get back onto the global stage, whether it's WHO, whether it's NATO, you name it, the US has to be at the table, and you retreated. And, there is no doubt that China is a huge super economic power, and the relationship between the two, the rest of the world is watching very carefully how, the meetings go in Alaska. They're very critical to global security and global economic development. So I wish them very, very well in their deliberations, because it's very important that these two great trading, giants get on and solve their differences.
Lord Davis, thanks for joining us. Great to catch up as always.
Thank you very much indeed.
Up next, Wall Street gets bullish on Ford's EV ambitions and the story that's sending Visa lower. All that and more when we take you inside the market zone. We've got about 14 minutes left of trade. We'll be right back.
Just over 10 minutes left in the trading day. We're now in the closing bell market zone. Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. And today we've got Odyssey Capital Advisors Chief Investment Officer Jason Snipe with us as well. Very good afternoon to you, Jason. Let's kick things off with the broader market. The Dow lagging in the red, while the S&P 500 and NASDAQ are higher. The S&P 500 and NASDAQ currently on track for weekly losses. So is the Dow as well. In fact, all of them are. Russell 2000 comfortably the worst performer for the week. Mike, interesting, just a little snapshot. Even though tech's doing relatively well today, we do have Tesla in the red. Apple fractionally was in the red earlier, but now is essentially flat. And some sort of noticeable declines there on the week for the likes of Tesla, down 6%.
Yeah, I would say you still are not having really persuasive rebounds in a lot of kind of aggressive high growth tech. That has not been the case. You definitely have seen some efforts to migrate back into high quality NASDAQ stocks at times when the yields have given them a chance and they've backed off. I think in general today we have kind of tentative action. It's a quadruple expiration day that kind of keeps the indexes sometimes within a band, and that is what you see right now, give and take. We are not seeing Treasury yields make new intraday highs versus yesterday, but still, I don't think anyone's convinced that even though it looks like they seem very extended, as I've been saying for a while, that has not really paid off in terms of calling the top of this yield move.
Jason, how much of your strategy right now is built around rising rates, which has been the predominant theme this week and over the last few weeks? And if so, what do you do?
So it's an interesting question, Sarah. I think what we've done here is really embrace this kind of reflationary trade that's been going on since November. Obviously, the 10-year note, the push and pull between the 10-year note and the NASDAQ is something to make mention of and obviously follow very closely. But I think for us, it's making sure you have a balanced approach here, even keel between value and growth. And I think that's going to be important as we move forward and kind of see how the markets trend from over the next few quarters.
Mike, oil prices, noticeable pullback for the week as a whole, a little bit of a jump today. Is that something that could start to take the wind out of a sector that, of course, has been incredibly strong so far this year?
Yeah, it's been an excuse to, I think, skim a little bit of sort of the momentum gains out of energy. But it's interesting, though, because it was pretty much a neglected, just cast aside group several months ago. And then with this revival, when you see people getting more excited about the demand picture, and maybe we're not going to see a similar supply response this time because of long-term secular issues, I think people did kind of make up rationales for why there was a lot more to go. And one of those would be if you looked at a 10-year chart of energy versus the S&P, because it looks like it's just barely even budged, even though it's up vastly for the last several months. So to me, it definitely requires some kind of consolidation. And $60 was a pretty significant area to get above and see if it can hang above there for a little while longer.
Let's hit Tesla. Wilfred, you mentioned it. Under pressure again today after reports that the Chinese government is restricting the use of Tesla vehicles by state and military personnel, citing national security concerns. China's alleged growing distrust of Tesla comes as America's auto safety agency ratchets up investigations into Tesla. The agency disclosed that it currently has 23 active investigations into recent Tesla vehicle crashes. And competition in the electric vehicle market overall continues to heat up. Barclays upgrading shares of Ford to overweight, predicting the company will likely aggressively shift its strategy toward battery electric vehicles in the coming years. That's really helped Ford and GM. Jason, how do you play this theme? And is Tesla risky from here?
So it's a great question. I think Tesla for us has been a trade. We've been trading in and out of it over the last 18 months. And I like this move with Ford. I like this move. I've liked GM. We've kind of played the do-it-yourself market, with AutoZone, which we actually moved out of recently. But what I will say, I like the alliance with Ford and VW. I think the increase in competition is a good thing. And I think there's obviously a lot of upward trend and movement here, and I think it's an opportunity to jump in and be a part of it.
Mike, these guys have performed very well as well. I mean, there's very few groups left out that haven't.
That's true. Absolutely. In fact, the only thing you could point to say that's really been left behind or nobody has an interest in are the truly lower growth defensive areas of the market, like staples, like utilities. Some parts of healthcare definitely have been sitting this out. But yeah, things like GM and Ford, it's followed along this theme where older economy legacy companies are getting credit
for being participants in, the new emerging big picture growth story. So obviously here it's electric vehicles. For Disney, it's streaming. Even for other media companies, it has been streaming. And Target all of a sudden is an omnichannel retailer. All that stuff has all been revalued. And in terms of Tesla, these have been subplots of the Tesla story for a long time. The safety issue is kind of a nagging storyline. And then, of course, things like China demand, I think, has been a big question mark because they've been very excited about it at Tesla, but it's never been clear that China itself would be willing to sort of, put Tesla at any kind of advantage to their own domestic producers. So I guess that also is a little bit of wear and tear on the growth story for Tesla.
Shares of Visa falling on a report of a possible probe into the company's debit card business. Kate Rooney's got that story for us. Hi, Kate.
Hey, well, Visa down 5% today following a Wall Street Journal report that the Justice Department is investigating whether the payments company is engaging in anti-competitive practices, specifically for its debit card business. Sources telling the Journal that merchants have complained about paying excessive debit fees, and regulators are exploring whether Visa limits competition in debit card routing. This comes just months after the DOJ sued to block Visa's $5 billion deal to buy fintech company Plaid, also citing antitrust concerns. Visa and the DOJ declined to comment. Back to you guys.
Kate, thanks so much for that one. Visa down about 6% or so. And Mike, adding to a sort of broader financials pullback today for different reasons. And again, one of the financials that hasn't performed well relative to the banks year to date.
It is true. Now, this, of course, really is in sort of the high growth bucket. In fact, literally in the S&P, it's in tech as opposed to in financials, even though it is essentially just financial transactions. It's interesting. There's been always this complaint among the retailers. The merchants have never liked all the fee structures. They've never liked the fact that these companies have a bit of a lock on things. But it's always been the case. And the reason they had high valuations is it was a sort of sustainable duopoly plus a few other players. I don't know if it's going to change right here. They've always been able to make the case that the overall value proposition to consumers is actually very good. They could provide this huge range of services on the back end to the merchants and obviously consumers. So we'll see if it really does, compromise their pricing and earnings power longer term. Right now, I see it as a decent excuse to, take a little bit of the premium out of a Visa.
It's about these invisible fees to consumers. Jason, do you see this potential DOJ investigation as a threat?
So I think it's a potential headwind here. Obviously, these DOJ cases take some time to unfold and develop. For us, this industry, the way we've kind of played it, when we kind of talk about the growth names, Square and PayPal come to mind, as areas of opportunity as we kind of look at decentralized finance as the future. So, I think it could be a blip in the road. We'll see, but, time will tell over the next few quarters.
Slipping a little bit as we approach the close. S&P's now flat. 2 minutes left. Mike, what are the internals showing us?
They've actually been net positive throughout the day, Wolf. If you look, actually, we had some small cap outperformance. That also does mean positive breath for the New York Stock Exchange, and we are there. It's not certainly overwhelming. 1,800 stocks higher against about 1,450 to the downside. Did also want to make note of the new highs versus new lows on the NASDAQ. This is typically in the last few weeks, highs have swamped new lows. It's been overwhelming. This is the first day in a little while. It haven't been too many days, let's just say, when you've had 100 new 52-week lows. It just sort of shows you some of the damage. There's an undertow of selling. There's some internal correction going on in this market that's been hitting some of the reaches of the NASDAQ. So even though there are more new highs, this is something to keep an eye on. Then the volatility index, we talked about how we did get to 2 straight closes below the 20 mark. We're basically hovering right there. It's kind of a not much to see here thing at this point. It seems like it's not ready to completely fall off a cliff and say that we're back into a very calm, normal type springtime market. On the other hand, it's not standing in the way of the S&P continuing to rally because it's been around here for much of the last several months, Sarah.
As we head into the close, let's take a look at where we stand. 1 minute left. The Dow is falling about 200 points, wiping out gains for the week, now lower. Visa is a big part of the story, as we just talked about the antitrust probe from the DOJ, shaving 86 points off the Dow. Nike still having a negative reaction to its earnings report and sales miss yesterday, shaving 33 points. Strength in the Dow now, Home Depot, United Health, and Salesforce. S&P 500
under pressure, but we have a mixed picture. Communication services are up, technology is down, financials are the worst performers after the Fed move today, and energy is rebounding after a very tough week where the sector was down 7.5%. The NASDAQ and this Russell 2000 both rebounding today, a little less than 1%, but both lower for the week, especially small caps closing lower, 2.6% or so. For the NASDAQ, down for the week, little less than 1%, fourth down week in the last 5, Wilfred.
Yes, at the close, a little bit lower for the S&P 500. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen and Mike Santoli, CNBC Senior Markets Commentator. S&P closing down 6 basis points, just slipping into the red as we approach the close. You can see that final 15 minutes or so of trade there for the Dow, fairly negative. The Dow closing down 233 points, or 0.7%. The NASDAQ up 0.75%. All three of the major averages were lower, though, for the week, largely because of yesterday's selling. Communication services, consumer discretionary, the best 2 sectors today, the worst, real estate and financials. Coming up, the CEO of Robinhood rival Webull on the retail investor revolution and whether stimulus checks will lead to an increase in trading activity. Jason Snipe from Odyssey Capital Advisors still with us, and Gina Sanchez, Chief Market Strategist at Lido Advisors, joins the conversation. Mike Santoli, first to you, and just that final 15, 20 minutes taking the S&P into the red for the day. We're still off the session lows, but just ending on a slightly sour note.
Yeah, I would say expiration Friday close. I don't want to really extrapolate what's going on here aside from squaring up of things. In general, the market had a hard time kind of gathering its feet under it all week because it was off balance, either because yields were going up or because yields were coming back and it was going to be a re-rotation type move. Net, you know, the overall trend is kind of held up, but I do think it's interesting to look at, we're almost a quarter of the way through the year. You know, S&P up, 4% or something like that, less than 2% from all-time highs, in a decent position. But it's also taken near record levels of net inflows into equities. You've had a lot of money thrown at this market. You have a lot of deal flow. So it's been this very active situation where high demand meeting high supply, and it's netting out to certainly still a bull market, but it seems a little bit more tentative. In the last half of each of the last 3 months, you've had this period of turbulence right here. So I guess we're just digesting the massive rally of 2020.
It's really, if you look at the communication services strength, Mike, today, a lot of these media names continue to make new highs. Discovery Communications at a high, News Corp, Viacom, CBS, as we've covered. What's driving this big run?
I mean, they are very heavily weighted in the value indexes. They have become this sort of momentum. I mean, pure value, and all of them would have qualified, has become this momentum trade. We've said it repeatedly here. And so in terms of what news-wise is doing it, I don't know. I'm not sure if the market was reacting to the NFL deal here among some of those players, but that's certainly not a Discovery story. So I think they've been trading kind of as a group. They've been trading inversely to things like Facebook and Netflix when those stocks have been weak on some days. So I don't think there's really much of a particular fundamental storyline. There's not really a through line there. It's much more about this sort of relative trade between value, growth, and momentum.
Gina, where are you on that relative trade between value, growth, and momentum?
So we've been overweight value really for several months now. And if you look at what has been driving that, initially it was concern about how long the pandemic would last. Now, I actually believe that the rise in rates is actually pushing investors to really think about where to find growth at a reasonable price. So I think this is really kind of garpier than pure value. I don't think that folks are interested in catching falling knives. And so if you look at the value side has just outperformed growth. And I think that really has been about trying to find better value of growth of companies that can participate in the reopening trade. And everybody agrees that this reopening trade probably could be very big.
Even when it comes to growth, Jason, not all growth is considered the same, right? You've got tech names like Apple and Facebook, and then you've also got names like Zoom and Peloton. Are there any of those trades that you should be in? Do you distinguish there between the high growth momentum names and the mega caps?
Without a doubt. So, you know, when we think about growth, we put them in those two different camps. Obviously, they're the high flyers, the Zooms, the Pelotons, and some that we like right now, which are Twilio, Square, and PayPal. I think that's a different camp. Obviously, we've seen the rates move from 0.90 to up to 1.75 over this past week. And obviously, a lot of the high flyer names with those crazy PE ratios, they're obviously vulnerable to this movement. But on the other side, as you mentioned, the stronger growth, like the Microsofts, the Googles of the world, those are some of the names we've kind of leaned to and added capital on some of the pullbacks over the last couple of weeks.
Richmond Fed President Tom Barkin, who is a voting member of the FOMC, joined us last hour. He struck an optimistic tone about the economy. Here's what he said.
There's a lot of momentum in the economy right now. I think we're going to have a very strong summer, a very strong fall as pent-up demand comes back in the economy, as vaccines roll out. And I think the economy is going to be strong enough to take somewhat higher rates.
Gina, that's going to be the thing, right? Because he also echoed exactly what the Fed Chair Powell said this week, which is we're going to make our decision based on data, on inflation, not on forecasts, and we're not in any hurry. We're not pre-committing anything on rates and on talking about tapering. Is there a conflict there from what's happening in the bond market right now?
Well, I think that what Fed Chair Powell has said, and I think what is worrying the markets, is that the Fed is not just looking for data to support that inflation exists, but he looks for persistent inflation now. The new Fed framework really is going to require 12 months of observed inflation, which it's been a decade since we've seen inflation like that. And so if you look at how long it will be before the Fed will finally move, it could be sometime in mid-2022. And I think that the bond market is looking at two things. One, the sustainability of debt issuance. That's one element. And how much inflation is going to be sort of generated through this post-pandemic boom. Now, our estimates are that, we're likely going to see some short-term inflation, but it won't be persistent. And that it will be a while before the Fed actually acts. But the bond market is pricing as though there's going to be more inflation than that.
Mike, did we see a little bit of a short-term top in yields today? The 10-year spiking, pulling back, the 30-year closing lower on the day?
Yeah, I mean, it's very tentative. It's contingent at this point. But, one thing you can say is, the rate of change higher in yields has been fairly extreme over the last couple of months. You've seen tremendous positioning in the direction of higher yields. In other words, a lot of speculators already on that side of the boat. Seen massive outflows from things like the long-term Treasury ETF. So all of these ingredients suggest that the higher yield trade is incredibly crowded in consensus at the moment. The thing is, bonds move based on macro, and they kind of more have these tidal shifts as opposed to the necessarily just responding to short-term positioning very much. So I think you can't really doubt the trend is higher. You just wonder if it has to take a break for a little while, take a pause. Not sure what it would require to get that to happen. Maybe we get a little bit of softening of data or a little bit of concern out there, even over a stock decline. It could work in that direction. But right now, you would think most of the short-term move is in yields right now.
If yields are rising, Jason, on higher growth prospects, shouldn't small caps continue to rise? But that was the hottest trade on Wall Street. It got pummeled this week, down 2.77%, the worst among the major averages. Is that over? The gain that we've seen? Tremendous gains from March lows last year.
Oh, without a doubt. Without a doubt. I mean, those names have moved so much. And I think a lot of that has to do with just taking some profits, taking some off the table as, rates continue to move and repositioning, looking at other opportunities in the market. And I think the market's still trying to digest, inflation, obviously the 10-year where that's been going over the last couple of weeks. So I think there's been some time for a little bit of a pause, and I think that's what's kind of happening in small caps and emerging.
Gina, in terms of international markets, which are you most excited by at the moment?
We're actually looking at the developed markets. I mean, relative to emerging. Emerging markets had such a huge run with the sort of China beating the world to the reopening, and a lot of that got priced in. Now you're actually seeing the rest of the developed markets catch up, even with the bad news that's coming out. I mean, you heard Paris locked down again, but we still see from a valuation perspective, and remember that the markets right now are very focused on valuation more so than ever. From a valuation perspective, there's still a lot of value locked up in some of these international companies. And so it's for us, it has been so far a trade that's been working.
A lot of those European averages closed the week higher, including the DAX, going against the U.S. We will leave it there. Jason Snipe, Gina Sanchez, good to see you both. Thank you. Up next on the show, the CEO of Robinhood rival Webull on whether he has seen an increase in users defecting from Robinhood following its trading restrictions in GameStop and other popular Reddit trades. Plus, Stifel chief equity strategist Barry Bannister on why he expects value stocks to outperform growth by 40% over the next 3 years. That's specific. And Dr. Scott Gottlieb also coming up. We're back in just 90 seconds.
GameStop set to report earnings next week. The stock has surged nearly 400% in the last month amid renewed retail interest following the frenzied trading in January. Joining us now in a Closing Bell exclusive, Webull CEO Anthony Denier. The company is a top mobile trading competitor to Robinhood. A very good afternoon to you. Thanks for joining us.
Glad to be here. Thanks, Will.
So the retail revolution, let's just look back a little bit first. How do we get to where we are today?
Yeah, well, from my point of view, this is something that's been happening for quite a long time. It's not just something that happened on January 28th. We've been working towards this for many, many years. I think three most specific things actually was when the world went to zero commission is number one. Schwab, Fidelity, TD all announced pretty historically that commissions were now going to be zero, and this brought in a whole new wave of investors that would have never thought about investing in the stock market or getting involved in the U.S. capital markets. And then we had the second obvious wave, which was COVID. People had more time. People had more time to learn about the markets, to actually open up that brokerage account that maybe they've been putting off for years. And of course, entertainment wasn't around, right? There wasn't any sports books anymore. There wasn't gambling. So the one thing that remained open was the stock market. And of course, you also had every night people would come home and see new all-time highs in the market, a very, very aggressive Fed policy, and stimulus packages that just threw fuel on the fire. And then ultimately, I think the third was that kind of culmination of social media and investing that culminated in the GameStop scenario on January 28th.
And so is it all here to stay, or when a couple of those factors change in direction, which they inevitably will, whether that's the market pulling back and people experiencing serious losses for the first time, and or, of course, hopefully economic reopening so that we have other things to fill our time with, will retail engagement in the market decline at those moments?
Yeah, we may see a little bit of a decline and maybe a little pullback in engagement and activity, but what we will have gained is a now new educated young America in terms of how the capital markets work and how the financial system works, so they can be smarter about the financial decisions that they make going forward. So even if there is a pullback in engagement, it's still a positive for everyone.
So what are your numbers like right now, and how much did you benefit, if at all, from the Robinhood debacle when they had to restrict trading on GameStop and AMC and others when things were going crazy?
Well, we've been growing aggressively for the last several years. It just wasn't, one event that we became, a player, I guess, in the world of retail trading. This has been ongoing. We've been working hard at acquiring customers, and we found that where we position ourselves in the market is we're a bit more sophisticated in how we present our analytics, our charts, and our platform. So we take a lot of customers, like you've mentioned, from Robinhood that are looking for a bit more engagement. They're looking for a bit more data so they can make a better decision when they actually trade or make an investment. So this has been going on for a while, but no doubt, did we see a huge jump in users when different brokers put on restrictions on specific names or brokers went down. Those are all big tailwinds for us.
What's your view on crypto and Bitcoin specifically, and how engaged are your customers with it?
Well, we've been really fortunate with timing. We opened up crypto trading in mid-November of this year, and Bitcoin at that point was about 17,000. So timing is very, very key in everything you do. So we've been really fortunate. We've seen a huge uptick in customers opening up crypto accounts on our platform. We're well above 1 million accounts right now, and we're looking forward to adding new product and adding new cryptocurrencies for our customers to invest in.
Anthony, what about the risk factor, if at all, being owned by a Chinese company? I mean, you're a Chinese company and expanding aggressively in America, where, I don't know, consumers could be concerned about their data going to China, going to the Chinese government, about all sorts of cybersecurity risks, not to mention the geopolitical clash that is on full display right now between the U.S. and China, and a potential crackdown on Chinese financial companies in the U.S.
Yeah, Sarah, I'm glad you brought that up. So Webull Financial is a U.S. broker-dealer. We are a U.S. company. We're registered by the SEC and FINRA. Right, so our customers' information in the U.S. is based in the U.S. It does not leave the U.S. Right? Our Chinese parent company is a technology company. They do not run the broker-dealer. The broker-dealer is run here in the U.S. And our broker-dealer, Webull Financial, is cleared through a company in the U.S. called Apex Clearing. So essentially, our customer accounts are actually held at a U.S. clearing firm called Apex Clearing based in Dallas, Texas. So not one customer account is based in China. Not one piece of information is going to China in any sort of way. So it's a little bit of miscommunication there. We are a U.S.-based company.
I wanted to end, Anthony, by kind of pivoting back a little bit to a topic we touched on earlier, which is what's going to happen as and when significant losses are experienced by all the sort of people that, as you said, were enticed into the market only over the last year or so, when markets have only risen. First part to the question is, who's responsible for those losses? Do you expect to have quite a backlash as and when it happens? And what will it do to engagement and market levels overall?
Well, we're very clear that all investments, whether they're securitized or crypto-based, have risks and deep risks. And we make that very clear to our customers. Now, I mentioned before the education that our users get out of this experience of learning to invest. So if the market does pull back and you do see some losses happen, yes, they walk away with a bit of change out of their pocket, but they get to have an education through experience that they would never have had through school or university. And there's nothing better than experiential knowledge. So, yeah, that is a risk, and investors need to know the risks when they get involved in the markets.
Really quickly, Anthony, are you seeing stimulus checks flow into stock accounts? Is that happening?
We have seen an uptick in deposits for sure. There's definitely a pretty substantial increase in the amount of activity that we've been seeing during this whole stimulus download over the last week and a half. It remains to be seen how that kind of plays out, but it certainly has risen the tide for all ships in the brokerage industry. Absolutely.
Anthony, thanks so much for joining us. Good to see you.
Good to see you. Happy Friday.
Likewise. 41 minutes left of Friday. Work Friday. Anyway, switching focus. US-China talks are just wrapping up. We've been watching as these became increasingly contentious, of course. The US delegation just speaking moments ago. Let's get to Eamon Jabbers, who's got a summary for us. Eamon.
Yeah, Wilford, that's right. A tense couple of days in Alaska as the U.S. and Chinese delegations are meeting, trying to hammer out some of their differences. First, real high-level, significant negotiations between the two sides. The Chinese side just walked out of that hotel negotiating room without saying anything to the press. The U.S. side, though, the Secretary of State and National Security Advisor both making a few brief comments. The Secretary of State saying here that they certainly knew going in that this was going to be tricky. He said that there are some areas where the United States and China are just fundamentally at odds. He cites Hong Kong, Taiwan, Tibet, and actions that the Chinese have taken in cyberspace as some of those areas where they're just not seeing eye to eye in these negotiations. He says it's no surprise that when you raise those concerns, you get a defensive response. On trade, he says they're going to continue to move forward in a way that fully advances and protects U.S. workers. So the United States signaling to China they're not backing down there, saying we wanted to share specific concerns we have about a number of actions China has taken, and we did that. We also heard from the National Security Advisor, Jake Sullivan here, who said, look, we expected to have tough and direct talks, and we were clear-eyed coming in, and we're clear-eyed going out. So that gives you a sense of sort of where they are. Both sides having the opportunity to lay out their concerns and obligations for the other. Doesn't sound like a whole lot of progress was made in terms of any kind of specific negotiations here. A lot of rhetoric, a lot of tension, not a lot of progress necessarily. Wilford, back over to you.
Eamon, thanks so much. The S&P 500 posted a weekly loss for the first time in 3 weeks today. Up next, Mike Santoli will have a look at whether a surge in sentiment could lead to a market bounce back. Plus, Stifel Chief Equity Strategist Barry Bannister will join us with his big call on value over growth. And March is Women's History Month, and we're spotlighting some of our CNBC contributors. Here is Loop Capital Markets President Courtney Gibson on getting more women into leadership roles.
In the U.S., more than 50% of the college-educated labor force is made up of women, yet women still only hold 25% of leadership roles, and less than 5% hold the title of CEO. As leaders, we all need to demonstrate that this is a business priority by not only what we say, but what we do, what we measure, and how we lead.
All right, guys. Sorry, that was like the longest phone meeting ever, like 2 hours long. So if you happened to be still watching, hopefully you were entertained by CNBC and everything else going on. So Anywho, let's see what we've got here. AMC was just, I can't explain this, right? And, while I was in that meeting, I went over to another browser here and I pulled up Yahoo Finance, and went to the conversations thread. I didn't go to Twitter. I tried to go to Twitter, but I didn't see anything. So that conversations thread on Yahoo, it's saying the same thing. So many people are on there saying, I've never seen anything like this before. This hard line of 14 where it's just up and down for that long. I mean, if you want to not count this right here, even if you want to not count this valley that it went into until 13.9, from right here, which is 10:30 in the morning, all the way until close. A little bit of a valley there, but didn't do it. But it's right back all the way until close at 3 o'clock. From 10:30 to 3 o'clock, it did nothing. I mean, I've never seen anything like that before. And if you really want to, you can count it to back here to 9:42 and 9:15 if you really want to. And if you really want to get squirrely, you can say, forget this whole crap, because it opened at 1400. It closed at 1400 or $14 yesterday, right there. And it opened exactly at $14 this morning, despite all this crap that happened after hours yesterday and this morning. Closed at 14, opened at 14, and stayed at 14, and then closed at 14 again, and stayed at 14 all freaking day. Technically, it closed at 13.9, but if you look at the end of the day, it was at 14 right here, which is at 14:37 with 2:57 in the afternoon, 3 minutes before the bell. I've never seen that before, that phenomenal of a way. That's bananas. So anyway, forget AMC. AMC just and then it goes ticks down after hours, and then it has this little tiny run, and then it keeps ticking down. So right now it's at 13:51. I'm just kind of ticked off because it's ridiculous. It's just what happened that day. So it's at 13:52 now. Maybe it'll tick right back up and it'll end up at 39, or maybe it'll do what it did after hours yesterday. What actually did okay after hours yesterday. Didn't do anything too crazy, but it did drift up here, to 14.3, and then overnight went up to 14.2, and then early this morning at 6 o'clock in the morning went up to 14.39. So, I mean, actually a really good run early this morning pre-market, but just the most bananas day I've never seen a stock do this before. At least a stock like that. I mean, you can get some of these penny stocks with no volume that'll do that, but not a stock like this that has some true volume in it. Express overall finished up 554 for the day. Let's reset the scale here to 1-1. So it started down, or I guess it ended the day lower yesterday at 4, or like right at 5, or maybe a little below 5, something like that. Spiked up right after the open to 5.8, and it was just kind of an up and down downhill roller coaster for the day. Ended up at 5.33, still up 5.54 for the day. Not a bad day. I just again wish that it took off. I'm just waiting for that day where Express is going to shoot up 40-50% and stay there, not just spike up and then come right back down like it did a couple days ago. And I mean, not stay there forever, but stay there for the day. It's going to have this day, but just an inverse graph, just cruising up. Cost had nearly the same type of graph as Express did. Spike in the morning, and then it just up and down for the rest of the day. GameStop, somewhat similar. It stumbled out of the gates, had a decent gain there, then a big crash, and then a big gain there pretty quickly. It went from a little below 200. I thought it went below 200 in this spike right here. Maybe not. Anyway, 204 up to 214 in a very, very quick. Never mind. I just zoomed out. Here's the big run I was talking about. This is the big run I was referring to. Went from 189 up to 227 in a matter of about 30 to 45 minutes. So huge run there for GameStop early today. It was what was that? Mid-morning, 10:30. until 11:30. So it's about an hour, about 1 hour time it took to make that very, very big run, about a 20% swing. So if you got in down here and then sold up there or something like that, good for you. That was a really good swing. And then it's kind of just trickling down after hours. So it ultimately finished the day down. It closed at 200. Even though it had a really good run midday, it finished down for the day. Cost finished very slightly down. And again, we talked about AMC, how amazingly slightly down it was. It's insane. And then Tesla was having a bad day most of the day, and then right here made a huge run in the last 12 minutes of the market, up from 648 and it closed at 654. So really, really good run there at the end of the day for Tesla. Ended up leading in positive territory. Let's just see where the major markets ended for the day. We're looking at the NASDAQ ended higher, which is great. It never tanked back down after a decent start to the day. So that's really good to see. Up 0.76%, about 100 points. The Dow ended down 230 points, so it's kind of flip-flopping the last couple of days. And the S&P, although it was looking good for the majority of the day, had a really bad last 15 minutes of the day, and ended up just barely losing for the day, down 2 points. Let's see. Bitcoin, Ethereum, Dogecoin, all trending up. Not the greatest day ever, but trending up. Bitcoin's nearly at 59 again, 59,000, I should say, which is great for them. For anyone who's got Bitcoin anyway, I should say. Not them, it's like a company, it's a currency. Treasury yield is just up today, which is such a bummer. It was looking like it was going to go down yesterday. Then it opened really, really high today. It stayed up most of the day. Stuff that I've got in triple Q and T triple Q, positive day, triple QJ had a great triple QJ, which is the innovation fund with triple Q, the new called next generation or whatever. Had a really good day, actually better than T triple Q. So it's not a leverage fund. So that's pretty interesting. Amazon did good and had a big spike right at the end of the day. Netflix did good, big spike right at the end of the day, which is really awesome. Google did good and had a dip at the end of the day. It's interesting. But almost every one of the tech stocks I have did good, plus a lot of the other building stocks. Ford did good, Norwegian did good. Pretty good stuff here. EXPI, of course, I told you yesterday, EXPI's roller coaster. Big gains, big losses. It up again another 8% today. Palantir went up today. Blink went up today with a big spike at the end. Kodak even had a decent day. On the memes, if you want to consider Churchill a meme, it's not really a meme, it's just a big social sentiment there on that one. It ended slightly down. Others, BlackBerry and Bed Bath & Beyond were up, which is great. Nokia brands finished slightly up. Then we get to some of the other ones that are emerging. MicroStrategy, great day, up 6%. Riot Blockchain barely got a gain. Market bet up nearly 2%. So that's really good. So overall, a great day. I think that despite the Dow being down, a lot of my stocks are in tech stocks and high growth stocks with bubbling values, quite honestly. And so today was a good day for me on that. Probably 1.75 to 2% overall of my portfolio is where I'm at right now. So it was a good day overall. I'm hoping that we can continue that momentum into Monday, and if we can, then I think we'll have hopefully a better week next week. We had a good start to this week, pretty decent week last week, really recovering from the crap that happened the 2 weeks before that, and then now this week just shifted downward. Like on Tuesday and Wednesday were not great, and then yesterday was just a disaster. So at least we had a decent day today, and I'm hoping that we can get some momentum into tomorrow. That's my really, really big hope. I think we can. I know we can. It's just we just got to get there. Got to get that treasury yield down, which is going to help those growth stocks come back up. Absolutely want things to go up as far as vaccines and opening things back up. Absolutely want that. I think everyone wants that. We just got to make sure that we are doing things in a way that is not so emotionally reactionary. Things are not, knee-jerk reactions both up and down, because that is what burns people in the market. And so I'm hoping that we can get that a little bit better under control so it doesn't keep happening. I am going to take this opportunity to sign off a little bit earlier today since we don't have a whole lot going on this Friday afternoon. I appreciate everyone who joined today. I had 15 playbacks today, 6 likes, so I think the numbers are slightly down from the last 2 days, but that's okay. I mean, it's still a respectable day for playbacks today. I know a lot of time I was like meeting and stuff and not paying attention to the screen, so that stuff happens. But that's the whole idea. Is I'm just watching the market. You guys want to watch the market too. You guys can watch me if I do any trades along the way. If you have any comments something like someone did earlier this morning, Klaus Media. Hopefully you were still on when we were talking about the answer to your question. So I put some comments in there to somewhat answer your comments as well. Um, if you come back Monday, we'll have some more conversation. If you ever want me to check on the stock and give you my personal, for fun, entertainment purposes opinion, not financial advice opinion, I'm happy to do so. But you've got to make the decision on your own on what works and doesn't work for your investment strategy. That's not something that I can do for you. So anyway, I'm going to take this opportunity to sign off, and I appreciate everyone who has joined me for the past 2 weeks. We're 2 full weeks in now to these live streams, and it is pretty exciting getting a few subscribers, getting, for the most part, more and more views every day. And so hopefully we can get back going on Monday morning. So until then, guys, adios.